Hope you had your breakfast. Yaar, haan to bol do. Haan, that's better. So you have got some energy. Fine. So ladies and gentlemen, we start this beautiful day, day 2 of GSMC also 2.0. Those who are outside can take up their seats inside the hall, and who are already inside, thank you for joining right on time, but kindly put your mobile phones on silent mode or vibrating mode. This is Dhwani again, wishing you a very good morning and also a great day ahead. So after the immense engaging sessions yesterday with lots of MOUs and the launch of courses and lots of things happening in one day, we welcome each one of you once again to another day filled with exciting sessions. For the first session of the day, I would, without wasting a moment, call upon the stage Shri Praveen Trivedi, Executive Director, IFSC, to address the audience on consumer awareness and protection in cross-border financial markets. So let's cheer up and start the day. Thank you so much. Welcome, sir.
Good morning. I just wanted to check whether you are responding the same way as you have responded to Dhwani or not. Good morning all, and I can see some of, I think most of the faces which were present here, so that makes my job a little bit easier. And for those who have joined today, and mostly I presume that those people who have joined today only, they will be from the securities market. So that again makes my job further easier, because I need not tell you what has happened yesterday and from where I am coming, because something I will just say something, and because you are having that background, you will understand what I want to say. So this is me, and I have spent 22 years in SEBI, India Securities Market Regulator, and now here I am, which is 4-in-1 regulator, unique sandbox regulator, I would say. Government has tested, and so far, for those who were not present yesterday, when we started, the total number of entities which were registered with IFSC June were around 92, and in December 2025, we have started our journey from 1st October 2020, and as of 31st December 2025, we have crossed 1100 entities in GIFT IFSC. So that has been the journey. Because this conclave is more focused on capital market or securities market, as the name suggests, but being a 4-in-1 regulator, we are here in this enclave regulating the banking, insurance, securities market, pensions, funds, and so many niche areas which were, I think, 5-10 years back were never even thought of, that a financial regulator will ever regulate such activities like aircraft leasing, like courses offered by the universities. Of course, they are particular courses which have been identified by the government. They have to have something with the finance or technology, and already 5 universities, international universities, are in this domain. So why I am telling all of this to you all, that IFSC, for the beginners, is drawing its powers from the mother acts, which is RBI Act, or Banking Regulation Act in banking, SEBI Act, which is the Securities Market Act in the domestic area, Insurance Act and IRDA Act, which is domestic in insurance, and then Pension Act, and then so on. So those 4 mother act remain, and we have been given power to regulate in this jurisdiction all those activities, and they have been barred from regulating or doing anything in this jurisdiction. So RBI has no role in this jurisdiction. We have every role in banking in this jurisdiction. So same way, SEBI. But having said that, Mother Act remains SEBI, and SEBI, when it was enacted into 1992, the preamble, as I am basically a law student, so when we are taught in the classes, we were told that the preamble of the act is the soul of the act. So preamble starts an act to protect the interest of investors, regulation and development of the securities market. So first sentence or first, if you say grand norm, is protection of the interest of investors. In securities market context, they are called investors. In banking, they are called customers. In insurance, they are called policyholders. In pension, they are called subscribers. We being the 4-in-1, we could have not used all those four words, so we have devised a new word, consumer. Consumer means a consumer, whether he is in securities market or insurance or banking or pension or any other thing. So we have a division also, which incidentally is headed by me, and my colleague Arjun is here. So we have started a bit late, I will tell why. So SEBI, when we were introduced in SEBI, we were taught that whatever you do, it has to lead to the protection of the interest of investor first. That is the mantra for you. Development, yes, of course, development is required. Without development, what a regulator will do, what the market will not develop. Regulation also is required, because a development without any regulation may go haywire and then people may suffer. So you have to, so as a regulator, every regulator faces this challenge where to put more emphasis. And this is daily basis. We are facing the challenges as a regulator, because I have worked in SEBI, I have worked in PFRD also. Now this is my third regulator, IFSC. So, and in IFSC also I have got the exposure in insurance. So, and banking anyway, being from legal department, all the circulars, all the regulations are routed through me. So I can say I have the broad exposure in all the sectors. So ultimately, we as a regulator think always, whatever circular, whatever regulation, whatever law, whatever guidelines we issue, we always have to have a balancing, do the balancing at last. Yesterday, in some panel discussion, a pointed question was raised to all the regulators, including our, our chairman and the 3 other regulators, that in a scale of 1 to 10, investor protection, systemic development, and overall growth, what you would prefer. So, IFSC chairman said investor protection is the first. Others have given a slight balancing reply that balancing has to be done, and that is the truth. Because if this has been challenge of a regulator, more particularly in SEBI, whenever we give more emphasis on investor protection, then development takes the backseat, which also we cannot afford as a regulator. Development has to happen. So ultimately the crux of the whole exercise is that you have to do balancing act, development not at the cost of investor protection. Development has to happen, but you have to keep always an eye that for whom ultimately these products are coming. So investors are at one stage, market participants, including whatever, I think most of you are from the market, REs, which are we call in regulated entities, whether it is MIIs or the brokers or other banks. So they are all market participants, and then regulators and the government. So and they both, in my personal view, they all complement each other. Regulator is there, government is there. If the market is not there, what it is going to regulate? If we regulate anything and we don't regulate properly, then investors will not be there. What for the market is? What you will do? So they have to coexist in an environment. We as a regulator have to develop that environment, that all coexist, all progress, all prosper, and ultimately they contribute to the economic growth of the country. And in terms, now we are talking about the international, so overall growth of the humanity, I would say. So with this background, I just want to show you some 1 or 2 slides or some messages which have recently came across in the newspapers or news. So just drive home the point, what has been the thinking and what is happening around us and what we should be aware of, or be aware of that. So can I will just.
Glad that the RBI is coming up with guidance on why mis-selling is not going to be, entertained. And I think the message should go to the banks that you cannot afford to mis-sell. And this word mis-sell, instead of offending anybody, seems to be one more word in the lexicon. Mis-sell is an offense, if you ask me. Don't ask me under which section of Bharatiya Nyaya Sanhita. But it is mis-selling, right?
So I think audio was little bit disturbing. So what she is saying that mis-selling is an offense, and she was addressing the banking sector, and she said that RBI, the people who are following the domestic India regulations, RBI is in the process of coming out with the guidelines for stopping the mis-selling, and she said that banks have no business to mis-sell. She has given one example that you have to focus on your core areas, and this is what RBI is coming out with this. So she was talking this in this context. Next, insurance. Those who follow the Indian domestic markets and financial ecosystem, they will know that lot of mis-selling is happening in insurance in spite of many efforts being made by the government and including the regulator. Third, please. So yes. So nobody is left alone here. I have put all three because people from banking should not feel that you are targeting me only. So SEBI is also equally worried about that, as SEBI keeps, and we know that about 6 months back, 1 year back, and there was a lot of hue and cry had happened in options and futures, and even finance minister and the SEBI then chairman had to come out in the public and caution people that normal common investors should not go in the option and future, because the study says that out of 190 people have suffered losses in options. So option is not for the small investor, it is only for the very well-informed and investors. So all three regulators have come out with this from different times. So idea was to draw home the point that whatever we do, we should not only focus on our business growth, rather, as I said, that all the segments of the market are complementing each other. So if you will only focus on your business growth, investor will not come, and investor will not come, then what will happen to your business? So you have to strike a balance on that. That was the point. And now, it's not, oh sorry. So with this background, I think I have, yes, so, okay. Some problem is there. Some problem is there. Yeah. So anyway, I have already raised those issues. So raising capital participation, because this is the global seminar, and now we are also discussing about the role of AI and advanced technologies in penetrating the markets. So individual investors have got a lot of options nowadays, as against what was happening 10 years down the line, that they can invest not only in Indian securities market, they can invest in any market in the world. And for that, I think it would be pertinent to mention that IFSC has also around 6 months back has allowed this global access. So Indian investors also can invest in the stocks of US or any other country through this route. So once that route has been opened, and India, the confidence is there that regulator is there, and say if something happens, they can go to SEBI and lodge their complaints. What will happen is some broker sitting in USA through whom these trades are happening from GIFT IFSC, if they are not responding to the concerns or claims or some mis-sellings which have happened with respect to Indian investors or domestic investors, and same way any investor all over the world, sitting anywhere in the world, can invest in any other jurisdiction, including through IFSC brokers, and then what are the mechanisms available to him to address his complaints. So digitization, cross-border platform, social media influence, everybody knows you go to Facebook or any social media platform, you will see, I think about 1 year back, we were flooded with the YouTube message, which apparently was shown as if Ashish Kumar Chauhan of NSE MD, he is suggesting some stocks to be purchased. Similar thing has happened with BSC CMD. And they had to come out with a press release and clarification, this is a fake video created by AI. This will happen tomorrow. I will not be surprised if they will show SEBI chairman or even including finance minister or prime minister also to invest in Israel, because he is visiting now Israel. He has just come back from Israel. So those type of things can also come. So we have to be very, very careful on that, social media influence. And then once, this has also a trend that once you have seen some video in Facebook or Google or something or some messages, next time you will open, all those type of messages only will come. So by some mistake also, if you have clicked something, then you will be flooded by that message and you will feel only you are the fool, everybody else is making money, and because you are not investing, so you are losing a lot on that count. So this is also one problem which is not easily, there is no easy solution to that, but like digital arrest scams are happening, and every day you open the Times of India in the morning, or any, even if you open in your system also, you will say some elderly people or retired people have been duped of their money on these type of scams. So this is what is happening nowadays, because now the investors, service provider will be in one jurisdiction, investor will be another, the securities will be listed. So this I have covered already. So he should be aware what he is purchasing. So this is, here it comes the mis-selling part, because somebody goes, my friend tells me, Arey, I have invested so many money, this much, in 15 days I have made 25% of the profit or 50% of the profit. So because my uncle has purchased or uncle's friends has purchased, that should not influence my purchase decision or decision to what to buy and where to buy. So awareness is the key, and whereas we should not be doing the mis-selling, and we should have, as a regulator, as MII, as a serious market participants, we should ensure that our team also should be aware, and whenever they are onboarding the clients or discussing with the clients, they should give the fair advice to him and let him, that is what SEBI's mantra has been, that in disclosure-based regime, you disclose everything fairly and then let them take a well-informed decision. Even mutual fund also, whenever you will see any advertisement, always it comes, mutual funds investments are subject to market risk, etc., etc. Please read off a document carefully. And because most of the people are not able to understand those jargons, you can only explain that, but don't sell ULIP to a 65-year-old person. So this is what is happening in AI and digitization, consumer risk. So all these things is happening, as I have already mentioned, algorithms, because once you click something, then same thing or similar thing will keep on coming, and same type of stocks, top 5 stocks to be invested, it will give you 100% returns in 1 month. Sort of things are happening in Facebook and other social media platforms, and you will not be realizing, as a small investor, common man will not be realizing this is all a game, and it is already pre-planned, and there are digital promotions, automated onboarding, behavioral influence. They are influencing your behavior, what to purchase. There is a very beautiful, I think, documentary on Netflix, where they have said that how Amazon has, over a period of time, influenced the behavior of the customers to purchase the things which they don't need. So I would encourage people to go and watch that, and this is happening in every sector. You will just see, because you have no time, you are sitting at the airport, you are sitting waiting something, and everybody is now into the mobiles, you will say something, and then you will get influence. Even if you don't require, okay, let us buy, because it is cheaper, and it is of no use. So what IFSC has done, because I have told about RBI, IRDAI and SEBI, what IFSC has done. IFSC so far, we have not faced any such serious problem on investor complaints or grievances, but because as I told you, we have started from 91 and now we have crossed 1100 entities. So we were aware of the fact that if it has not happened, it should not happen in future also, because that is a reputational risk which we as an international regulator cannot afford, because reputation, once the reputation goes, everything goes. So we were very much careful of that. So we have come out with a circular which is mandatory for all the regulated entities. And these are the 4 principles on which we have drafted our regulation, that your every transaction should be fair, dealing should be fair, dealing should be transparent, the investor should have access to all the relevant information, and so that there should not be any case of any complaint. But in case there is a complaint, the timely resolution of the complaint should be there. So that is on investor protection. Yesterday, the related issue to that is also that not only the REs, but the people who are working with the regulators and government, they should also understand the market. I have done only MBA finance and I come next day to a regulator, or I have done law, I have come to the regulator. I may not understand the nuances of the market. So the people who are working in the market which they are going to regulate, they should understand at least basic understanding should be there, what they should see, what is the mantra, and how they should process the papers and understand the, for example, in SEBI's context, of a document. So we have established a IFSC Academy, and we have launched 2-3 courses. Yesterday only, I think it was mentioned that 3 courses was launched in collaboration with ICSI. First course was launched because that we thought that is the most important and cutting across all the vertical was AML CFT, and that we have launched in collaboration with NISM. That was launched, and that has been made compulsory for all the REs. So that was the first course. This, and then cyber security, it is likely to come very soon. Certification courses, not only for, and that we have made not only for our employees but also to the market participants also. That AML safety, there can be zero tolerance on that. So we have made it compulsory. Similarly, cyber security, basic information, basic understanding should be with all who are working in this financial sector regulatory market. So that is coming, I think, in April. These 3 courses which we have yesterday launched, that was on corporate governance, fund management, and CMI, capital market intermediaries, the basic course to understand what is capital market, what are the roles of intermediaries, etc. That is coming. Will be yesterday it has been launched. Registration will open from 1st April. So purpose is that investors and all market participants. And in a way, we are also investors, because everybody of us must be investing something in some product or the other. Though as a regulator, we have been put under some restrictions in SEBI. Like for example, we were not allowed to invest in securities market equity shares except mutual funds. Only mutual funds were allowed for SEBI people. So some restrictions are applicable on us also. So except those, we are also investing. Even if it is FD or it is an insurance product or any other product which we feel that we should invest today, so that after retirement I will get the benefit, or I will get some lump sum amount so that I can purchase my flat or home. So mantra is that investors should be well informed, and for that institutions including REs, MIIs, including regulators should also be well informed, and they should be working and continuously working to upgrade their knowledge, upgrade their efficiency, upgrade their soft skills also, to catch with the market and to walk with the market. So at the end, how market will any jurisdiction will grow, or for that matter, any financial sector can grow, is a trust. Trust-based. If they have trust, trust will come from transparency. If we disclose everything, fix the accountability. If there is a mis-selling, immediately we should do some action, we take some action, and predictability. Predictability, when we say predictability in the market behavior, predictability in the products, predictability in the regulations also. So predictability is on us also as a regulator, that our regulations, our guidelines, our circular should be such that people who are coming today, it should not happen they have come on some X premise because today regulation says this, and after 1 year we change it and take a U-turn. So that predictability has to be there, so that then only the long-term investor, or for that matter market participants, or for the regulated banks, insurance and other entities will come. So with this, I will close my remarks and thank you very much for having that patience to listen me. At the end, I will just, because tomorrow is starting this weekend, so I will just recommend this documentary. If you go back, you are flying back, and in the flight, or you can download on your phones, you can just watch this, and this will tell you, because what I have told so far, what you should do. This will tell you what we should not do. So with this, thank you very much.
Thank you very much, sir, for setting the tone of the day with your insightful remarks, and would now request Mr. Dharmesh Tejani from NSE-IX to present a memento to sir. Get in the center. Thank you very much. So friends, moving on, we have a very interesting and very high discussion panel coming up. This is on innovations driving the next revolution in stock exchange trading. It will examine innovation in technology and product design that will have a bearing on secondary market trading on the stock exchanges in the near future. Panelists will discuss the impact of AI-driven predictive analytics and quantum computing on high-frequency trading and smart order routing. To moderate this panel discussion, please help me welcome on stage Mr. Praveen Kamath, General Manager, IFSC. Welcome, sir. I now take a privilege to call the panelists on the stage. Foremost, Mr. Michael Sin, President, CGX Group, Singapore. Welcome, sir. Mr. Russell Bitty, Managing Director, APAC CME Group. Welcome, sir. Mr. Murray Steele, COO, APAC, Cube Research and Technologies. Welcome, sir. Mr. Nikhil Kohli, Managing Director, Head of India Equities, Citi. Welcome, sir. And Mr. Stephen Ulrich, Senior Vice President, Eurex. Welcome, sir. I can see, the stage when the claps are higher when I call the first person, and towards the last it goes like, Come on, just morning, guys. Thank you so much. Over to you, Praveen.
Thank you, Dhwani. Before we start this panel discussion, I just want to make an announcement. We have the GSMC 2.0 app on Android and iOS store. So during the course of the panel discussion, we are going to activate certain audience opinion poll questions. So if you go to the app, at the top left corner of the app, you will find 3 lines. You click on that and live session and then polls. So I request all of you to take 10 seconds off and just answer some of the questions in that public opinion poll. These are multiple choice questions with options, and it's completely anonymous. So with this, we can start off with our panel discussion. We have 5 top executives from the capital markets industry today with us. And they have such illustrious backgrounds that all the time zones on this planet and all the geographical locations on this planet are covered between the 5 of them. So let me set the context for today's discussion. Stock markets are considered to be the plumbing for capital markets, and today that plumbing is being torn apart and rebuilt in real time because of the advances that are taking place in technology. There was a time when settlement of equities used to take place on T+4 basis. That time reduced to T+3, T+2, T+1. Today, equities in China are settled on T+0 basis. Equity market in India settles on a T+1 basis and moving towards T+0. So with all this innovation that is happening, the regulation later follows. The innovation comes first and the regulations come next. So that raises a very troubling question, that are we modernizing market infrastructure or are we just rewriting the rules of the game? So this is the context for the discussion today. So I'll start with my first question, which is on trading hours on the stock exchange. When we set up two exchanges in GIFT IFSC, India NX and NSE IX, because this is financial center in 2017, decision was taken that it should be open for 21.5 hours. The reason was it should cover Japan, APAC, Europe, as well as the Americas. So investors from across all these jurisdictions and time zones would be able to come and trade on the exchange. That was the idea. SGX today is open for 21 plus hours, 5 days a week. The CME group, CME Chicago Mercantile Exchange is open nearly for 24 hours, given your Globex trading platform. And Eurex is open for 21.5 hours, 5 days a week, with some exceptions, of course. So the question is this. Now the argument that is given for 24/7 trading is that there is an overnight demand from retail investors and institutional investors from across jurisdictions. So the 24/7 trading hours help in bringing in the liquidity. This is one side of the coin. However, there is another side of the coin which says that if you spread the buyers and sellers across 24 hours in a day, you thin out the liquidity, and that has an adverse effect. This is the other side of the coin. So with this, I would like to first start with Mr. BT. Is 24/7 trading on the exchange the most optimal model for price discovery for equities and derivatives markets?
Well, good morning, everyone. Thanks for having me. It's always a great pleasure to be back here in Gift City. I think a couple of things, if I can, just to start with. 24/7, we currently at CME have had 23/5 for many, many years. So when everyone starts talking about 24/7, and we just announced just recently over the summer, we're going to be launching weekend trading. Basically what's happening is it's 23/5 is going to stay exactly the same. And then in addition to that, there's going to be access to a weekend market. So the market will close approximately 2 hours for a maintenance window on a Saturday morning Asia time. And then it'll be 100% pre-funded. And then we'll trade, any trades done over the weekend will settle on the Monday. So it's not quite 24/7 just yet. So it's 23/5 plus a weekend session. So that's the first one that's going live. Now I think what's really important is understanding, to your question about liquidity, is understanding that the underlying core market has to be open to ensure it's right. So for example, we're going to be launching it on cryptocurrencies because it trades over the weekend. The physical market trades over the weekend, and so clients are coming to us to say, we need to manage our risk over the weekend, trading those hours. We're not going to open it for agricultural products because it's closed. It's illiquid, to your point. We're not going to be opening it for anything else unless the physical market is actually trading. Now, it's the thin edge of the wedge. We know, for example, that NASDAQ is thinking of going 23/5 for the cash equity markets in the US. Now, for example, and I'm just speculating here, down the track, if we're meeting in a few years' time, if NASDAQ was to go trade physical markets over the weekend, then it would be a natural extension of what we would do is to add probably then equity indexes to support that. But we're not going to start supporting equity indexes first while the cash market is closed. So I think that's a really important thing that we have to get across as we go through. The second one that's running in beta, which I think is exciting, is actually going 24/7, 24/5 with a closing window for 2 hours only on a Saturday morning and then running over the weekend. So that beta testing's happening right now, but that's not something that's going to be going live. So I think it's really important to understand your question. You're 100% right. The core underlying physical market needs to be open first. Then the underlying investor can manage their hedge and manage their risk exposure over that period of time.
Mr. Ulrich, if we take the example of crypto exchanges, they are open 24/7. What is your take on these longer trading hours? Does it really impact liquidity on the stock exchange?
Is opening longer
trading hours.
automatically going to generate more more liquidity? Thank you very much for the question. Look, I think we're very much aligned here across the different exchanges. As you said, we extended trading hours in 2018, went to 21 hours. That's gone very, very well. But I think one thing worthwhile pointing out is that we didn't do that across the board. So we did that for selected contracts, for the benchmarks, where there is strong underlying liquidity, for contracts in particular that were relevant to Asian investors, so the MSCI suite, for example. And essentially, Russ's comments around underlying markets are very, very relevant here. It doesn't make sense to just blindly extend trading hours for everything in the hope that somebody will come there. Another thing, yesterday at the FIA conference, somebody mentioned, say a statement comes out after hours in the US, say in a tweet or something like this, that market participants need to have a chance to respond. That is true, but on the other hand, I would say that it's also no coincidence that some news come out outside of trading hours for everybody to have a chance to actually think first before they then start going into the markets and doing something. So I think we have a very similar approach to what Russ just outlined.
Mr. Sen, when we enabled the Gift Connect, NACIX aligned its timings with SGX, 21.5 hours, so that the investor order flow from Singapore is in sync with that in Gift. Your take on the longer trading hours?
So because we are largely an institutional marketplace, so a few things to observe. Different markets have different structures. Firstly, our customers are largely institutional, largely Western. Secondly, we are not direct to customer. We go through a clearing member, then the clearing member goes to the customer. So what the clearing members and the customers have said very clearly to us, we don't need and we don't want 24 hours a day. Because, for instance, if you're in New York, you're managing 1,000 mutual funds. During the day, you execute your products. At the end of the day, you have to allocate, you have to reconcile, you have to do onward paperwork. It doesn't help their business or anyone else's business to trade for 24 hours when that is their fundamental cycle of reconciliation, of creation of mutual funds, of redemption of mutual funds. So if the underlying market structure of the end customer doesn't require this and doesn't work on weekends because banks don't work on weekends, moving to 24/7 requires a very strong reason because it carries with it all the credit risks that Russ was talking about. On Saturdays and Sundays, the banking system and the credit system isn't equipped to move collateral from one pocket to the other pocket. So you're actually adding risk to the system by doing this. What we have observed to the discussions with NASDAQ is when they try to go 24 hours, so far what happens, it's mainly Korean retail and maybe some Taiwanese or Japanese retail. And if that is a very important part of your customer group, then by all means go 24 hours. But certainly for our market structure and what we bring to Gift City, going 24/7 isn't completely obvious to me that it brings a lot of value.
Candid reply. So I'll move to my next question. IFSC recently issued a consultation paper on guidelines for algorithmic trading. And the reason why we issued is that we wanted to align our guidelines with international principles. Today on our exchange, a lot of trading, majority of the trading that's taking place is algorithmic trading. To be more specific, high frequency trading. Algorithmic trading gained traction in the 1980s in the United States. They are also responsible, some say that they're responsible for the Black Monday crash of 1987. Nobody knows the truth. But it's known that algorithmic trading has its share of benefits. They tighten the spreads and they improve liquidity. However, at the same time, because today entities are using co-location servers, they have that undue speed advantage. And this is an institutional play. Now, has HFT today, as of today, peaked as a competitive advantage? And many exchanges today introduce something known as speed bumps. And my question is to Mr. Steele. You are the expert here on HFT. So has HFT peaked as a source of competitive advantage? And what is your opinion on speed bumps? Have they really improved market access or market fairness?
Hey, Praveen. I wouldn't agree that HFT is, by definition, a source of competitive advantage. HFT is a style of trading, as is mid-frequency trading, as is commodity trend advisory and trend following. All of these strategies can make money. It's just the time period and the technology. And competitive advantage and HFT tends to go back to this view that everyone who does it is evil. Hedge funds are evil, quants are evil, we're all out there taking money from retail investors. A lot of the HFT traders are actually providing liquidity. They're making markets. They're showing constant order books that academic studies have shown have tightened bid-offer spreads and improved transaction costs for retail players. So it's a style of trading rather than an obvious advantage. In terms of speed bumps, where we've seen speed bumps, they generally do offer a more equal access in terms of time or latency. But there are lots of other considerations in terms of providing liquidity and who trades on the markets. You can speed bump, but exchanges will still need to make sure there are liquidity providers there and provide incentives such as market-making schemes, discounts, and ensure that you've got enough players willing to show that bid-offer spread to the retail. Markets will evolve. There was a time that electronic trading itself was brand new and possibly exacerbated the 1987 crash, and now it's just taken for granted. As technology improves, as we see more and more exchanges trading different asset classes and traders moving across those, we'll see constant evolution.
Fair enough. Mr. Kohli, my next question to you on HFT. In markets where there is a high concentration of retail investors, do you believe that HFT should be tightly supervised or regulated?
Look, I think as a principle, regulation is needed, right, in all markets, right? That's the basic thing. HFTs, by definition, again, they become such a big portion of markets globally. You do need regulation. If you look at the trends globally, retail everywhere is increasing participation. So I think the two pockets of investor concentration is retail and HFT. They do balance each other out, right? But you do need regulation, right? Do you need more regulation? I think that's debatable, right? But you do need basically equal access. You do need to ensure, right, that HFTs as a trading class, right, doesn't become too dominant. As it is dominant. I think it's found its equilibrium. I think it peaked around 60% in the US. It's down to around 50 now. I think if you look at India, it's around 30, 40, right? And I think that's probably where the HFT serves its purpose the best, because at the end of the day, they are liquidity providers. They're very important, right? But you can't have a situation where they suddenly become 75, 80% of the market.
Yeah. Mr. Ulrich, Eurex has introduced a form of a speed bump called passive liquidity protection mechanism, So what is your experience with this speed bump that you introduced for HFTs? What is the experience of Eurex with respect to this speed bump that has been introduced for HFTs?
It essentially works as intended. To come back to your original question, I think we certainly have seen the peak of the speed advantage, right? So it's not so much a defining feature of the market to squeeze out that last nanosecond, and we're definitely seeing like a much more a shift towards more sophisticated trading algorithms, and for the essence of that particular approach to markets, that has shifted somewhat away from the question that could be simply resolved by having speed bumps. So I think we're good in that space now, and I think one thing that's really important is for us as the intermediaries, as the market providers, to just continue to maintain an open dialogue, most importantly, including with regulators, also to, from time to time, again, look at what is meant by fairness, right? Because, of course, you introduce a speed bump, and some market participants may look at the mechanics of that speed bump to try and figure out how you can work with that, right? So I think it continues to evolve, and hence all of us need to maintain that as a matter of course to see what fair and equitable actually means and make sure we provide the best possible solution.
Okay, fair enough. Let me move to an exotic topic now from the stock, slightly away from the stock exchanges. Last November, the Gift Brokers Association, spearheaded by Nitesh Jaiswal, they launched their biannual magazine. And there was an event to launch this biannual magazine. So a lot of us from IFSC also contributed articles to that magazine. So during a short and sweet keynote address to the crowd, Mr. Balasubramaniam, MD and CEO of NSE-IX, he made one statement. He said that prediction markets in the US are gaining traction, and it's a space that we need to watch out for. So for the purpose of the audience, a prediction market is a market where you have an event-based contract based on the outcome of a particular event, be it geopolitical, be it corporate earnings, and so on. So in a way, it's akin to betting, but it is not betting. That's what most people say. So my question to Mr. Sin is this: what do prediction markets reveal that traditional markets don't?
This is a very big topic that in almost all countries and jurisdictions was resolved by saying certain things are socially purposeful and they're securities and futures and insurance and banking, and certain things are gambling in nature and you have a gambling authority to take care of that. And I suppose what's changed in the past year or so is that there has been a blurring of what ought to be organized and regulated in a certain way versus gambling protection. I would say that there are many aspects of functioning markets in the world which are converging now. One aspect is insurance. We today allow people to buy insurance against certain things that if they were in the market, you would say is not acceptable. I can buy insurance on my house burning down, on my own life, on my spouse, on a crash, on weather, things that if you put in the marketplace, you would say, moral hazard, difficult, game of chance, not game of skill. But we allow insurance companies to do that. Is insurance purposeful? Yes, for certain things. Increasingly for climate events, for certain real economic events. I would contend that it is more important than ever as we see the global economic supply chains fragmenting, that we might want to make available to our business community ways to exchange risk on shipping routes, commodity prices, the results of tariffs, the results of failed monsoons, failed harvests. These are categories of things that I feel that actually our market structure might do better than an insurance company. So that's argument number one. Very specific to the stock exchanges, I also think that the focus only on the price of a security can be significantly enhanced if we also allow investors to exchange risk on the underlying factors that drive a company or an economy. So there are many economists in this room. This is what econometrics is. They write a very long equation that says that the gross domestic product of India is equal to employment times employment rate plus people working in farms times, payrolls. These are all factors that if government economists are able to say, this is how I manage my economy, I would also say that we ought to let people create a market in these variables and exchange risk. So the way I personally think about it, and I have no blessing from my boss, my regulator, or my political holders, is there are many real economic outcomes which regulated exchanges such as ourselves should bring to the market, should allow the market mechanism to exchange risk on, and then you have created a new public good. Today, the things we trade on price. The public good is price discovery. We have discovered an actionable, tradable price which acts as a coordinating signal for the global economy. I think prediction markets done on real economy is probability discovery. It is very important for us to say, what is the probability of the rainfall over the Panama Canal falling too low so ships cannot sail? That's just an example. I think it is a public good to do this. It is important for public policy owners, important for planners, and important for anyone who's active in the real economy to think about marketplaces for real economic outcomes.
Talking about innovation, in that regard, if you see the way our capital markets evolve in India as well as across the world, the innovation comes first. It's introduced in bits and pieces. It gains traction. Once it reaches critical mass, then the regulators come into the picture and they say, yes, let's regulate this, let's supervise this, let's control this for financial stability risk. So my fundamental question to you, Mr. Sin, with prediction markets in mind, the reason why I'm asking is this. Earlier this year, in the first week of January of 2026, there was some geopolitical event. And one trade was made in the prediction market with respect to this event, which made a lot of money. And then the regulators and law enforcement agencies jumped into the picture, saying that this has been done based on inside information. So like you said, an event contract in a prediction market can be treated as a binary option. Now, that brings us to the more fundamental question. Are regulators actually enabling innovation or eternally reacting to it once it's introduced? I'm asking this as a regulator, after being a regulator for 17 years.
There are categories which we know through time, morally in society, we've said there is so mortality and death. Buying fire insurance on your neighbor's house. Betting on who becomes the Pope. By the way, this was the first incidence of when it was banned in 1591, because it was discovered in all the papal elections that the cardinals were spending most of their time trying to make money by saying, hey, I think it's going to be that guy, and they get the nuns to run outside to go and bet, right? So this was banned. And upon threat of excommunication. And this was only reversed in Vatican II. So this ban lasted for 450 years. So today, there are many things we're not allowed to do because they're deemed as immoral. But regulators have proven that they're open to lobbying. So if you think back to credit default swaps, until the late 1990s, this was illegal because it was actually buying credit insurance. But regulators globally decided, we will call it a swap. It is now a derivative, no longer insurance. So I think that innovation can move forward provided society is willing to accept that the greater good is served, some public good is served, and then we have sufficient safeguards on bad behavior. The kind of bad behavior which is probably unacceptable is reflexive behavior, where you create a marketplace and gamify something which in itself leads to a bad outcome. This is known as the Hunger Games scenario. If you let people start betting on outcomes in war, and by the way, this market exists. Ukrainian soldiers do this all the time. They're on the battlefield, they're very bored. It's like, how many Russian soldiers can I kill? Now, after a while, I think it is morally repugnant to gamify everything in life. And we should try our very best to focus the actions of the markets on things which are socially purposeful and lead to real economic outcomes.
With respect to gamification, and my question to Mr. Steele is that how can stock exchanges more aggressively self-regulate to enable innovation and handle emerging technologies?
Regulation is really important, and having investor confidence, be it institutional or retail, in an exchange is really important. I think it's just about regulation. I think for stock exchanges, in an era of innovation, it's the whole ecosystem. It's the tax environment, it's the political environment. So it's important that investors know how they can trade, but also how they can be taxed and how they can put money in and how they can get money out. Self-regulation in some jurisdictions, in some exchanges, has proven successful. In other countries, it leads to massive fraud, corruption, and graft. So it probably comes from a top-down government level, making sure that if an exchange or any other institution is empowered with self-regulation, that the right people are in place, and the right processes in place, and the right checks are in place.
My next question is with respect to retail participations. November 2025, National Stock Exchange of India crossed a major milestone. They crossed 240 million accounts, unique individual investor accounts in the Indian market. These are retail investors, and it's a big number. So, Mr. Beatty, if you see post-COVID, retail participation across exchanges is on the rise, right? If you see 0 day to expiry options, it's primarily driven by retail investors. In 2021, you had this GameStop scenario where retail investors hit back at institutional investors, if I may say so. So has increased retail participation actually strengthened or destabilized markets?
So I think there is no doubt about that there has been a massive pivot in the US towards retail and embracing retail. Mike just spoke about the prediction markets. As we know, they were launched on CME in December last year. We've reached 100 million contracts since then. Very, very small notional. So the demand from the retail sector is extremely high. I agree with all the comments around making sure that there is appropriate regulation in place because you have to protect it. But the development work that's going on at the moment in the retail sector is very US-centric. I think when we come out as we operate in Asia Pacific, there's some 15 different legal jurisdictions that we have to navigate out here. And every single country has a different policy agenda specifically, all right, as far as that goes. So a big part of what I'm doing at the moment is going around country by country, talking to regulators, trying to ascertain what their policy is and ensuring that the products that we launch in the US are fit for purpose in the local jurisdictions that we have in Asia Pacific. And I think that's really important. The development work that's going on at the moment is retail is definitely taking off. We are, you know, an incredible statistic is there's 4.2 billion middle class across Asia Pacific, which is now outspending the combined middle class of the US middle class and Europe together. So that sophistication, the requirements for that retail sector to look for different new products for investment is very much different to what it was 10, 20, even 30 years ago. So the evolution that we're talking about right now, and Mike explained it really well, is making sure that it's fit for purpose. Equally, we're in a situation with our partners from the professional trading community. They're providing liquidity in the Asian time zone. And so now what we're seeing very significantly, the data is showing this, instead of having to wait till London comes in to move risk, instead of having to wait to the US to come in to move risk, we are now seeing quite easily Asia domicile investors, retail, professional and institutional, being able to move and manage their risk in Asian time zone through the exchange structures that we have here and the infrastructure we have. 10 years ago, we didn't have that, did we? You know, we all grew up having to work nights, you know, to cover the European or the US sessions. That liquidity risk, that liquidity is now in the Asian time zone. So I think taking on board the regulatory framework is really important, making sure it's fit for purpose by country, making sure that the engagement is appropriate. But as I said, the expansion of that 4.2 billion middle class across Asia, we're not going to be able to hold it back. So we have to be able to manage it. And that is, you know, the projected by 2030 is where the volume is going to come from.
So Mr. Ulrich, taking forward what Mr. Beatty said, on one hand, on the stock exchange, you have high frequency trading firms which have an unfair advantage, if I may use the word unfair. And on the other hand, you have retail investors. Now, the proportion of retail to institutional varies from stock exchange to stock exchange. So are stock exchanges fundamentally designed for institutional accessibility or for retail trust? And where do you draw the line between accessibility and investor protection?
I would not say that exchanges are fundamentally designed for either of them, not on principle. Where you take your exchange, what measures specifically you take can make a big difference and can lead to a market being a bit more, having a more institutional bent or being more suitable for retail investors. But then again, luckily we don't operate in a vacuum. We operate in this force field with peers, with regulators and with the market participants. So at the end of the day, we can as long as the lines of communications remain open, undue harm can be prevented for retail investors. So I'd say, as Russ pointed out, as Murray pointed out, we cannot stop this. Like, there's no way, and we would not want to. I mean, there is the potential for retail participation to generate wealth, real wealth, is phenomenal. At the same time, we're starting to see some genuinely new phenomena. I think GameStop, which will probably require a bit of a rethink in terms of, okay, what is our understanding of a market, and what is potentially, in certain cases, a retail investor's understanding of the market. So one thing that I'd like to add into this whole thing, which I think can make a huge difference, that goes to the chairman's remarks earlier, education, or to use a sustainability term, financial literacy, all of these things. I think that's something that's a bit of a collective effort I think that we can all make to make sure that retail investors don't go into this unprepared and are to some degree shielded from anybody who tries to indeed unduly influence them in their investment decisions.
So investor awareness and education, that's what our Executive Director, Mr. Praveen Trivedi, also emphasized at the beginning of the session. So let me move to a new emerging technology topic, blockchain and distributed ledger technology. In August of 2025, the World Federation of Exchanges wrote to the ISCO FinTech Task Force as well as the SEC's Crypto Task Force that there is a growing risk to investors from unregulated platforms that are tokenizing equities, especially US equities, listed US equities. So it was a very strongly worded letter that was sent. Then subsequently in January this year, you had the NYSE make an announcement saying that they're developing a DLT platform for tokenizing securities and trading these securities. Now, a centralized trading system where price discovery takes place through order matching and execution is one type of technology. And then you have a distributed ledger technology. So Mr. Kohli, my question to you is, in traditional stock markets, stock exchanges, you have one single point of order entry, order matching, and execution, right? And that's a huge scale. You have, in the Indian markets, you have like literally 20 billion orders that are entered on a daily basis. Can a DLT technology or a blockchain technology handle the scale, as well as the latency requirements of people who execute trades on the stock exchange? And do you ever see DLT becoming mainstream on a stock exchange?
No, so I think where things are today, I think it's pretty clear that blockchain, for all its efficiencies and all its greatness, doesn't have the ability to handle the scale, right, of transactions that a stock exchange is set up for, right? Now, having said that, I still think that there are applications, right, around DLT specifically, right, which will, I think, over time be adopted by exchanges, right, to increase efficiency. And most of this, I think, comes more in the post-trade cycle, right? So while the exchange core function of trading, right, it has massive moats. It's very, very difficult to replicate that, and there's a lot of trust in that entire system. There is potential for efficiency in post-trade settlement, right? And that's where I think blockchain and DLT technology really can come and step in. It'll take time, right? But effectively turning, as I think you said, equities at the start was T+4, right? We're now at T+1, T+2, right? Some markets T0, right? How do you get to real time? How do you get to DVP, right? That I think is where the real application of DLT in the equity space. In the fixed income space, as you step out of equities, I think yes, there's a lot of, because again, fixed income is, I think, a generation behind equities when it comes to efficiency, right? I think there's a lot more blockchain and tokenization can help over there.
Great. So I have a follow-up question to that. Blockchain technology or distributed ledger technology is primarily designed to eliminate intermediaries, right? It's strictly between the entities that are taking part. The way stock exchanges are evolving today, let's say even if DLT doesn't become mainstream, do you see a role for stockbrokers as an intermediaries in the stock exchanges that are emerging in the future?
I think brokerage as a industry will evolve, right? We've already seen that evolution in like phase 1, right? Where the focus on simply executing trades is going to diminish over time. It already has, right? You had high touch trading 20 years ago. It still exists, but it's a lot smaller portion. You move to electronic, right? Electronic itself will go to direct access, DMA, all that will happen. But brokers still play a very significant role, especially full service brokers, right? Because when you add pieces like internalization, right? Pieces like inventory, I custodian of assets, especially when you do it across markets, right? The prime brokerage model, right, is very difficult to replicate, right? It's bits and pieces, like I said, inventory management, internalization, cross-market leverage, right? And then even the advisory piece, right? Again, the way the world is moving with AI and everything else, I think a lot of things will get automated, there'll be a lot more efficiencies, but that last 5-10%, that last mile of human intelligence will continue. And that's where the advisory will become important, right? Whether it's corporate access, whether it is research, whether it is data management, that's the direction it's going to go. But I think it definitely will exist. I don't think you eliminate the broker completely.
Great. Moving over from the exchange to a dark pool, and my question is to you, Mr. Steele. See, dark pools are there in certain jurisdictions. In India, dark pools are illegal. You cannot have a dark pool in India. For the purpose of the audience, dark pool is an off-exchange trading venue where large blocks of securities are traded. The details of the trade are not disclosed until after execution, right? And these details are not disclosed primarily to prevent market panic. So, do you believe that dark pools, they were originally created many years back for a particular purpose? Have dark pools outlived their intended purpose, or they do still serve a function in today's high velocity markets?
It's an interesting one because we are seeing more dark pools springing up and a lot more volume going through dark pools. They have their uses in being able to shift large amounts of liquidity or being able to aggregate much smaller retail amounts for people like us to provide liquidity to. I don't think there's ever going to be one dominant dark pool because as dark pools become more popular and more participants enter them, the dynamics of that pool will change. And the advantages that you might have had in providing block liquidity at a fair price, a fair spread, may be eroded away, and so people move to the next one. But I think dark pools are here to stay, but I don't think there's going to be one dominant one in the way that we have dominant exchanges in particular markets or sectors. Maybe Russell.
Yeah, no, I tend to agree. Look, I think in all the conversations I've had with regulators around the region, I think the marketplace likes a regulated market, okay? That's why, for example, having our crypto futures contracts on a regulated market, it's transparent and everybody knows as you go through. I think what's interesting, just picking up on a point, is that something in a tangible way is that coming up with this 24/7 is stablecoin, all right? And it's the transfer of cash through stablecoin to address weekend when fiat the banks are closed on the weekend. So I would suggest that this year we're going to start seeing that, for example, all right? A transfer of stablecoin where an investor trading over the weekend, if they want to pay the margins or transfer cash, they will be able to use a particular stablecoin, for example. Now, that's a development that's going to happen probably this year. So linking liquidity pools, dark pools that you're talking about, linking the previous comment you spoke about, blockchain, that's a very tangible development asset that's going to happen this year because banks can't handle over the weekend. So that gap is going to be filled by technology. And I think that's the key. Wherever there is a gap, technology and innovation will fill that gap with some particular form.
Mr. Ulrich, Eurex is a lit market, right? Eurex does not have a dark pool on its own, but your parent Deutsche Börse Group operates a dark pool for equities and ETFs. So, do you believe that regulators should regulate the amount of activity that takes place in a dark pool, especially when it is managed by an exchange?
Okay, generally speaking, regulators should always, again, to come back to the opening remarks, should make sure that no harm can come to anybody. Whether that puts a dark pool operated by an exchange in a particular special category from one operated by a non-exchange, I'm not sure that makes much of a difference. But I'd like to come back to some of the earlier comments here, because originally the question started with the disintermediation that can happen with blockchain technology and all that. I think another major aspect of that, of blockchain technology, is efficiency, market efficiencies, filling gaps that weren't there. So we recently ran a successful pilot on collateral mobility using DLT. That's where we definitely see like major potential. So I think it's not all about the disintermediation and suddenly everything's going to become completely trustless and anonymous. Having said that, I think we're at a major inflection point, and Russ was just getting to that, where different things converge, in particularly now DLT and AI. So one thing that caught my eye preparing for today was that Coinbase, apparently some 2+ weeks ago, introduced a new payment protocol, X402, specifically for agents. So suddenly, this is to enable agents to make payment, to autonomously make payments. Now, Stripe, Amazon are among the companies that have now already adopted that, and within 2 weeks, we've seen 50 million transactions happening in a purely agentic space. I think that is stuff that we really, all of us, need to wrap our heads around very, very quickly, because the speed of innovation that we're now seeing, courtesy of AI, I think really we've got to be very, very careful there that, we keep everybody safe and well protected.
As we're nearing towards the end of the session, can we have the results of the poll on screen? So as they're displaying, I'll just start with my last question. The year 2047 is a very, very important year for us. It's the 100th anniversary of India's independence. The year 2047 is also a year touted by many futurists as the year of technological singularity. That's when machine intelligence will overcome human intelligence. So in 2047, if we were to jump to 2047, what would a stock exchange in 2047 look like? Mr. Sin, the question is for all the panelists, so we'll start with Mr. Sin.
Singularity dates are compelling to think about, but actually we've blown through them and no one said anything. A very important test used to be this thing called the Turing test by someone very famous, Alan Turing. If you can talk to a machine, but you can't tell whether it's human, then basically machines have achieved human intelligence. By the way, we passed that 5 years ago, and nobody thinks that these chatbots are humanly intelligent. So the definition of useful intelligence changes with time. 2047 is a long time away. I would say that a few of the things which are happening today make me think that market structure will certainly be different, but whether stock exchanges are still relevant is a separate topic. The question of the stock exchange is whether you believe the joint stock company, the way we have organized ourselves for 500 years, a company with permanent capital available to shareholders, will that continue to be a legal construct that's useful? And it may be that it's not. If that's not true, you don't need stock exchanges. Market structure categorically will head more decentralized and then more distributed. And actually, building on the points they were mentioning, the interesting thing is not that exchanges now allow AI agents to pay or to trade. That's just algorithmic. It is that you've all heard this term, the DAO. The role of the supervisor and partially of the regulator can be embodied in code, in policy. And some of these DAO organizations are now saying the governance, the policy making, the regulation of certain chains will be done by AI dynamically, right? So that is when it's going to get very, very interesting.
Fantastic opinion. Mr. Beatty.
2047, I'll be back on the farm in Australia, and you're welcome to come and visit me, all right? But I think what's really important, what I'm really super excited about Asia Pacific, is that our projections are that by 2035, a little bit before that, over 50+% of the global GDP is going to come from Asia Pacific. So expanding on what I said around that 4.2 billion middle class, the engine room of the world is going to come here. So by 2047, I would, from a distance, I'm going to be seeing how successful and how dominant the economic growth and infrastructure setup that we have here in Asia Pacific. At the moment, we have, for very good reasons, we have domestic isolated markets of very significant dominance. Third quarter last year, as a statistic, out of all the futures contracts that traded globally, 63% came from the Asia Pacific region. So that is only going to increase. So my projection is that we're going to see a very significant dominance growth factor here in Asia Pacific. We're going to start seeing, as Mike said, market structure changes, where we're going to start seeing a shift of the capital and engine room of global growth is going to come. And everyone in this room is well placed to take advantage of that, to set the foundations for that projection.
Mr. Steele.
2047, I'm sure we'll still recognize the brands of NSE and SGX and CME and Eurex, but what they actually look like might be very different. And it's been interesting to look at some of the newer disruptive digital exchanges that have started in the cloud, whereas these guys had the mainframes years ago and are managing the traditional exchanges are managing huge legacy technology systems and processes. The newer digital exchanges have gone straight to Exchange 2.0, 3.0. So there will be a huge transition. I have long been told off by my friends at exchanges that I should not refer to them as monopolistic utilities. And I would like to see more competition for buy side. They'll be there, but it'll look technologically very different. The technology will be disrupted, and hopefully a much more competitive landscape where we can trade and where we can find liquidity.
Mr. Kohli.
I mean, maybe I'm being a bit more conservative, but I think you will have a regulated marketplace in 2047. It's probably going to be continuous, right? And I think just the speed at which information is processed will be a different paradigm, right? So when you combine quantum computing with AI and that whole piece together, the investing climate or the investing environment will be very different. But I think at a base, there will still be a regulated marketplace. So the stock exchange will still be in the middle of it.
Mr. Ulrich.
Thanks a lot. So 2047 feels like a very, very long time away, and like having been around since before 2000. The thing that strikes me the most is that the accelerating pace of innovation that we've seen since then. So I actually, with that question in mind, I checked with my favorite research assistant these days, and to remind myself of like what the world looked like in 2005. So the NYSE was still mutual. CBOT until October that year was also still mutual. CBOT was mutual. So we've seen so many things that have happened, and in particular the last, I'd say, 1-2 years. Again, the pace is picking up so much. It feels really difficult to make a proper prediction. So I'll leave that to my favorite research assistant. So in 2005, someone would have laughed at the suggestion that the NYSE would become a division of a mortgage technology company, that more than half of S&P 500 options would expire the same day they were created, or that a Reddit forum could move 20 billion in market cap in a week. The equivalent absurdities for 2047, perhaps fully autonomous AI market makers, real-time atomic settlement, eliminating CCPs entirely, or exchanges operating as decentralized protocols with no corporate parent, may sound simple and ridiculous today. So let's see where we go.
So we are dot on time. With this, we end the session, but I'll just go through the audience poll questions. So the first question was, does high-frequency trading improve or reduce overall market fairness? So a good deal of people said that it improves efficiency, but reduces perceived fairness. Next question. Should exchanges impose artificial So the second question. So the second, hello, yeah. Second question was, should exchanges impose artificial speed limits or delays for HFTs? 29% said yes to level the playing field. 47% said no, speed is legitimate information. Wow. And 23% said only when retail participation is high. Fair enough. Next. During times of market stress, the liquidity provided by HFT firms is best described as an overwhelming 75% said reliable and stabilizing. Wow, this is interesting. 20% have said. Yeah, 20%, 18% have said it's illusory and destabilizing. Wow, this is an interesting audience, huh? Yeah. Next question, please. Yeah. The recent rise in retail trading has been 83% said net positive for market liquidity and 16% said transformational for certain assets. Good. Next. Today, AI in trading provides its greatest edge through. So 69% said faster processing of information, 23% said better prediction of prices. So I believe predictive modeling is already in play through AI in our markets. And 7% said, one vote in fact, automation and cost reduction. Next. Would you trust a fully autonomous AI trader with no human override? One person has said, yes, already do. Also, autonomous execution is there in our market right now. Yeah. Absolutely not, zero. But a good 64% said, yes, no humans must remain in the loop. Fair enough. Next. Future market crashes are more likely to be caused by, this is Mr. Steele's area of expertise, AI feedback loops. In fact, the stock market crash of 1987, they say algorithmic trading caused that crash. It was a feedback loop, though it was not an AI feedback loop. The market went into, those algorithms went into feedback loops, and that's what caused the crash. So 46% said AI feedback loops, 20% said human panic.
This meeting is being transcribed and summarized.
Failures, and a good 20% macroeconomic shocks. So let's see what happens later this year. Yeah. Next question. Sure. Yeah, like my ED is saying, what will happen if a machine panics? You know, the autonomous trading system panics. What's going to happen? It's interesting to see what happens. I think the shocks that we have witnessed over the last 4 months are anything but macroeconomic in nature. Yeah. Next question. We're done? Yeah, great. Yeah. So with this, we conclude this panel. Thank you so much for the esteemed guests. I especially want to thank all the panelists. 4 of them have flown in from overseas, specially for this panel. Thank you so much, Mr. Sin, Mr. Beatty, Mr. Steele, and Mr. Ulrich. And Mr. Kohli, thank you for taking time off from your busy schedule for coming and attending this panel. Thank you so much. So, Dwani, over to you.
Thank you. Thank you, Praveen, for churning the session so well. And in order to present the mementos to the gentlemen, I would now request Mr. Amit Pandya from NSE IX to present the mementos to the panelist and the moderator. Foremost to Mr. Michael Sin. Thank you for flying from Singapore over here. Mr. Russell Beatty. Mr. Murray Steele. Mr. Nikhil Kohli. Mr. Stephen Ulrich. And to Mr. Praveen Kamath. He took exam right in the morning. Thank you. Can you pose for the group photograph, gentlemen? Please join, sir. Thank you very much. Moving on now to our second insightful panel for the day, which will delve into the topic of the panel discussion is trillions in the crossfire. Thank you, gentlemen. Decoupling climate finance from geopolitical situation. And the future of climate finance depends on the world's ability to decouple climate action from geopolitical hostility. Success will require a fit-for-purpose global financial architecture that prioritizes liquidity for the vulnerable, transparency in private flows, and the recognition that climate stability is the ultimate global public good. Allow us a moment to start the panel discussion as we set the stage. Are both the panelists online? They are online, right? Fine, thank you so much. That's fine. That's fine. Okay, so I request everyone to kindly settle in fast as we begin the panel discussion with our moderator, Mr. Pradeep Ramakrishnan, ED, IFSC. Welcome, sir. Sir, welcome. This makes it louder. I also welcome Ms. Chandni Rena, Advisor, DEA, Ministry of Finance, Government of India. She's joining us virtually. Can we have her on the screen, please? Good morning, madam. Welcome.
Good morning. Thank you for inviting me.
Pleasure, ma'am. We also welcome Mr. Seen Kidney, CEO, Climate Bonds Initiative. Hi, welcome, sir. Good morning to you as well.
Thank you for having me.
Okay, and from here, we welcome Mr. Shalabh Tandon, Regional Head of Operations and in charge of IFSC's climate business in South Asia. Welcome, sir. And Mr. Samuel Joseph, Deputy Managing Director, NAFID. Welcome, sir. Okay. Can we extend a warm welcome to all of them, all 5 stars? Yes. And Pradeep, sir, over to you. Thank you.
Thanks, Dhwani. Welcome to my panelists. Good morning, everyone. So I have the task of, I had to stand in fact, for at the last moment because the moderator who was supposed to, do this, had some personal issues at the last moment. So kindly bear with me for coming in front of you once again after yesterday, right? So we have quite an exciting set of questions, wonderful panelists. So, and one of our panelists will have to leave a little early, so I'll have to start with him first without wasting much time. So Shalabh, and this is something which I would like to pose to everyone as an opening question. So one thing is which we use a lot, a term that we use a lot is geopolitics, right? So even I have tried to use it a lot as an antidote to a lot of my failures. At times, the only place where I have not used it is home. So that's not, I'm not able to, find a way to do it. But what do you think is a barrier to climate finance? Because this is something which also gets discussed at the COP every year. Do you think geopolitics is a barrier, or probably even just a financial architecture itself?
So I think from where we are sitting as part of the World Bank group, geopolitics has certainly played a role, but a bigger barrier is creating a pipeline of bankable projects. If there is a pipeline of bankable projects and the risk-return profiles match, then whether we call it climate, whether we call it tagged to anything, capital will usually flow in it. So it's creating a huge pipeline where the risks are well disseminated to the capital allocators and where the returns are commensurate. That will drive the whole financial architecture. Geopolitics has played a role in terms of concessional finance, in terms of driving the North flows to south in terms of philanthropic capital, in terms of blended finance, and so many other things. That has been a detriment, and I think that's a challenge going forward.
Okay. So Samuel, your opening remarks on that?
I think geopolitics has played a disruptive role, but I think this is a little temporary. After all, what is president's tenure? 4 years, 2 terms. That's what we think. I don't know what the president thinks, but the financial architecture challenges, I think, are more challenging with regard to taxonomies to enable seamless flow of capital. So I think we need to do a lot more on the financial architecture scenario in order to bring about.
So I'm going to come back to you on taxonomies, because I do have something on taxonomies, and probably I'll just ask Sean his in his views, his opening remarks before I probably come back to the panelists on the set of questions that I have. Sean, please.
Sure. Well, look, my answer is a bit like Shalab's. I mean, the geopolitical environment we live in is, of course, challenging and difficult. But let's be clear, it's very localized. It's localized to a big economy, but the rest of the world is getting on with things in many ways. The architectural issues are the biggest issues. There are some barriers which are problematic. I mean, credit assessment tools, for example, on the international stage are weak. When India, whose sovereign debt is, I can't find an investor in the world who thinks there is any chance of default from the Indian sovereign. And yet it's rated BBB. I mean, that is madness. Clearly, that is madness. So borrowing costs as a result are higher in India than they should be if you used a substantial, a proper credit assessment tool, and so on and so on. There are many architectural issues along these lines that we need to address going forward. And we can address them. And of course, we're in a race to address that kind of risk assessment in time to be able to make sure that negative risks coming through of climate impacts don't make things worse at the same time. So this is an architectural issues, but there are other architectural issues too. We know there are issues around access to capital markets. This is why Gift City is so important, because it's a tool to increasing access to India's capital markets. And we also know that there are some structural issues in northern investors around asset allocations and the regulatory environment for them, which reduce their propensity to look forward rather than look back. In other words, they don't allocate enough money to emerging markets. And I had a long conversation yesterday with one of the largest emerging market investors about the frustration of these particular issues. These are architectural issues. Finally, Shalab, dead right. At the end of the day, the real issue is pipeline, structuring the long-term framework. We need that to convince those investors to change their asset allocation, to restructure the global conversation about risk, etc. So you know where I stand.
Yeah. So with Chandni ji, of course, I'm not going to ask anything on geopolitics, because as regulators, we are supposed to be agnostic when it comes to the geopolitics. Our rules and regulations are supposed to withstand all this. But I would like to probably, recently the Niti Aayog came out with an estimate that we probably need almost $23 trillion to achieve our net zero thing. And in fact, it started from 10 trillion, it went to 15. And now it has been estimated at 23 trillion. And to be very fair, I think probably I would want probably Chandni ji to probably comment, of course, on that. First is probably, where do you think India has progressed? And secondly, there is also a gap. While there is a thing that we need so much money, there is also a gap that is projected of almost $17 trillion. So how do you think India as a country will be able to meet its targets, not just as as a nation that has to meet its goals, but even otherwise on transitioning towards a wholly green economy?
Thank you so much. But before I go to this question, let me also add my 2 bits on this earlier, the icebreaker question that you asked. And like the other panelists, I would want to say that it is actually the global financial architecture that is much to be, responsible for what is happening at the moment where finance doesn't flow in at all. And I don't really agree with the view that there is a need for pipeline of projects. That alone will not help. At the moment, the overpricing of sovereign climate risks and not taking into account the resilience building measures that the countries might be taking, or to value their future climate vulnerabilities in that manner, only creates cost of capital, leads to a cost of capital which does not allow investments to happen in a range of climate projects. And that is the crux of the problem, we think, is responsible also for the lack of stream of projects that we would want, because the stream of projects also needs to be viable. And, the same project in a developed country vis-a-vis even a big developing country like India is priced completely differently in terms of capital, access to capital. So making it impossible and for developing countries to scale up climate action, much as we may want to do so. So that's one aspect of that question. The second, I think you're talking about how are we to do this financing gap, the extensive financing gap of 6.5 trillion, as is mentioned in the note. And, from the standpoint of what I just said, climate finance flows as such. The problem that exists in accessing finance of 6.5 is actually external financing, is because of the international financial architecture the way it is. Now, that makes it difficult for it becomes a structural issue than access to finance in general and domestic action to enable finance to flow in. Domestic action in countries like India is ongoing, and at present we know, and all of us know, that much of climate action in India is actually being carried out through domestic resources. So the financial capital from external financial flows are actually quite minimal. But the problem is about the international financial architecture. So you don't take into account the fact that the country's been growing at a fairly buoyant rate, much higher than most economies in the world. It is taking climate action over several years. So it's been on since 2009, when the National Action Plan for Climate Change was set into motion. There is resilience building, but still no accounting of that. The extent of domestic engagement, therefore, is not the issue. The issue is actually the fact that the cost of capital tends to be high, because how are we looking at how is international finance looking at us? It's overpricing our climate risk, looking at climate vulnerability without taking into account the action that has been taken. So it assumes that there's no action. And what would be the climate vulnerability, let us say 20, 30 years down the line, making the cost of capital extremely exorbitant. What do we need in finance? Well, financing of climate. We need investments in grid. We need investments for battery storage. We need investments in our hard-to-abate sectors. This is not a project-specific input that we would need. It is an economy-wide requirement of finance. And these are the structural issues that need to be addressed, without which finance will not come in. What we'll get is bits and pieces of small projects which are not scaled up. They are, you have accounting in terms of carbon emissions reductions in those projects, and that's about it. But what is the impact it would have in enabling the country to move towards a more climate sustainable architecture is not there. So I think I beg to disagree. And in this way, I also want to make the point that, the common but differentiated responsibility has turned on its head for developing countries like us, which are not responsible for the problem that we are in, making the cost of capital much too high for any climate action at scale to happen through financing from outside.
Yeah,
Thanks.
I also tend to agree a little quite on that, because I would also like to probably buttress that with the fact recently India towards its net zero goals also has, as part of that, we also have to report our nationally determined contributions, right, on what we have sort of achieved. So one of the things that India had promised the United Nations was probably will, the scaling will be up to almost 40% of the energy would be renewable. In fact, the fact is that we have progressed to 45% and even 50%. There was a thing that was also released officially in a press release, which actually demonstrates the commitment which the government wants, and a lot of this actually has been domestic capital. But now I'm coming to you, Shalabh, I think, and I want this probably the audience wants this from the perspective of a multilateral development bank. While India needs this money, quite a heavy investment, one of the things that probably are the objects of a multilateral development bank like yours is to bridge this gap, right? And the general thing is that the share of MDBs is a little modest than what it should actually be. And what do you think are the structural constraints which probably prevent an MDB from contributing to it or probably scaling it up?
So I think first we have made a lot of progress in the last 2 years. As you know, the IG report came out, which was co-chaired by Mr. N.K. Singh and Ali Samad under India's G20 presidency, which called for the MDBs to be and the World Bank to be a better, bolder and bigger bank. So under the presidency of Mr. Ajay Banga, we've taken a series of steps to really increase the mobilization. India is our largest exposure. Put together, all the MDBs in climate are probably doing about $125–150 billion. For as far as better is concerned, we are reducing the time and efficiency of approving projects. As far as doing more is concerned, we are trying to extract more juice from our balance sheet while maintaining our AAA rating. Can we, on our own account, get to about maybe all put together $175 billion per annum? That's still small for the global needs, but at least it's coming there. And finally, even to increase and double it, you need some, and that's where the structural issue comes in. World Bank Group, as you know, we need more hybrid capital and more capital from the shareholders. And the shareholders are all the countries. That's where the geopolitics comes in and creates that structural issue. Can we get more capital if one large shareholder is not willing to put more capital for climate, etc.? And that's something beyond us, that's more in government's domains to get that. But whatever is in our control, what we are trying to do is increase our own account investments and then mobilize on top of that, create a multiplier effect for every dollar that we put in. We've put ambitious targets of mobilizing at least $3 for every dollar that we put in from private sector market. Recently, and I must highlight India as a prime example, recently our board approved the India Country Partnership Framework, and we are doing it in all the countries. That country partnership framework was approved by our board and also by the Ministry of Finance in close consultation with them. The main principle, I will highlight two principles there. One is moving away from being a pure lending bank to a leveraging bank. Whatever we do, we have to look at how are we leveraging whatever limited resources we have, balance sheet, knowledge, investments, advisory, and then multiply it by leveraging private sector capital into this. So that is moving away. And second is the term, I think, which government used with us, and we have used it with our board, is finance plus approach. Finance is not enough. Where the World Bank Group sits in, we have to make sure that we are doing some of those difficult projects where cost of capital is high, which Ms. Raina was mentioning about. I don't think we said totally different things. What I said is, the north-south flows will get affected if the geopolitics are there, and that affects concessional finance and that affects blended finance. Now, that has not flown in despite our trying for 10 years. What we may need is, how do we, whatever limited pool of that capital is there, to blend, to do those difficult projects, how do we get the best bang for buck? Whether we'll get the north-south flows concessional to reduce cost of capital, we don't know. We've tried for 10, 15 years. We can keep trying about the CCDR responsibilities or not, but whether it will come in or not. for a country like India, the best, and India is in a very good, unique position, the best insurance for that is development of domestic capital markets, both on the equity side as well on the bond side, because that takes away the currency risk. I know Harish is sitting here from NSE. I'm part of one of the discussions around the green equity principles. We always talk about debt, but risk capital is also very important. So we are trying to come out with the guidelines, voluntary, for tagging green equity, which will create a lot of multiplier effect in that. Coming to the difficult projects, before they become market ready and before they become pipeline investable, that's where we need some form of blended support, blended capital, etc., 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 so that they become commoditized like solar. Today, you can finance solar very attractively, but you may not be able to finance a CCUS or a very difficult biomass project or a water project or an adaptation project where the returns are not clearly visible that easily. And that, no matter how much we try, it won't come easily unless we unleash the market forces into it. Therefore, blended finance comes in as a temporary concept for the interim to bridge the gap, but ultimately market forces have to take over.
So so by the way, I think for the benefit of the audience, I'd also like to say that the IFSC is also in the process of coming out with its own framework on blended finance. It should be out. We came with the consultation paper. We're also trying to come out with the regulations very shortly. But Shalabh, I want to stay with you and just probably, why we did listen to Chandni ji, mentioning about probably, even an Apple store and just comparison, which is happening. So I'm just trying to probably just provoke this with you, and probably you can actually answer this, not even from as an IFC and standalone person also.
Yeah.
It's like, do you probably think that there may be a necessity to probably look at countries like India a little differently because of the scale of industrialization?
Absolutely.
And we have 1/6 of the population in the world, right? So is that happening, or do you think it should happen more?
I think it's happening, and let's not paint the entire world as a multilateral thing. I think what we are seeing, and you would also be seeing, and Sraina would probably be seeing even better than all of us, is bilateral collaborations are happening. So the trade deals have happened, India, EU. If India was not seen as a powerful nation, you wouldn't have seen those trade deals happen so quickly. India, UK has happened. India, US has happened despite whatever the new tariffs that have come up, 10%, whatever, etc. What these trade deals signal to the market is more than trade. It signals a trust element in the country. It signals, and again, I'm not wearing my IFC hat or the World Bank Group hat. It signals access to a very large market. 2 days ago, we were discussing in another forum in Delhi on how does India and EU and UK leverage these trade agreements for broader climate finance flows. And I think the elements are there to do that, for technology transfer, for newer technologies like electrolyzer manufacturing, for long duration battery storage, where I visited some companies in UK where they have the technology. They are dying to deploy it in a large market like India. We can use that trade as a foundation to build other elements on it. On taxonomies, interoperable taxonomies. UK and EU both have very advanced, detailed taxonomies around various things, including on adaptation, including on AI guardrails. And there are many things that we can do there. Of course, and the last element is, which is a challenge which we all have to work together, and it's a challenge to the MDBs also, is how do we link India's MSME structure segment, where a lot of the jobs will happen, into the global value chain. And that's some work that we still have to do. As in the previous session, somebody was predicting 2047, 2036 and all that. And if you visited the AI summit in Delhi, I found the maximum rush was in the panels which were discussing the impact on jobs. Therefore, for the MDBs and the World Bank, our focus is jobs, jobs, jobs. If the jobs are not there, if the income is not there, if the demand is not there, then what are you producing and for whom? But we'll reserve that discussion for another day.
Yeah, so I'm going to go to Sean now, and we have taxonomies and taxonomies. So no sustainable finance panel is incomplete without a discussion on taxonomy. So there are almost 40 odd taxonomies around the world. Around 10 of them are globally accepted. So, in of course, this in some way does help sustainable finance, but sometimes these standards are incompatible, right? And because of this proliferation of these standards, do you think there is actually costing any emerging economies? By the way, at IFSC, what we have done is that we have not tried to reinvent the wheel by inventing a taxonomy of our own. What we have tried to do is that we have said certain major taxonomies are those that we actually accept.
No, I think there's a confusion here. I mean, every country in the world needs its own guidance for its own market. Regulators, central banks, Ministry of Finance will necessarily be adopting, promulgating, and supervising a market around a taxonomy that comes out under their name. We're working in many of those countries. We're working at the moment on taxonomies in Ethiopia, in Nigeria, in New Zealand, all around the world, and that's a necessary development in what is a world of many sovereign parties with their own views. But that doesn't mean that the fundamentals, the underlyings, are different. The same kinds of climate development issues that face India, face Ethiopia, face Nigeria, face Brazil. The resilience side, especially the nature of climate impacts, is pretty well universal, especially amongst emerging markets, where the impacts are disproportionately felt compared to rich countries, as we know, as Chandni's referred to earlier. And India's work on taxonomy, that, and I have to say, Chandni's been leading that work, is a perfect example of that way. Grids are part of that work. Renewable energy, clearly part of that work. Clean transport is part of that work. Green buildings, these are the same all around the world. So don't get blinded by the colourful variety of clothes that we wear around the world. That's the joy of the cultural diversity of the planet. Understand that they're all clothes, they're all guidance. There is actually a surprising amount of commonality. And if you look at the interoperability tool that we've developed, working with a variety of international bodies led by the Azerbaijan Central Bank, you will see that in fact commonality is the norm. Hey, don't take me wrong, there are some challenges, in Europe especially, where there have been challenges with a way too Eurocentric taxonomy that's made it difficult for outside parties to participate in the European market. But look, the European Commission has recognised that only a tiny proportion of what should be eligible has been eligible, and they're in the middle of a big reform process around that. This is how things change, right? We rarely get things exactly right the first time, and Europe was a leader. But generally around the world, we're pretty comfortable, and we've been working with the IFSC and with others around this, around the world, some of Shalab's colleagues, to try and do this. And so I'm actually not too worried about that. I'm much more worried about the issue of how to get holders of capital in the world, which is predominantly in places like Japan and Europe and the US and Canada and so on, to become much more aware of the extent of the opportunities in emerging markets led by India in this particular case. China's reached the kind of status now, India is growing like a rocket. If they don't, they've got a problem for their future asset allocation. They won't be able to pay the pensions for their staff. They don't take advantage of these growth opportunities. So that pipeline story that Shalab was talking about, that explanation of the extent of green investments, of energy, of water, of urban development investments in India, and how to explain that, I think is the big story now. And I think we have a growing receptiveness around the world, supported by a raft of blended finance instruments that are now coming to play. Thank you, Asia Bangar, for having pulled together development banks around this to try and get more capital flowing. We need to get it flowing faster. There's a kind of need to turn the tap on, but we need to make sure that the pipeline is clear and exciting. So the work of Invest India and others becomes incredibly important here, linked to India's national taxonomy, linked to that taxonomy's relationship to all the other taxonomies. They are not crazily different. They are in fact reasonably, largely in the same line, because of course climate issues, both mitigation impact are actually broadly the same everywhere else. There are differential issues. If you're in Meghalaya, of course, what you have to do around biodiversity is different to what you have to do in Goa, but the principles are exactly the same. So I think that's the least of our worries. Lots of bigger issues to explain to the world what the future looks like.
It's quite interesting because, Sean, I just want to stay with you on that because I wouldn't know if probably, you can at least opine again on that. Do investors internationally, particularly the larger or institutional ones in Europe, do they really appreciate this difference? Like that though the taxonomies could be different, like you very probably said, the clothes they're just clothes, right? If they're just clothes, then why is it that, for example, in the IFSC, we have recognized international taxonomies. The same companies which are not able to borrow green finance in India are able to borrow, because India does not have a taxonomy of its own. We are in the process of developing a taxonomy. But for listed companies, SEBI came out with a broad definition of green bonds and a green taxonomy broadly on the ICMA principles. But it didn't find any traction. The same companies were actually able to borrow here because we have recognized international taxonomy. So why is that?
Look. For a start, the ICMA green bond principles and the SEBI principles are very high level. They're very vague. The detail, to make it easy for people to understand the range of things that are involved, comes out with national taxonomies. There are many issues around capital flows. Taxonomy is a tool to support, it's not a solution. So by having a taxonomy, we're not going to get suddenly an extra $1 trillion of capital flowing. I just want to be clear about that. It is a useful guide rail to speed things up as we address a bunch of other friction points. Taxonomies that look different are a bit of a friction point, and I'm very hopeful. I'm enthusiastic about the idea of the Indian taxonomy when it comes out, being able to be clear up front how it aligns with other taxonomies around the world to make it easier for investors. If India comes out and says, this is our taxonomy, and there are tools available that says this is how it fits in for you, this is how it fits in with Canada's taxonomy, which is coming through the system, Australia's, etc., then that'll just make it easier and give comfort to local investors. So there are things we can do to make life easier for all the parties involved. But that applies in other areas also. There are things we can do to make capital access to the Indian market easier for everyone. That's why GiveCity exists, for example, and so on. There are many things we can do to improve it, and we need to work at all of those things. There is essentially microeconomic reform, and there are a bunch of friction points in the capital markets of India, which have been slowly but surely being removed over the last 20 years of reform in the Indian market, which have helped capital flows. But we're not over yet. And that applies to the other side too. I mentioned earlier the challenges around asset allocation for pension funds and insurance funds in northern markets who are overly allocated to wealthy markets from any kind of risk management perspective. Some of those are regulatory reasons. So there is one of the things India could do, for example, is to get a discussion going with Europe, with Canada, with Japan about how to make sure regulatory management of capital in those countries is appropriate to making sure risk is mitigated going forward around climate change. Have we done that? Have we looked at that? No, we haven't done that. It's a piece of reform work that we need to do. We're not going to be talking to the US in the next couple of years. They're out to lunch somewhere, but everyone else is really keen to actually start engaging around these issues. As investors increase their asset allocation, they need to increase it a few percentage points. India will be a prime beneficiary of that increased appetite for emerging markets. Some of that is education. That's why I mentioned the pipeline work that shall have, every investor I speak to around the world who is already saying they're interested in emerging market debt. We've got some challenges there, but nevertheless, the rhetoric is there. Tell me they can't see the pipeline. Now, if I go into the Ministry of Finance, they will knock their head and say, are you kidding? We've got trillions of things to invest here. Bringing those two things together, promoting the pipeline, which is a makeable pipeline, to those investors is something we can be doing today, tomorrow. I'm actually hoping that the Indian hosting of COP in 2028, which I hope will happen, can be a moment to transform the whole idea of COP from argy-bargy and fighting about brackets and rules to investment promotion for emerging markets climate action. That's really what it needs to be. And we need to bring global investors there to show off the scale of what needs to be done. Because this world only stabilizes its climate and improves the lives of ordinary citizens going forward in the context of climate with massive investments in emerging market infrastructure that will address climate issues. That's a key thing that's got to come out of the COP, and I think India can lead on that in 2028. Many things to be done. I actually think I'm very hopeful because I think all of the things I mentioned are things that we can do to accelerate the capital flows that are needed.
Thanks, Sean. Even Senator, probably when India did host the G20 summit, of course, India showed how it could be done a little differently. I'm sure the same insights can be brought in by India when India hosts the next COP, right? So I'm going to go to Samuel. So Samuel, this is a conundrum, like power, transport, and heavy industry constitute the bulk of India's climate investment need, but essentially these are the places where private capital perceives that they are high risk areas. So what sort of instruments, like either guarantees or blended structures or probably even first loss tranches, have they, which of these has actually demonstrated the highest leverage in shifting private capital to these sectors? And if not, and why is it not happening at scale?
Well, Pradeepji, I'll accept with your statement at the generic level. We all know that private sector investment or capex in the country has been lagging the public sector investment, government sector investment. But when it comes to renewable energy financing, I don't think we have felt the need for either equity or debt. But I'll agree with what Ms. Reina said. The heavy lifting today is being done by the domestic institutions to a very large extent. But the problem is twofold. I also take the point what Mr. Tandon and Mr. Kidney said. There is a pipeline problem also. As a practitioner, I can say, in 23-24, we had bid out 47 gigawatts of projects, which reduced to 40 gigawatts in the previous year, 24-25. And in the first 9 months of this year, that is up to December 25, we have bid out less than 10 gigawatts. So there is a sharp slowdown in the pipeline of projects bid out. There are multiple reasons. It's not just capital. It is the evacuation pipeline which is not there, which is delayed. It is the PSAs which are not getting signed with the DISCOMs, so on and so forth. And again, it is very easy to blame that planning or there is no synchronization between, let's say, the energy generation capacity addition and the transmission evacuation pipeline investments. But if you look at it earlier, in the earlier days, if a 4,000 megawatts power project was to come up, the UMPP coal projects, the implementation period was 4 years. And in that 4-year period, the transmission line also was being set up. But today, a 10 gigawatt project is being set up in 12 months, 18 months from groundbreaking. And within that 18 months, it's impossible for transmission lines to come up. So there is a practical problem why transmission is lagging and which is affecting the supply side of project pipeline also. But having said that, there is also a need to reduce the cost of capital in order to make these projects more viable so that private sector investments, capital flows will happen at scale. Because as of now, whatever pipelines are there, we are able to get both. We are able to see equity and debt. For instance, in my own organization, we are just 2.5, 3 years old. But in the last 2.5 years, only for renewable energy sector, we have done about 1.3 trillion rupees of debt sanctioned. That is almost $15 billion. So domestic capital is not lacking to fund these projects. But the question to be asked is, are we doing at the required scale what is required for India's size and magnitude? I think there is a lot of gap between what is being done and what is required to be done. And that is where getting the blended finance, concessional finance, first loss guarantee structures will help in channelizing more private sector capital into this. And as we speak, while we have been active only in the senior secured debt, as of now, we are working on other structures, including mezzanine, which will have some risk absorption capacities, subordinate debt, which will make the senior lenders more comfortable reduce the cost of capital, so on and so forth.
It's quite interesting, and that's quite a valid point, and I'll tell you why. We have at SEBI, we have a structure for municipal finance, and I'm sure Mr. Pramod Rao here would agree with me on this. When the Mahua started giving guarantees, and recently in the latest budget it has actually gone up. The government guarantees has gone up to almost 100 crores in case you borrow 1,000 crores, if I got it right. That has actually led to municipal companies, municipalities, raising blue and green finance, and that has actually happened because of guarantees also, and probably that portion, so that comfort is actually achieved by the person who is a private capital. So that is actually a valid point. So I'm going to go to Chandni ji, and I would like to ask her, how is the Ministry of Finance negotiating at the global stage to ensure that international climate finance frameworks accommodate this dual mandate of that we have to meet the climate goals as well as developmental goals, and rather than forcing a trade-off. And along with that, maybe ma'am, would you also probably look at giving your thoughts on on how India should probably host the COP?
So, as we've articulated very clearly that we will aim to become net zero by 2070, but prior to that, we have to achieve the Viksit Bharat status by 2047. So the fact that these twin goals exist articulates also the fact that development remains central to our strategy. So energy transition is important, but it is some energy security, growth, employment, they're all equally important, if not more. So that is an articulation we make by in international negotiations, saying that the country circumstances and their pathways have to be defined by the country themselves. And their growth and development is an ask that cannot be denied. And that requires finance to flow into myriad of requirements. There are myriad of requirements, and climate may be something which is important, but then we cannot at any point in time not look at development as a whole. So when we're looking at a climate project, we're also looking at how it impacts development rather than just look at climate just like that. And that's one of the reasons why in our taxonomy also, we have the draft taxonomy talks about adaptation being central, because we realize that no investment is going to help if it is not resilient in the context of changing climate situations. And since we are, the climate commitments across the world have not been very ambitious. In fact, they have been underwhelming, and we probably will experience those temperature increases that we have been saying we should avoid. And so climate impacts are going to be there, and perhaps the first principle for us should be adaptation. And that is also articulated in the economic survey, where we actually say that adaptation is actually closely related to development. So development, it means adaptation as well. And that finds its position in our articulation. What also is important to us when we are articulating as negotiators is the need for quality of climate finance. So the quality is important. It can't come at a market rate, because that will not enable scaling of climate action. There is need for predictability. So while finance may be limited, what is also a bigger problem is that the finance is not even predictable, ex ante. So we need to know what is coming in to be having an idea of what is possible for us to build in terms of pipeline of projects. Pipeline of projects itself requires a cost. There are costs incurred in it. And so there needs to be a predictability of finance, which again brings back to the whole question of the structural problems that we have. And in that, we also talk about the need for de-risking. So these are the prominent aspects that get into our financing issues and into negotiations. Now, you asked me about the COP. For us, I have articulated that finance is key, and finance will have to be, there has to be a mechanism that enables de-risking at scale. There has to be an acceptance that countries will decide the manner in which they want to progress in terms of their climate objectives, and adaptation should get an equally important role, if not more important than mitigation, because mitigation is reduction of emissions now, vis-a-vis adaptation becoming resilience building in future, which should in fact help us get costs, get the cost of capital, lowered as well. So I think that's our articulation, and that is not going to change in COP30. If in the next COP in 2028, if India does host it.
Thank you. Thanks for superbly articulated. Shalabh, I know that, of course, we are also ending in 2 minutes. We don't have much time. So I'm going to give you 1 minute to give this answer to the fact that South Asia's infrastructure is largely unbuilt. So we are going to start from ground one. So why can't we make it green from day one, right? And if so, then are you sort of, whenever you go for certification, go for financing of such infrastructure, do you say that, okay, you start from it being green from day one so that you achieve the dual purpose of funding and achieving the green goals?
Yes, so every investment that IFC does at the concept stage, when the in-principle approval is given, we look at it that whether it is Paris aligned, but not just Paris aligned, but within the country context, whether it's following the path and helping the path towards net zero of the country. So there are many ways in which we do that. The easy ones are obviously the green projects, which are purely green, like renewables, solar, wind. Those are the easy ones, which we do. In the industrial side, the industrial decarbonization, that's the difficult one. There we have our product of sustainability-linked finance. And we have done a number of sustainability-linked loans and even bonds there, where we specify KPIs linked to a certain transition path. Now, I know transition finance definitions, there are a lot of things, but within our own metrics that we have, we move the needle on transition finance when we do this sustainability-linked loan. When we do buildings and we finance buildings, we have our own certification called the EDGE certification for green buildings, which has become quite widely used for all the, whether we give money to financial institutions or whether we give money to builders, we try and request them or ask them or link it with our financing that they follow certain norms. And India also has their green building norms, etc., and they are getting all converged today. Then when it comes to now, what we are trying to do is to Chandni Raina's point on adaptation. It's not happened yet, but we've made a commitment that 50% of our climate finance going forward should ideally be to push the envelope on adaptation. So any project that comes in, we are at least internally within IFC, using our modeling, we are trying to see whether it is a resilient infrastructure, whether there is an adaptation case to be made, and there are 3 types, and I don't want to, in the interest of time, I don't want to get into details. There are type 1, type 2, type 3 adaptation, and we are also getting into training and capacity building for banks and financial institutions to specifically look at climate risk and resilience. So we are looking at the entire architecture to help this.
Thank you. Thanks a lot. So unfortunately, we don't have time for any further questions, but just in 15 seconds, NABFID has big plans for Gift City. We are happy that you are also here. So what are your plans as far as green finance is concerned out of this jurisdiction?
As you're already aware, we are working with you for setting up an AAF, a $500 million fund, which predominantly will be for climate finance. We are looking at other structures also. We'll soon be approaching you.
Okay, thank you. So that's it, ladies and gentlemen. I also had a hat tip from Mr. Pramod Rao on the fact that the incentives that are being given by MOHUA are 100 crore for 1,000 crore issuance by a municipality. We expect more municipalities also to hit the municipal bond market in India. Of course, borrowing from GIFT is a different ball game. Because it involves other formalities. So that's it. I think we have to stop here. It's quite an interesting panel, an interesting subject where we can actually keep talking till the cows come home. But we'll have to stop here. I would like to really thank the panelists, particularly Chandni ji and Sean, for taking time out and joining us over video, and Mr. Shalabh and Mr. Samuel for joining us here on the physically. Thank you so much.
You.
Thank you, madam. Thank you, sir, for joining us virtually. We appreciate it. And I now call upon stage Mr. Sachin Savrikar from Artha Bharat to present the mementos to the moderator and panel. Thank you very much. Thank you. Ladies and gentlemen, continuing our journey for the day, for the next session, I would now like to call upon stage Shri K. Mahipal Reddy, Executive Director, IFSC, for his address on new regulations on pension ecosystem in IFSC. Please welcome him with a grand round of applause. Thank you.
Good afternoon to everyone. I am told that there is no tea break because this is going to be a breaking news itself, as we are going to give a new regulation on the pension ecosystem. And it is not just a breaking news only for the pension ecosystem, it is also breaking news. With this piece, the IFSC is now a complete unified regulator, because all these days one piece was missing. You have banking sector, you have capital market, you have insurance, but pension was missing all these days. Now with this regulations, it is a complete regulator. And that is the uniqueness of a unique regulator. And I'm sure that you might have gone through the details of pension ecosystem already. So it may not be required about a PPT, but it is more of an announcement in this forum. And it is also a break to you, because you have been discussing about capital market, securities market, so much of other topics. But this topic is one of the topics which will be of interest to everyone, whether you are in the banking, whether you are in the insurance, whether you are in the capital market. It permeates all the sectors. And not only to the institutions, but for individuals. As an individual also, we can't ignore pension as a retirement savings, and everyone requires in the day of uncertainty. So it is also of interest to every individual. And the unique feature of the pension ecosystem here, unlike in the domestic, the pension ecosystem is driven by the government pensions, employer pensions, private pensions. But this is unique because it is voluntary pension meant for individuals. And this ecosystem is designed as a robust, innovative system for the individuals, especially the Forex framework, where individuals can take dollar-denominated pension product. And it will be useful for the NRIs, PIOs across the globe. And it so much so that we know that the inward remittances from abroad is almost 3.5% of GDP. And in that, I think the inflows from US is 25% of it. And from UAE, it is 18%. UK, 7%. And from Singapore, it is 6%. Even if it is small percentage of this is tapped as a pension, it is going to create a big fund. And those who are already here in different verticals and their group companies with the experience of handling the pension, handling the funds, they can be the first mover and they can take the early bird advantage by becoming a pension fund. And you know the background of this, and my colleague Mr. Praveen Trivedi has laid a foundation for this pension ecosystem, and moreover he is also experienced person having worked with PFRDA, and there was an expert committee on the pension ecosystem to how to develop the pension products in IFSC. So post that they have identified in order to bring regulations, first of all the legal framework has to be very clear. So in accordance with that, the government has notified that any scheme operated by pension fund is a financial product. So this notification was given by the Government of India in December 24. Post that again, there was another limitation to go ahead with the regulation. That was Section 25 of PFRDA Act, which limits the investments have to be domestically placed. But however, in IFSC being international jurisdiction, the investment have to be outside. So accordingly, again, we have to go back to the government, ask the government to give a carve-out under PFRDA Act. So accordingly, on 1st October 2025, notification was given by government exempting IFSC from Section 25 of PFRDA Act. So post that, we have moved to formulate the regulations, and we have come to the fag end of notifying. I am sure that my colleague, again, it went back to Mr. Praveen Trivedi for the notification. I hope there may not be a significant changes from what we are going to discuss here. So I will be constrained to give PPT also because, again, the notification is due and it is in his hand. And if any of the feature is different from what is going to be notified, we may have to see that. So we will be taking indicatively about the PPT. It may not be of so much significant, but notification is just a few weeks time. And I am sure with that we will be a complete regulator to call as a unified regulator. All these days it was only a triangle. Now fourth pillar is being built. Now in democracy, fourth pillar is like media. I am sure the fourth pillar like pension will also act very strong like a fourth pillar of democracy, a fourth pillar of financial ecosystem. So with that, I think we'll just go through the important features. So this is the architecture which is designed for the pension fund. Pension fund, there is pension scheme, there is individual subscriber, and there is trustee and custodian. And this is the broad architecture for the pension ecosystem here. The core objective is to a robust framework for long-term retirement savings, promote a secure, transparent environment for subscribers, maintain integrity of pension ecosystem, and regulate the pension funds, trustees, and custodians. So this is just eligibility criteria for the pension funds. The net worth is only just a minimum, but however, there is a screening on experience of the prospective pension fund. So we have put 10 years of experience in pension, retail fund. And you know that we are late, but we are latest because we have included banks also as sponsors. Recently, you know that PFRDA has permitted banks also as sponsors. So accordingly, maybe it is proved that by being late, we have included banks also as a pension fund. And there is, as usual, fit and proper requirements, which is applicable for other regulations. These are the investment choice. I will not go into the details. You have active choice and auto choice broadly. And the operational features, as it is said, it is voluntary. And any individual above 18 years is eligible. And you know who are the individuals who are mostly eligible? NRIs, PIOs, foreign expatriates, Indian residents through LRS route. Maybe that is the last one, so that we don't conflict much with the domestic pension funds, but is a big opportunity for the global pension funds. So there is a portability option that is within the pension funds within IFSCA. We will not talk about interoperability because interoperability requires intervention from the government. However, we will be taking up with the government later how it can be interoperable between the funds abroad. And it may also require totalization agreements, which is also a big task for the government. But whenever any inputs are asked about trade agreements between two countries, I am sure that as a stakeholder, you must give comments about this also, so that we can push. We have to build a push for the government to bring out totalization agreements. Some of the governments may not be willing to enter into it. It is not so easy because nobody wanted to see that their pie goes out. They have their own constraints. But however, I think it is only through push we can make this possible. And that trust structure, each scheme constitutes a trust. A scheme information document must be filed and it will be approved by IFSCA. So these are the options, like partial withdrawal is possible after 5 years. Maybe the percentage we will not talk, but again, final notification we will have to see. And there is a minimum 10 years contribution, and there are options of SWP, and there is a minimum 20% corpus must be used for SWP. So this is a mandatory usage. And this is a value addition. Like maximum 10% of total contribution is the cap. The investment can be low risk, liquid instruments. And there is one add-on benefit like health benefit. Maybe most of the pensions do not offer it. We have come out with the concept of add-on health benefit. There will be a separate fund earmarked for the health, maybe in the extreme medical exigencies, critical illness. A subscriber can withdraw the fund from the health add-on cover. Maybe you might have observed after we have brought this public consultation, recently PFRDA has come out with a circular in January bringing the health option, and it has come in news that they have put in a sandbox environment. So that is the effect of reverse effect from IFSCA to the domestic regulators. So these are the broad investment principles. You know, the investment options have to be very conservative, and the details are in the document, which we will not display here because again, final notification, subjected to final notification. So the risk management features are this enterprise-wide framework will be there. And stress testing will also be one of the features. These are the roles and responsibilities of trustee. They have to ensure assets are held for the benefit of subscribers, monitor strict compliance, prioritize the subscriber's interest, exercise due diligence, skill, and prudence. So these are the brief features of these regulations which will be notified shortly. And with this, I think we can announce that we are the complete regulator, unified regulator. And I'm sure that those who are already into the asset management, fund management, they can think of to become pension fund also. One more license to be here. And you will have a complementary opportunity here if you are here, because the ecosystem has well developed. Capital market will be supporting it. And they are in fact waiting every time whenever they are going for any discussions with government or foreign entities, they keep asking about inputs from the pension. But without having regulations, we are also constrained to give inputs. But now I think all regulations are open. Now it is open for any discussions with the government bodies, with any pension fund managers outside India. And I am sure that it will generate a lot of interest. This being one of the long-term saving, not only helps the individuals, but institutional investors, economy as a whole, and not only India, but even the global regional hubs. So with this, I wish that the pension fund regulations will be taken forward, and I'm sure that you will spread the awareness about this and see that IFSCA will emerge as another pension fund hub. Thank you.
Thank you very much, sir, for explaining the new regulations on pension ecosystem in IFSC so well. And I now request Ms. Gunjan Mirani from India ICC to present Sri Maipal, sir, with a memento. Thank you. Thank you very much, sir. Madam, thank you. Coming on to our next address, I would like to invite Shri Vijay Krishnamurthy, MD and CEO, India INX. Welcome, sir.
A very good afternoon. Respected regulators, industry stalwarts, and my dear friends. Gives me immense pleasure to be on this platform once again in its new avatar of 2.0. And what a response. Mind-blowing. Last year, I'm sure IFSCA would have really highlighted this, and Pradeep sir would have really highlighted this. But it's been mind-blowing. The kind of feedback that I've been receiving since yesterday is amazing. The kind of panelists, the speakers, the topics, the issues, the relevant things that has been discussed has been the highlight of this entire GSMC 2.0. So really, I think so, this deserves a big round of applause. So, and because of this concept, we at IFSC are able to showcase and able to do a lot more under the aegis of a very progressive and a supportive regulator. Today, what I would like to do is, last year we really spoke about what India INX does and, a lot of these stuff, because I think so we wanted to tell people we are there as an exchange, as an international exchange, as part of IFSC, and these are the various products that we have. And I think so now, in a lot of these sessions, we have well proliferated ourselves and created an identity for ourselves as also being a BSE company. So today I just want to leave some thought processes of some numbers that we have done. And also so the idea is to actually tell you all what we want to do. Right, what are the areas that we want to really focus on, and how we want to grow this ecosystem at IFSC, right? And I very strongly believe from day one, unless the ecosystem grows, none of the organizations here can grow, because we are all here to be supportive of each other and make this growth possible. So be it the banking unit, be it the insurance, be it now, there's a new pension fund that's the regulations are going to come out, or the broking community, the depository. So I think so we need to work as a cohesive unit to really make this happen. And I'm very confident and very sure that, we are on the right path to do that. So it's more on partnership that, as I would like to really speak on and build on. Some business highlights. Just wanted to leave. I think so as exchange and especially India INX, we have been putting a great thing from a debt listing perspective, and we continue to do that. We have 166 unique debt listings. that has taken place. We are happy also to share that some of the new kind of instruments we were able to list, like fully that is FCCB, right? A foreign currency convertible bond. So we were able to get such kind of bonds also to be listed at IFSC and at India INX. So we are happy that we're making getting new instruments to come to IFSC to get listed. And again, with great support from the regulatory team, wherein they have been also quite appreciative of some of these new instruments coming here, and also being able to make some changes to the listing regulation. So that's something that we've been doing. Would also like to state that one of the big Indian issuers was away last year when they raised capital at IFSC. Right, they went to Afrinex to get themselves listed because few regulations were made, which so happy to state that this year we've been able to get back Exim Bank onto IFSC exchange to get themselves listed here, and so it's a big achievement, I would say, because they are a very big issuer, they're a very big name, and they coming back to IFSC exchange to get themselves listed is a very big thing, and I'm happy that India INX took that initiative to get them back here, and I'm very happy, and I really want to congratulate my team for really taking that entire effort to do that. Right? We also had some of the green issuers like Renew come here who listed on IFSC as an exchange. I also would like to touch upon a couple of other things. So green bonds, I think, so we spoke about climate bonds. Green is again a very important topic, and sustainability and all of these things. So we are seeing some traction there. So Renew came, we may have another Sri Lankan bank who may come with a blue bond somewhere, maybe sooner then later he will come onto IFSC to list. So I think so, it augurs well from an listing perspective. Also, I would like to state that the first equity is going to soon get listed here, right, on both the exchanges at IFSC. Yesterday I've been told that I think so they are planning to open somewhere in March 6th, if I'm not wrong, is the date that was told to me, but I'm not very sure on that date. So as people in IFSC, it's a humble request from IFSC itself, and being a unit of IFSC, it's very important that this listing becomes a success, because based on this, there are many other who are waiting to get themselves come here and get themselves listed. So it's very important as a collective unit, as GIFT IFSC, it's very important that we all of us together, the broking community who will be reaching out to the NRI. So I think so, we have created all the possible uploads, apps, APIs, so that there is an easy connectivity for people to come and, invest or, apply for these applications. So all of these things have been done. The ease has been done. The apps and everything is available for testing outside. So please do the testing. Please proliferate it, and let's make this IPO a big success. So XCD is the company who would be coming there, and EdTech. So I think so March 1st week, March 6th was a date that was told. So please help in making this a huge success. It's very important for IFSC. Sensex we launched last year, right? And happy to state that without So typically what happens is, as an exchange, you try and pay incentive to get trades happen, right? And I'm happy to state that last year we didn't do that. We wanted to see where is the actual volumes coming from. Are there actual volumes, or do I need to really pay to get volumes? It has been slow, but it has been steady. I know the numbers are nowhere as compared to the other exchange at IFSC, but we are growing. The happy part is, there is one more product that is coming to IFSC for participants to come and participate. Because when I go and speak outside to a lot of people to get brokers here, they said, what products do you have at IFSC? There's only one product. There's only two products. What are the products for me to really come there and set up a shop here? But happy to state that I think so we will be growing Sensex, and there will be a lot of focus to do that. There are many ways that we are trying to do that, and we are sure we'll achieve that, right? We will make that happen, so that there are multiple products for people to come here in IFSC and do the transactions. So that is the aim, that give as many products as possible, so that we attract people from from various jurisdictions to come and trade at IFSC. So that is the aim that we are working for, right? I also wanted to touch upon GAP, which is a global access provider. Licenses or the regulations came in August of 2025, 11th or 12th August to be precise. We have been in this business as India INX and a subsidiary of India INX GA since 2018. We are now an official GAP license holder, and we are growing in that space as well, right? And as per the regulations, it's only the exchange-based GAP subsidiaries are allowed to provide the unlisted products as well. So we are working on that so that we are able to give a vast range of products, global products, to the Indian issuers, and also, it can also attract NRIs to IFSC to come and do these transactions. So that's another area that we are very closely and, aggressively working on. Also, the Luxembourg team was here, and the finance minister was here. Happy to share that, there is an MOU that's signed with the Luxembourg Stock Exchange sometime back. Of course, it's not something that it's done during my tenure, but Bala sir is here, and it was done during it. But India INX has an tie-up with Luxembourg Stock Exchange for putting up their, any green bonds here, which will be available on the SOL list there. So that's another thing, just wanted to highlight and point out. Wanted to speak a little bit about GAP because that's been a lot of queries and a lot of buzz which is happening around in the Indian markets as well, where people are trying to diversify, right? Of course, because people are looking for avenues for diversification, for growth, and where they want to see where, want to put their money where their, mouth is. So, very clearly, it's a very good way to diversify your holdings. We have tied up with some of the, big international brokers, and we are been in this space for a very long time. The digital onboarding journey has been far more easier now. We have launched mobile apps. We are also tying up with various other global partners to see how we can help you all give this. Also the aim is to see how we can proliferate a lot more on this with the Indian issuers, and there's been a lot of interest even from back home from the Indian broking community. Why this product? Honestly speaking, it is our strength. Back home we have almost 22 crores of UCC holders. They are looking to diversify. There are Indian brokers, which is our strength, which is there in IFSC. So what is a product that can be at least initiated and given to them? So I think so GA is a good platform for that, and where people can diversify and go global and invest in global securities market. And the best way is to come through an exchange and an exchange subsidiary, because again we are highly regulated entities. So that's another area where we wanted to just speak about. As I said, I had already mentioned 3 areas where clearly we are going to focus this year is Sensex. I already spoke. It is our flagship product, a product which has been there for a very long time, and it is really doing well domestically, and there is an India growth story. So there is a lot of interest and attention that it receives globally. It is just that how do we want to really proliferate? And I think so yesterday the former IFSC chairman, Mr. Injeti Srinivas, did make a very interesting comment that he started this as an experiment in GIFT IFSC. Right? What did he start? He started this GIFT Nifty Connect with SGX as an experiment to see how they could get the liquidity from there to here. And that has actually phenomenally worked well. Right? So for us also to gain far more liquidity into this space, into IFSC, right? That is going to be our endeavor to see if we could get some kind of an exchange connect going, so that, as I earlier said, there are multiple products for people to come and trade, right? Because even if you look at the domestic market, there are 2 active indices that on which derivatives are trading. So the more the products, the better it is for the market, the better it is for the participants to really do their trading, and really, the activity is a lot more. So that's going to be really our focus and really our aim to see how we could get this liquidity into this product, and many other products that the market wants. We'll be happy to launch. The third area, which is again going to be very important, is mutual funds and ETFs, right? There has been a buzz of GIFT AMCs, which are typically Indian AMCs who are coming and wanting to launch mutual funds here, retail schemes here. So that is another way to say that to NRIs to say that, okay, you can, the retail segment of the NRIs to say that, okay, why don't you come and invest in the mutual fund units, right? Because that's a far easier route for them to do that on the retail segment. So that is something that our focus is going to be this year for mutual funds as well as ETFs. So we are also trying to see if there are any global AMCs who would be interested to come to this space, to offer their products here. So that that's another a good attraction for people to really look at and invest. So these are some of the things that possibly I just wanted to leave behind as going to be our focus area, and happy to hear from anybody in terms of if there is anything interesting as an exchange that we can do that will help the entire ecosystem grow. Would be really happy to do. And also wanted to make a couple of quick announcements during this during my address. So firstly, I would like to invite the HSBC team onto the stage. If Ashish Kumar Tripathi can please come up, who is the CEO of HSBC Gift IFSC Banking Unit, and Shaibal, are you here? Yeah, hi Shaibal. So Shaibal heads the wealth management space. So I would also want to have Ritesh Varshney on the stage. He is our head of BDM. So as I had said, GAP is going to be one of our key initiatives, because that's going to be. So what we are doing is, and actually, how did this stem? Let me just take you a few seconds back. October 2024, if I'm not wrong, RBI did come out with a notification saying that Indian resident investors can open bank accounts in IBU, and they can keep the money here for 180 days as compared to 15 days. Right, so that struck the idea, saying that what is it that we can do along with banks and with wealth companies. So this is something that came as a thought to me, saying that they can really, reach out to their already existing Indian clients to say that why don't you open a bank account here, keep the money here. So it's a business for the IBU, and what can they offer? So through the GAP route, they can offer global securities market to their clients. So it's an additional kind of an portfolio offering for their end clients, and at the same time, it's a new segment of business for the banks here. So I'm happy to share that we are signing an referral agreement today with HSBC in this forum, and I would like really to get that going. And Shaibal, Ashish, if you just want to add a couple of words on that.
Thanks, Vijay. Good afternoon, ladies and gentlemen, esteemed regulators. This is quite a pivotal moment for HSBC. As a global institution, our ambition really is to connect our clients to global opportunities, and we realize that when you would want to globalize, you need to have an ecosystem which really enables this to happen. We are very grateful to the GIFT Authority and of course IFSCA for enabling this to happen inside GIFT City. Our capabilities and our partnership with the INX would enable our customers to access global markets, a need that I think all of us as investors are increasingly realizing. You will obviously get to see and hear far more about us and what we are doing in IFSC, along with other partners as well. We really appreciate and thank you for making time and being here this afternoon. Thank you.
Thank you so much, and congratulations to all of us here. Right, I have another announcement to make. May I have? Yeah, okay. I would also like to announce and call Mr. Chiranjeev Kumar on the stage. He is the General Manager and Regional Head South Asia for State Bank of India. So this is an initiative that we did with State Bank of India sometime mid of last year. But pending some approvals, we didn't make a formal announcement. But I think so it all waited for this moment at GSMC where all of things aligned and we were able to make this announcement. I would like to invite Shri Chiranjeev Kumar to say a few words on this. Sir.
Good afternoon, everyone. I'm thankful to Vijay, though we have entered the agreement some time back. So there are some procedural clearances that to be taken. And we are the oldest unit, almost, we have set up our IBU in 2016, 10 years old unit. And we are having many queries for the broadening the investor base. So we thought it to collaborate. That is the real way to provide more than banking services to our offerings to the clients. So we have collaborated, rather we have started passing on the leads also. And I will be seeking BSC team and their business development team to collaborate with my business development team to take it further. And it's not in the vision of the banking business to say, but the IFSC itself wanted to have the broaden the base to the Indian diaspora as well as the wealth management product. So within wealth management product, we have certain banking products only, but everybody is interested in securities, and we didn't find better opportunity to collaborate and just make a strategic partners with BSC at this point of time. Thank you very much, Vijay.
So with that, I think so this was a small bit that I just wanted to share. And thank you IFSC, thank you GSMC 2.0 for providing us this platform to make such announcements so that the reach is far and wide. Thank you so much. Thank you one and all. And all the best for all of us, and looking forward to the next year as well. Thank you.
Thank you very much, Mr. Vijay, and we are wishing you good luck as well. And I now request Shri Arjun Prasad, General Manager, IFSC, to present Shri Vijay Krishnamurthy with a memento. Welcome, sir. Thank you, gentlemen. We have the next address from Shri V. Balasubramaniam, MD and CEO, NSE International Exchange. Please help me welcome Shri V. Balasubramaniam, sir, on the stage. Welcome, sir.
Namaskar. Good afternoon to all the people here. And I can see Pramod Raoji, our directors, Mr. Suresh Menon, my colleagues in the Clearing Corporation, Neeraj, and NSE ICC Chairman, Sri Kumar. And of course, all the regulators here, the senior regulators, I can see Praveen and Maipal. First of all, hearty congratulations on the new pension fund regulations. Thank you for giving us this opportunity. I was there last year, also speaking in the GSMC 1. And at that time, the topic was innovate, integrate, and infrastructure. These were basically the three themes which we talked about in terms of what we need to do in the IFSC ecosystem. And I think what I'm going to do is, of course, Vijay did cover most of the aspects, but as everybody knows, NSE International Exchange is the leading exchange, and we actually trade more than 99% of the market here at this point of time. But having said that, since last year, I will just say where the focus has been. We have actually really progressed well on the capital formation side, because on the risk management, we are already kind of pretty large. So what we are trying to do this year is, we actually focused a lot in terms of how we can enable companies not only from India but also companies from abroad to actually come into GIFT and make truly GIFT a international financial ecosystem. And that's one of the big drivers which we had. And I'm happy to state that this year actually till December 31, 2025, we actually had incremental 88% market share on that business as well. So that's again something which we are focusing and doubling down on. Of course, one of the things which still remains to be done, I think Mr. Pramod Rao is there as part of the primary market standing committee. About a couple of years back, Honorable FM had said that Indian companies should be able to do direct listing on the IFSC exchanges also. And I think there was a working group which was also set up, and we contributed quite a lot in terms of the efforts there. But it's still waiting for the final operating guidelines to be issued by SEBI, which hopefully once it starts, I think there could be a lot more companies which could really look at using the IFSC ecosystem and the stock exchanges to list. And one of the things which we have done very consciously over this whole year is build a lot of connects across the world. We are now actually connected with most of the investors who are looking at cross-border investing and clearly are looking at GIFT IFSC exchanges also as a venue where companies want to raise money. Lots of tie-ups which we have done strategically also. One of the things which we have done to attract more issuers to come and tap the IFSC ecosystem is we have signed MOUs with large NBFC bodies like FIDC. We also done it with microfinancial institutions like Sadhan. So these were some of the important things which we did. And today morning, I think Praveen highlighted the importance of consumer awareness or investor awareness per se. And we have actually done a lot of industrial level tie-ups, starting with the Institute of Chartered Accountants of India when we announced the MOU, where actually now we are engaging very actively with all the international chapters, because effectively they become the brand ambassadors from whichever global region to actually bring investments back to our country through the GIFT IFSC ecosystem. But broadly, let me just ruminate, because I've been in this ecosystem for almost 10 years. And I have seen the journey from virtually a barren land to where we are standing at this point of time. And every year we are progressing pretty well. In fact, today morning also some of the people who are my friends who visited GIFT after 3 or 4 years, they said that they can see a remarkable change in the infrastructure and the ecosystem here. And in fact, yesterday when some people were in my office, I got a nice view to see a lot of part of GIFT. And they actually said that they could count the number of cars parked here as actually a great progress in terms of the number of job opportunities getting created. So that was again something very heartening. And I think today also in the earlier panel, they said that any growth in an ecosystem has to be accompanied by creating more jobs. And I think that is something which is very clearly the focus of the policymakers, including the Department of Economic Affairs, when it actually looked at the IFSC ecosystem. But broadly, when Honorable PM Modi ji actually inaugurated the first exchange in 2017, we were witness to that. And he actually left 2 messages for us. He said in the next 10 years, I think we should become a price setter of some products, if not all. But he said that that is something which we should achieve. And I think we are very proud that today GIFT Nifty, which is our flagship product, actually sets the price in terms of the equity benchmark. And over the last year, we also seen hearteningly that on the off-market hours when India doesn't trade, there is a lot of interest in terms of volumes which have come up. And last year has been also an event full of disruptions. And to that extent, GIFT Nifty has become more popular and more relevant and more important. In terms of some numbers which I will just say, just last week we achieved a record volume on a single day. Our total volume was about $23.48 billion. Our open interest also, on an average, is about $15 to $16 billion, but we touched the peak record of about $21 billion. For this, I think I will also like to thank our partners, SGX, who have been part of this initiative, because that was the first connect which was established. And obviously that will be not the only one, and we are looking at more connects going forward. And yesterday we had quite a few interesting announcements which we made on NSEIX. We actually signed an MOU with Cyprus Stock Exchange when the PM visited there. And Cyprus is a global gateway into Europe in some sense, and this year we have signed this monumental mother of all deals of the FTA with the EU. And in some sense, a lot of foreign investments do come through Cyprus into India. And what we are trying to do is we are trying to now create a bridge between both these countries into Europe. And we are getting probably the first company from Cyprus which will also do a list onto us. So that becomes the first foreign equity listing which is going to happen on us. This year again has been very interesting because you don't become overnight a global financial center. What you probably first become is a regional financial center. And I think we have been focusing a lot on the BIMSTEC part of it. And today probably will be very monumental because we have my colleagues from Colombo Stock Exchange here. We are going to sign an MOU with them today. But more importantly, what we have been doing is we have been actually doing a lot of roadshows in Sri Lanka over the last 1 year. And last year we got the first international issuer who did a green bond on us. And today we are very happy to announce that we just got the first blue bond also to be listed on NSE-IX. So, in fact, I'm told this is Asia's first blue bond. So I'm not too sure about that, but if that is there, that I think is another feather to gift IFSC ecosystem's cap. And obviously, this would all not have been possible without the support which we get from our regulators, IFSCA, and especially Pradeep and Praveen and Arjun and the entire team from IFSC. So we are really thankful for them to support all these kind of initiatives. Apart from this, I think broadly when I talk about what NSE-IX stands for, we are actually a market infrastructure institution. That is how we are defined. And we are an infrastructure, and today in the morning panel, they said that these brands which are the exchanges are going to be there in 2047, despite all the disruptions which you are going to see. The technology may change, and obviously, I've been pushing my team. In fact, at NSE-IX, now we have grown to a good healthy 70 people, and with the clearing corporation, we are 100 plus people. And we have indirect staff of about 50, 60 people. So that makes us one of the largest institutions which is providing job opportunities within the gift city. And one of the things which I've been doing is we have been continuously training the younger team. Today, as part of our induction program, we make sure that people are getting exposed to usage of AI, and that is something which we are now incorporated in our day-to-day life. And that's something which is basically strengthening the kind of human capital we have, because tomorrow human capital will probably be getting out of mundane chores, and for that they will be delegating it to a machine. I look at AI more like earlier people used to clean things themselves or wash dishes themselves. Today there are vacuum cleaners, and now there are bots which go and clean, and there are actually dishwashers which actually do those chores. So in some sense, human capital will still have to kind of evolve, and that dynamism has to be there. But AI is going to really simplify things, make it a lot more productive, a lot more easy, and that is something which we are clearly embracing. Another thing which we are also doing in terms of resilience on technology, because end of the day, we are nothing but an applied technology company or a fintech in the original avatar. And what we have done is we have taken NSE stack, a tech stack, which is I think one of the largest globally in terms of the number of transactions it can handle, because they handle close to 20 billion orders a single day. I'm also happy to announce that we have actually done peak volumes of more than about 50 to 60 million orders in a single day. And another big initiative which we did, which to fully comply with the regulations from our regulator, is that we have created the near DR site. We have a DR site which is in a different seismic zone, but we also put in a near DR site which basically ensures that there is zero data loss. So that again is a big infrastructure investment which we made this year that also shows our commitment as far as the GIFT IFSC is concerned. This year, two more things we have done structurally. As an exchange, as a group in NSE, we thought how we should actually look at basically making NSE go more international. And one of the things which NSE did was they infused more money into us. And with that, what we did is we aligned the NSE International Clearing Corporation into our fold. So effectively now they have become our wholly owned subsidiary. So effectively NSE-IX and NSE-ICC today now are in some sense partners in progress. We are building the whole ecosystem together. And Neeraj, my colleague, we always say that the exchange and CC are joined at the hips, and that is what we are, and that is what we really symbolize. Another initiative which I think Vijay did mention, which I started in 2018, which was the Global Access. But interestingly, this year, finally, in 2024, August, I worked closely with the IFSC team, and we finally got the GAP regulations out. Post that, we have now started the NSE International Exchange Global Access. In fact, we were the first GAP license holder from IFSC. But as usual, whatever we do, we want to do it well. So we didn't want to do any launch for symbolism. What we have really done is, we just did a soft launch with the colliding with the GSMC yesterday. And I will request all of you to visit our stalls here, where we are actually showing what this solution is capable of. This is something which is basically, again, standing with our vision, because when we talked about a vision of NSE-IX, we want to be a financial gateway, truly a financial global gateway, to enable both inbound investments as well as outbound investments. So the outbound story is now something which the global access is going to really amplify. And what we are doing is we are actually deploying cutting edge technology. We are virtually becoming like a new age broker, which is like basically something like what Robinhood does in US or what Zerodha did in India, and there are many more which are there. So what we are actually doing is we are enabling that anybody could in 30 seconds flat do a video KYC from wherever they are, and they could actually just use our gateway to trade on international markets. This is exactly what we did when internet trading and mobile trading happened in NSE, and NSE became an early adopter of the technology, and today we see that these kind of things are pretty large. And in fact, just yesterday we opened the soft launch, and I'm told by my team that already 2,000 clients have already enrolled in a single day. So this is again something which we definitely look forward to make it big. And as envisaged in the regulation, we will obviously be wanting more and more partners and distributors, both from India and abroad. We want all the banks, all the broker-dealers, all the mutual fund wealth distributors in India also to come and join NSE-IX GA as our referral partners, because it will effectively, in some sense, give them another model, because today they do a lot of mutual fund distribution, they do insurance distribution. Now they can actually do global investment distribution to Indians. And I think it's the right time, because today India is becoming more affluent, and as we move towards Viksit Bharat, where we want to become probably a middle income kind of a country, and by 2047 become a truly a developed nation. I think this is another kind of diversification which Indian investors need. And this is again something which we are going to cater to as a solution from the NSE group. Lastly, I would like to definitely thank all the member fraternity, the stockbrokers. Today there are 90 odd stockbrokers, almost most of them are connected with NSE-IX, and their contribution, if I don't recognize today, I will just express my gratitude to them that they have continued to use NSE-IX platform to trade on it. And obviously, going forward in the new year, we see a pipeline of more investors thanks to SEBI, which has also come up with good guidelines in this year, where they allowed Indian brokers now to set up separate business units, and they can actually set up a branch, so they don't need to actually set up another legal structure. So I would like to thank SEBI also for helping us in this cause, because this is something which was a little bit of a old demand, because this was allowed to all other intermediaries, but this obviously will also facilitate more players to come. That again is another big step. And with this, probably I will be happy if there are any questions, we'll be happy to take. But I will also request to announce, I will also like to acknowledge XCD, because they have been the first IPO. In fact, I remember that when we had the SME listing about 10-12 years back in India, it was the same story. We had to first get the first one as a poster boy and as a basically a first test transaction. And I'm sure that now XCD has worked quite closely with us. They have chosen NSE-IX as the designated exchange, and we have provided our team from the listing compliance side as well as the listing operations side have really cooperated with them, and we are very happy that they are going to now look at opening their issue in probably a very short while. March 6th, which is what Vijay said, probably whatever is the date, but I wish them all the very best, and I think that transaction is going to be a path breaker. But having said that, we are definitely in touch with a lot more companies worldwide. We have been putting in a lot of efforts in terms of doing it. And thirdly, I will also request banks, because we have been seeing that there are some things where, for example, LRS is still actually difficult for Indians to look at doing. And through our Global Access Gateway, I will like to partner with them to make sure that the remittance cost and the cross-border remittance cost is also crunched. And in global access, I can give one commitment to all the Indian customers. We know that Indian customers want the best of service, but they want it at the lowest cost. And I can assure you that NSE International Exchange Global Access Platform will provide both of this world-class service at the lowest possible cost. You will actually not hear these kind of costs for trading on the international markets. And in phase 2, we'll also cover institutional customers from India, and in GIFT both, where we'll offer them custody options to make sure that even institutional investors who want to invest into global markets could use our global access platform. Thank you very much. And probably I will request Ethel to join me on stage, and also invite my friends and colleagues from Colombo Stock Exchange to come on the stage, please. Thank you.
Yeah, that's fine. We can hand it over later. Please, you're welcome. I welcome the Colombo Stock Exchange, led by Mr. Khosla Gemich, to kindly come on the stage for the MOU exchange. Many congratulations. Thank you. And before that, I would request for the memento presentation to Mr. Bala sir. I call upon stage Chetan Shah, EVP and Head Capital Market, Global Securities and... Yes. You will do afterwards? Okay, fine. We shall welcome Mr. Khosla Gemich to kindly say a few words.
Good afternoon, distinguished ladies and gentlemen. Today marks a significant milestone, not only for the Colombo Stock Exchange and not only for NSE International Exchange, but for the future of regional capital market collaboration. This memorandum of understanding is more than a formal agreement. It represents strategic intent, it reflects shared vision, and it demonstrates what becomes possible when two exchanges align with purpose, clarity, and mutual respect. At its core, this partnership is focused, practical, and forward-looking. It enables dual and cross-listings, expanding issuer visibility and broadening investor access. And importantly, it provides the flexibility to collaborate in any other mutually agreed areas, subject, of course, to regulatory approvals. The principles guiding this MOU are equally important. Both parties commit to working in good faith to achieve its objective. And companies incorporated or operating in Sri Lanka seeking a listing on NSE IX will be dual listed on both exchanges, reinforcing transparency, regulatory alignment, and above all, investor confidence. We are already witnessing early success. DFCC Bank PLC has completed 2 dual listings, the first following its inaugural green bond issuance, and the second being the blue bond listed today on NSE IX. This demonstrates that our collaboration is not theoretical. It is operational, it is progressive, and it is delivering tangible outcome. The Colombo Stock Exchange remains fully supportive of our listed entities seeking greater visibility, enhanced exposure, and broad access to capital through platforms such as Gift City India. At this juncture, I wish to express our sincere appreciation to the distinguished dignitaries present with us today. Mr. Pradeep Ramakrishnan, Executive Director, IFSCA, Mr. K. Kumar, Chairman, NSE. Thank you, sir. Mr. Balasubramaniam, Managing Director, NSE IX. Ms. Hetal Katak, Head of Listings. Thank you. Your leadership, cooperation, and commitment have been instrumental in bringing this partnership to fruition. This collaboration also reflects the strong and enduring relationship between India and Sri Lanka. We are confident that today's agreement will serve as a foundation for many more developments to come, further strengthening financial connectivity between our two nations. On that note, I wish you all a productive and successful day, successful afternoon. Thank you. Thank you very much.
Thank you very much, and we also wish good luck to all of you. I request Mr. Chetan Shah, EV and Head Capital Market Global Securities and Services and Capital Account Axis Bank Limited to kindly present the memento. Yeah. Yes. Sir, would request you to present the memento to Shri V. Bala sir as well. Chetan sir. Thank you. Thank you, sir. Now we have an important announcement to make. No, it's not about lunch, it's about something else. The first IPO in GIFT IFSC is expected next month. May I call upon stage Mr. John Khalil, founder, CEO, XCD, Executive Development, and investment bankers on stage. Welcome, sir. And I request him to kindly address the gathering. Yes, you're all welcome. I know it was not an announcement of lunch, but we can still applaud for the IPO coming up. Thank you.
So I'm coming between you and lunch, so I'm going to make it interesting, okay? So two things, couple of things, four things. One, I just landed a couple of days from New York City, so the tired look on my face is because of that. So please excuse me there. And two, I just want to share a specific incident that happened to us a while ago. So I'm based out of New York City. I work out of our New York City office. And the team from Gift City came over to New York City. And we were impressed with how welcoming they were. They threw open the red carpet. They had infra in place, systems in place. There was a promise of great success. And today we stand because they delivered on their promise. So thank you, the entire team, for making this possible. This is a landmark event for all of us at XCD. We have our university partners, Oxford, Cornell, Michigan Ross, Carnegie Mellon, our customers from around the globe, right from Tokyo to Cape Town to New Jersey. We have participants from all over the world. We are excited to be part of this journey. Three, we also want to thank our partners, the exchanges. Bala, I don't know whether you remember this. A while ago, we were walking in the streets of Manhattan, and this is the first time I'm meeting you here in India. But thank you again for all the support, NSE, BSE, for the journey that we have gone through. Phenomenal it was. And today we are here. This is the proof of the pudding for the launch of the IPO. With that, I also want to thank our merchant bankers, Global Horizon. Piyush is standing out there, our co-founder and CFO. With that, I want to announce the launch of the IPO. We are open from March 6th to March 18th. We look forward to your support. Look upon us. We are an exciting new venture. We are in 5 countries. We have been doing programs all over the world, and we have brought it home back in India. Thank you again. See you at lunch.
Congratulations. So we have the next event of IPO launch. That is next month. So we'll see you there. But before parting for the lunch, a humble request. Kindly use completely the water bottle. Don't use it half. This is Dhwani asking you to come back sharp at 2 after the lunch. Enjoy your meals, guys. Thank you. पूरी गई भैंस पानी में. Good afternoon, guys. Thank you. We had nice lunch. We've been sitting in the AC hall of Gift City Club and whatnot. So for that, we would like to thank our sponsors. Our diamond sponsors are Appreciate Broking, Artha Bharat Investment Managers, Interactive Brokers, and View Trade. This was for diamond. Our gold sponsors are Axis Bank and World Gold Council. Our platinum sponsors are PwC and Alpaca. And our silver sponsors are Gino Moneta International IFSC Private Limited. Thank you, sponsors. You have a big heart. Always do that. Thank you. So now, as we are back, I'm glad only these many people are inside because we're moving to one of the very lovely and exciting session, which is the quiz. And we want to give away some goodies. So jitne log kam ho, utna zyada hai, aapka chance zyada lagta hai. So, ladies and gentlemen, please help me welcome Shri Praveen Kamath, General Manager IFSC, to run this small quiz. But obviously, whenever you get a gift and a goodie, you have a smile on your face. So best of luck for that. Thank you.
Hi. It's always tough to conduct a session post-lunch, especially when the lunch is very sumptuous. So just to get the audience engaged and keep you awake post-lunch, we have planned a quiz. Since this is a capital markets conclave, we have a set of questions which are related to the capital markets. So I'll start with the questions one by one. There is a prize for each correct answer. So we have volunteers here who will be coming and handing out the prize. It's a nice piece of chocolate. So here we go. First question. We all talk about listing, right? My colleague Arjun is working on listing regulations and working very hard to get. Yeah. So my colleague Arjun is working very hard to get the listing regulations executed and get the first company to be listed here. Markets. So the first question is, which was the first publicly traded company in history?
Is it Dutch East India Company?
Absolutely, that's correct. So why don't you? So the Dutch East India Company, or known as Verenigde Oost-Indische Company, V0C in short form, 1602 it was publicly traded. Great answer, sir. Next question. Which famous financial index was originally calculated by hand using pencil and paper and published via telegraph? So from the question you can realize that this question is at least 100 years old, right? So any guesses? Yes, it was the Dow Jones Index. Pramod Rao, sir. So two basic fire starting icebreaker questions. Let's move to the third one. Okay. One of my favorite personalities, all-time favorite personalities. Identify this favorite personality, and I'll give you the hint also. I think people know this. It's related to the book that has been distributed to the speakers 1929. He is related to 1929, the Great Depression. Identify this famous personality in the picture. Show of hands, please.
Adam Smith?
No. Akash. It is Jesse Livermore. Yeah. So Jesse Livermore is considered to be one of the all-time great stock market traders in the history of capital markets. In 1929, he went short on certain stocks, and he was called mad, you know. Subsequently, when the Great Depression unfolded, he made over $100 million in profit, one of the largest profits in stock market trading in history. He is reputed to be one of the greatest traders of all times, and the book was written on him. It's called Reminiscences of a Stock Operator by Edwin Lefebvre. So, next question, please. Which market famously closed for 4 months, not because of a crash, but because of war? Show of hands, please. Anyone who wants to attempt the question. No negative marks. When I say market, the exchange, stock exchange, because it's a capital markets conclave. No? You can name the war also, in case you're guessing the stock exchange. Can you give her the mic, please?
US stock market?
Close. You have to tell the exact the exchange.
US-Vietnam war?
No. No. It is the New York Stock Exchange, yeah. She's revised the answer, but it's correct. New York Stock Exchange closed for 4 months during World War I, 1914. So next question. Now, all of you are fans of Hollywood movies. This is an iconic Hollywood movie, right? This is a picture from an iconic Hollywood movie. When I was in my second year MBA, I seen this movie at least 30 times. The movie was made by Oliver Stone for a particular reason, but it had an opposite effect. I'll tell you after the quiz, the question has been answered. So the question here is this: based on the picture that is displayed on the screen, name the movie and the character played by these two famous actors. You can name the actors also, no problem, but the characters in the movie played by these two actors, and name the movie. Any guesses?
The name of the movie is Wall Street.
Wait, who's attempting the question? Could you please stand up, please?
The name of the movie is Wall Street.
That's correct.
And Michael Douglas.
Yeah, so you have to name the characters played by both of them in the movie. Yeah, Gordon Gekko and Bud Fox, but you had assistance, so you can split the prize between. Yeah. Okay. Just go back to the slide. Yeah. So the movie was released in 1987, made by Oliver Stone, and it's centered around a famous insider trading scandal that took place in the US in 1985, which led to the arrests of a lot of Wall Street executives. Michael Douglas won the Best Actor award for this movie. So the next photo is related to this movie. Okay. I'll answer this and I'll come to that. So this is a cover of Time magazine, okay, dated 1986. There is a person on the cover of the Time magazine. He has a direct relation to the movie that was displayed, to the Wall Street movie. Identify this person. Tough question. Close, very close, very close. It's not Michael Milken, very close. No, sir. Very close. Pradeep sir knows the answer actually, I think. Very close. He's in the same book in which Michael Milken is mentioned. Any guesses? It is Ivan Boesky. Who said the answer? It is Ivan Boesky. So he was known as Ivan the Terrible. So now, if you go back to the Wall Street slide, and I'll answer Edie sir's question. This is a very iconic photo, actually. Go back to the Wall Street movie poster. Okay. Now, if you've seen how many of you have seen the Wall Street movie? This movie? Okay. There is a famous scene in the movie where Michael Douglas, aka Gordon Gekko, goes into a boardroom meeting of a company, and he says, "Greed, for the lack of a better word, is good." Okay. He makes this iconic statement. Now, this statement apparently is based on Ivan Boesky. Ivan Boesky was a famous insider trader on Wall Street. And he used to go in meetings of company boards and used to make a statement that greed is healthy. So the character of Michael Douglas in this movie is inspired by Ivan Boesky. And that statement, okay, actually in real life, such a statement was uttered by Ivan Boesky. And the movie and the character of Michael Douglas in the movie Wall Street is based on Ivan Boesky. So if you want to read more about this insider trading scandal, there is a book called Den of Thieves, written by Patrick Stewart. He won the Pulitzer Award for investigative journalism. It's one of the finest books ever written on Wall Street and insider trading scandal on Wall Street. Extremely deep investigative journalism. So this is what I would encourage you to read. In fact, Edie sir, when we were preparing for this conclave, Pradeep sir said that why don't we give Den of Thieves as a memento to all the speakers. But apparently the heading was a bit too controversial, The speaker might misunderstand, so we decided against giving that book. Yeah. So to answer Edie sir's question, the movie was made by Oliver Stone to highlight the dark side of Wall Street.
Okay, so it was basically intended to make everybody aware of what the dark side is. On the contrary, after seeing the movie, it inspired a lot of people to apply for jobs on Wall Street. Right? Honestly, when I was in my second year MBA Finance at Nasim Monji in 2007, I saw this movie 30 to 40 times. Of course, it's a negative, it has a negative ending, right? And in the negative ending, it's a regulator who comes and arrests that trader, Bud Fox, right? I never even thought when watching the movie that I would end up becoming a regulator one day, So, yeah. So next question, please. Okay. You all have heard about GameStop, right? GameStop 2021, that share price which skyrocketed. Okay, so the GameStop short squeeze of 2021 is widely remembered as a Reddit. Reddit is a social media platform, Reddit-driven revolt against Wall Street hedge funds. Okay, in this saga, the retail investors hit back at hedge funds. However, the individual who ultimately profited the most was neither a typical Reddit trader nor a hedge fund manager. He had built his position quietly over 18 months, consistently sharing his investment thesis in public, on Reddit of course, while being largely ignored or ridiculed. At its peak, his initial investment of $53,000 grew to approximately $48 million. This is in the GameStop saga. Who was this person? And what was the name of his YouTube channel where he documented his analysis? And I'll also give you a hint. Netflix made a documentary on GameStop, beautiful documentary. That person is mentioned in that documentary. So, yes, Mannar from Liminal, I can see his hand up.
Yeah, so I know the YouTube channel. It's Roaring Kitty. I don't know the name.
First, identify the person.
No, I don't know his name. I forget his name.
You got the YouTube channel right, but the person, you have to guess both the answers. Yeah. It is Keith Gill. That's correct. So you can split the price between the two. So it's Keith Gill, who was active on Reddit, and his YouTube channel was known as Roaring Kitty. Okay. One question before I ask this question. Okay. How many of you have heard about the South Sea Company bubble? How many of you? Sir, please. Can you give him the mic? Yeah.
So the mic would be Isaac Newton.
Yeah, that's correct answer. So South Sea Company is regarded in financial history as the world's first Ponzi scheme and also the world's first share price crash. So basically in 1700s, the British Empire had created one company called South Sea Bubble, South Sea Stock, for handling the British debt, British national debt. And Sir Isaac Newton invested in this company. He initially made a profit when he sold his shares early. Then he bought it back at near the peak as prices kept rising, losing approximately 20,000 pounds. Okay, 20,000 pounds in those days was a hell lot of money. So it was equivalent to several $1 million if you apply the time value of money today. So as it is most popularly reported, the man, Isaac Newton, who could calculate the motion of heavenly bodies, could not calculate the madness of people. So there was a crowd mania which went into investing into this stock, and eventually it popped off as a Ponzi scheme. Next question. Every action has equal and opposite reaction. That's correct. The term blue chip, used today to describe the most stable high-value stocks, was borrowed from which game, and what made that particular color the obvious choice? Pradeep sir.
I'll answer this if others are not answering, because I shouldn't.
No, you're the only hand that's up.
Oh, great. Okay, that's poker, and that's because it's got the highest value.
Perfect, perfect, excellent. Next question. This American economist spent his entire career warning that financial markets were inherently unstable and that a catastrophic crisis was inevitable. Mainstream economics ignored him completely, something which I heard many times before. The Economist magazine mentioned him exactly once in his lifetime. He died in 1996, never having received a Nobel Prize. 12 years later, the largest financial collapse since the Great Depression proved him right in every detail. You had the 2008 subprime crisis. A single two-word phrase became the most repeated term on trading floors from Wall Street to Dalal Street. Who is this economist? Supriya sir.
It's
Hyman Minsky and the
That's
Minsky
correct.
moment.
That's great. Yeah. He raised the hands first, I'm sorry. Yeah. That is correct. Hyman Minsky was the economist, and the two-worded phrase is Minsky moment. Next question. Okay. In the old open outcry days of the Bombay Stock Exchange, and this is a tough question, in fact, and please don't use Google. In the old open outcry system, you had this trading pit on the Bombay Stock Exchange where the open outcry system, they used to show hands and then trade. What was the specific local term used for jobbers? In the bracket, these jobbers are market makers who specialized in specific securities, right? They used to buy and sell from brokers. They were known as jobbers. What was that local term that was used? Sir, just a minute. You can take the mic. No. You're close, but. No. No. This is one specific term that was used to describe these jobbers. So in today's world, they used to be an intermediary of an intermediary. So they used to buy and sell from a broker. Very close. No. The previous word that you used? No. Any other guesses? No. No. Local term. Yeah. No. So I'll give a hint. Of course, let the gentleman guess, please. Yeah.
Lala.
No. So you have this term called dabba wala, right? The term ends in wala. It's a tough one. Very close. Hey, don't insult that family. Yeah. Who said that?
Taravani wala.
That's correct. Taravani wala. That's the correct answer. Taravani wala. Yeah. Taravani wala, yeah. If that's the right way of. So the next question, we're very close to the end. Who am I? I decided how much money companies would raise. I control share pricing and I disappeared. This is, SEBI veterans can answer this. Just a minute, let me finish the question. Or exchange veterans can answer this question. I control share pricing and I disappeared after liberalization, 1992. Who am I? Full form. That's correct, yeah. Next question, and I think most of you guys should be able to guess this one. One man sent the Securities and Exchange Commission of the United States a detailed, mathematically rigorous report titled "The World's Largest Hedge Fund is a Fraud." Not once, I can see Pawan's hand going up. Let me finish the question, I'll come to you since you raised the hand first. Not once, not twice, but 5 separate times over 9 years. The SEC investigated each time, and after each submission, found nothing. The fund collapsed anyway, taking $65 billion with it. Ponzi scheme, of course. Who was the fraudster? Yes, Pawan, yeah.
Madoff?
That is, Bernie Madoff is the correct answer, yeah. So Marco Polos was the investigator. You were close, yeah. So he submitted the reports to the SEC in 2000, 2001, 2005, and 2007, 2008. Each time the US SEC either didn't read it carefully or assigned investigators who lacked the quantitative skills to understand it. So 5 times a whistleblower brought a scam to the notice of the regulator, and somehow it was missed, right? And this was the Bernie Madoff scandal. Yep. Wizard of Lies, yeah, yes, yeah. Next question. In 2021, a company called, and I expect at least the hedge fund managers here to answer this question because you were involved in this. In 2021, a company called Signal Advance, and Signal Advance is the company which makes that Signal Messenger. Just this is another hint I'm giving it to you. Saw its stock rise 11,000% in 3 days. It had nothing to do with the company's actual business. What triggered this? Just show our hands first. One hand has gone up. Let me, because somebody from the last rows, nobody's answering. So anybody at the back rows? Anybody? I'll come to you, sir. You answered a question, so don't mind. Anybody at the... Yes, Vinayak. Please give him the mic. He's not a hedge fund manager, by the way.
I think around that time, Elon Musk tweeted about use signal, and that triggered.
That's correct. That's correct. Brilliant.
People googling it.
Brilliant. Brilliant. Yeah. So Elon Musk tweeted use Signal on January 7, 2021, referring to Signal, the encrypted messaging app. So retail traders moving faster than they were reading piled into Signal Advance Inc., a stock, a tiny market cap of roughly $7 million US, driving it to approximately 3.5 million valuation within 72 hours. In fact, this was not only the first time that Elon Musk intervened for retail investors. In the case of GameStop also, he had put a tweet, if you may remember, GameStonk, after which the retail investors started piling positions into that equity. Next question, please. What was the specific philanthropic philosophy Sam Bankman-Fried, SBF, publicly espoused that made sophisticated investors, regulators, and journalists lower their guard? This was the run-up to the scam that he was... Akash, yes.
Effective altruism.
That's correct. So, SBF was the most prominent public advocate of effective altruism, a philosophical movement arguing that the morally correct approach to wealth, to creation of wealth, is to earn as much as possible in order to give it all away as effective as possible. Right? Amazing. I believe this is the last question. So, in 2005, a relatively unknown economist stood up at a prestigious gathering of the world's most powerful central bankers, assembled to honor the retiring Alan Greenspan, Federal Reserve Chairman, and delivered a paper arguing the global financial system was heading towards catastrophic collapse. One of the most respected economists in the world called this paper misguided. He was described as a Luddite for questioning financial innovation. 3 years later, everything he predicted happened almost exactly as he described. Who?
Raghuram Raj.
That is correct, yeah. It was Raghuram Rajan. Yeah, for I have no comments to offer on that. So, that's it. With this, we approach the end of the quiz. So we have a next session. Yeah, thank you very much. Thank you.
So while we were planning this GSMC, so we thought we'll have this session after lunch to wake you all up. And we find that no one was even looking at the phone. So I think I should really thank Praveen for such an engaging thing, and thanks to you for all participating. Thank you.
Before the quiz, I forgot to tell one condition, that if someone wins 2 chocolates, one is mine, because I'm the only one from the non-financial sector. Okay, ladies and gentlemen, we're moving ahead with the address by Ms. Revati Kasture, MD CEO, CareEdge Global IFSC Limited, for sharing perspectives on sovereign ratings. Please help me welcome Ms. Revati. Welcome, madam. You were laughing so loud. Why can't you clap so loud? Thank you.
So, good afternoon, everyone. I'm sure all of you are now reasonably awakened after the lunch, because the quiz was both intellectually stimulating and entertaining at the same time. This presentation will be only one, intellectually stimulating. I don't guarantee entertainment. The topic is sovereign ratings, but I would go on to say that this is a topic which is pretty much a very wider topic. It's not only the country rating, because all the companies within the country also depend on this rating for raising money, which typically company ratings are capped at sovereign ratings. So Carriage Global is the first agency from India, an international rating agency from India, which has got into the space of sovereign and global scale ratings and has received license from IFSC as well as accreditation from RBI for rating non-resident corporates. And we obviously believe that the world needs an alternative. Yeah, so as I mentioned, we are the first credit rating agency from India and incorporated in GIFT City. When we started, we were a 100% subsidiary of Care Ratings India, and now we have got expression of interest from NSE-IX and SBI to take 10% stake each in the company. So that transaction would get concluded in some time. We are, in the very first year of our operations, the 6th largest coverage company in terms of the number of ratings that we do. We are the 6th largest. And we've rated about $6.5 billion of debt with 25 plus companies rated across 10 plus sectors. So this is what I mean by 6th largest in terms of coverage in the very first year of our operations. A lot of rating agencies have been around for many, many years. And we hope to do about 45 ratings by the end of FY26, that is in the month of March, another 3. And we will be then probably the 4th largest rating agency. These are our portfolio ratings. The one in red denotes a negative outlook, and the one in green denotes a positive outlook. All other are stable outlooks. This is the distribution of our ratings across all the entire rating category, AAA to D. This is our clientele that we have rated, the corporates that we have rated. Some of them have already raised money in GIFT. Some of them are in the process of raising money. Some of them are just issuer ratings because they use issuer ratings for their counterparty assessments when they trade globally. So in the last 1 year, what we've seen is that, I showed the slide on the ratings across different countries, and I said we covered about 41 countries. Now in 1 year, in 18 countries, we have seen a directional alignment of ratings by global rating agencies which have been in existence for more than 100 years towards our rating. And this is a very, very powerful validation of the robustness of the model that we have developed. And I don't believe this is a timing issue. I strongly believe that this is a model issue, the model or the methodology that we have used to arrive at the ratings. Otherwise, you will not get an alignment of, let's say, a Portugal, which we gave A+, from an A- to A+ in 1 year. India took 19 years for its upgrade to BBB from BBB-, and that's how fast or slow sovereign ratings move per se. So on the left-hand side are ratings where we had given a higher rating and there is a directional alignment. On the right-hand side are countries where we had given a lower rating and there is a directional alignment. And you might want to imagine that most new rating agencies would want to give higher ratings just to get ahead in the game. If you look at the top chart, then as compared to some of the large rating agencies, 50% of our ratings were different, but most of our ratings were lower than what were currently out in the market. So we believe in a very credible institution that we want to form within the country and from India to the world. This is something, when I talk about credibility, has been recognized by different countries too. So if you look at the engagements that we have been having, the Brazil government site already shows our rating. The countries on the left-hand side, France, Portugal, Greece, Turkey, have engaged with us. And we in our analysis, we now say that the rating is unsolicited, but with interactions with the governments of all these different countries. there are a lot of countries which come and make presentations to us. The reason that they do that is because they first find value in what we are saying and therefore want to add more color to how they are looking at their fiscal or monetary trajectory for us to take that into account in our next assessment. These are, the institutions in these different countries that we are engaging with, and you see 19 names over here out of 40 odd names, so close to the halfway mark there in terms of the engagement that we have got with institutions from these different countries. This is a slide I presented last time, and I'll not spend a lot of time on this slide, but typically what I want to say is that all this has happened because A, the methodology is transparent, it's 80% objective, 20% subjective as against 40% subjectivity in some methodologies. It is consistent, so we don't have different benchmarks for emerging and developed worlds. And there are some parameters and some weightages which are different. And when I say that they are different, the rating outcomes are different. And what we'll do is that I'll pick up 5 countries where our rating outcomes were different, and I'll tell you which of the parameters are those which led to those differentiated outcomes. Because it cannot be just a timing issue that somebody took a review later and then moved to our ratings. It has to be a methodology issue, which I want to highlight here. So I'm going to put some 5 countries as illustrations for differentiators. The first country I want to take is Portugal. Here we assigned a A+ rating in October 2024, which was divergent from other rating agencies, which had a A-, which is a 2-notch differential. The other 2-notch differential rating we put out is on India. And I don't say we have a home country bias over here because a lot of rating agencies then converge with our rating. But Portugal is a country where we put a 2-notch higher rating, and the reason for that is Portugal has demonstrated credible and consistent track record. 80% of my methodology is objective. I have to pick what the data is saying, and the data was saying that there is a consistent improvement due to the structural reforms which Portugal had undertaken. So if you look at the left-hand side graph, then the unemployment rate declined, and that's due to a significant amount of labor market reforms, and the real GDP growth has been strong. Portugal is another country which was very, very focused on fiscal consolidation, and we see debt to GDP of this country declining. One of the few countries in the world that you had a debt to GDP ratio declining in this period. So taken together, all these macroeconomic improvements led to better numbers, and those numbers translated into better rating for Portugal, which then some other rating agency in 1 year upgraded by 2 notches. The next country I would like to take is France. This is on the other side. We actually gave a lower rating to France. And when we gave a lower rating to France, our view was perched on a couple of things. One is persistently high fiscal deficits. Second is subdued growth prospects. So if you look at the high debt levels and muted growth prospects on the left-hand side as compared even to the Euro region. The third point is that there was a high pension and subsidy commitments in France, which led to constraining the fiscal space that they had available, about 8 percentage points higher than the Euro area also. So France, because of all these reasons, had a lower rating from us, and further on we downgraded the rating to A+. The other agencies have also converged with us now on A+ over a period of just 1 year. The next example I'd like to take is Morocco. Now, Morocco is a country where we gave an investment grade rating, where there was a sub-investment grade rating of the other credit rating agencies. And that's a very bold differentiator, because going from sub-investment to investment takes a lot of time, effort, and consideration. So when we look at Morocco, our belief in the rating was because of A, a robust capital investment momentum. Now, gross fixed capital formation is a primary differentiator in our methodology. It is not the primary differentiator for other rating agencies that we studied of. And because gross fixed capital formation, that is a capital investment that is made into the country, is a primary driver, that led to Morocco's debt trajectory, led through capital investment, have a favorable outcome in our methodology. So if you look at the BBB median for gross fixed capital formation on the left-hand side, Morocco is better than that. And that was one of the drivers for our Morocco rating, apart from diversification efforts which the country made and the nearshoring benefits, because it is close to the southern European countries. So it got a lot of nearshoring benefits, which was evident in the numbers, while the external debt has risen. But there is a mitigant to that in terms of higher forex reserves, which is partially offsetting that, and therefore we are very comfortable with even the external debt rising in this country, and that's a differentiated rating on Morocco. The fourth country which I would like to take is South Africa. Now, in case of South Africa, one of the differentiators in the methodology is what is the percentage of external debt, what is the percentage of governmental debt which is external, and how much percentage is domestically held. This is a primary driver for us. In case of South Africa, if you see from the chart, there is very high domestic debt and very less external debt, which means that they really are in a very comfortable position in case there is any refinancing of debt which has to happen, because not a lot of it is externally held, it is in the domestic currency. The second thing is that in our framework, we use what we call as an adjusted net international investment position, which is there on the right-hand side. Now, this is defined as NIIP's net of outstanding FPI investment on the liability side. Now, why do we adjust it? Because this measure helps us assess the economy's ability to withstand significant capital outflows. And this was favorable for South Africa, which is why we had a higher rating on South Africa, and the other agencies followed. And of course, I can't leave the stage without talking about India. So why is our rating on India higher? And what are the differentiators that help us sustain that approach? One is, again, as I spoke about one other country earlier, the capital investment that the government is making is high. So if you look at the right-hand side top quadrant, these are the countries where the investment or gross fixed capital formation as a percentage of the GDP is high, and this has an extremely high correlation with the future GDP growth rate of the country. And India is very comfortably perched on the top in this matrix. And this is a very important primary factor for us. The second point which lends itself to India's rating being higher is, the amount of externally held debt. Just like I spoke about South Africa, also in case of India, the amount of debt which is externally held is extremely low. The third factor which helps India is that the government is very, very disciplined as far as fiscal consolidation goes. And again, we are one of the few countries where debt to GDP is going to fall. It's going to go to 77% by 2030, which is a very, very good number. So those are the large three reasons why we have a differentiated rating on India, notwithstanding the fact that our interest expense is higher. And it will come down because, our interest costs are trending downwards as a country. This is the differentiator part of the presentation. I'll move towards what is our sovereign credit outlook across the different continents. So I'll just give a flavor of where we are right now as far as the global economy is concerned, and what do we see in different continents play out. So if you look at, last few years, we've seen the interest rates trending downwards, but the yields trending upwards. And that is very apparent. The policy rates have started to ease. So many countries are now in this rate cut cycles, but this is not translated into a meaningful decline in sovereign yields. Persistently high yields suggest that the markets are increasingly focused on structural fiscal pressures, particularly in the advanced economies. So that's point number one for the global landscape. Second, we are seeing global debt is going to surge. Yeah. Global debt to GDP is going to surpass the pre-pandemic levels. So the pandemic levels by the end of this decade, it's going to be more than 100% of GDP. So we are not just talking about rising borrowing costs, but we are also talking about structural buildup of debt that could shape markets in the coming years. And this is happening in the developed world in the US and the emerging world in China. Both these countries are heavily borrowing. On top of this, there are trade-related challenges that we all know. The tariff, drama of the US has unfolded after the Liberation Day, and we still are grappling with what, how, and when of that. But overall trade protectionism is increasing. With clear implications on global growth, supply chains, and evolving global trade order. There is also a geopolitical risk and a strategic rivalry which is, unfolding itself. This is, the strategic rivalry I say in 3 areas. One is AI and tech. Second is semiconductors, and third is critical minerals. We're seeing this happening more and more, and that is also shaping, how countries unfold their future. To summarize, the 2026 outlook underscores a changing environment marked by high interest rates, high debt, and a good amount of trade barriers. So how does it look across the different continents? So if I look at Asia Pacific, then we see that there are structural strengths. Asia Pacific is a continent which is also manufacturer to the world and also provides a lot of services to the world. So in that sense, it is expected to remain broadly stable, supported by structural buffers. And these buffers will offset any pressure that we have on exports, impact of global tariffs and subdued private consumption across several economies. Of course, within Asia Pacific also you will have some countries which are high trade openness, and that will get higher impact than those countries which have low trade openness like India. The next continent is Africa. While a lot has been said on growth on Africa, we remain cautiously optimistic on the continent, which is Africa has good long-term growth prospects, and there is a reform which is also going underway in multiple countries. However, despite of this, there is a limited fiscal space that is there, and there is an exchange rate volatility which persists across the region, and that's why we remain cautiously optimistic on Africa. Now, Europe is a divergent southern and northern Europe. France and UK exhibit something different from Greece, Spain, Portugal. So the debt profiles of these European nations are actually divergent. Fiscal space is set to come under strain over here, and therefore we see that Europe will be walking a tightrope walk. Americas is largely stable, ex-US, but their resilience is getting tested. The consequence of expanding US influence in Latin America, of course, remains a key monitorable. Inflation across the region, while easing, is still above the target in most countries, and therefore we feel that, Americas, while it is largely stable, ex-US, but it will still be a key monitorable region. So that's it from my side. What I would encourage you is to scan this QR code to access all our research and our reports from our website. Thank you so much.
Thank you, Revati ma'am, for that enlightening session. And I now request Mr. Vivek Singhvi from NSE IFSC Clearing to present Ms. Revati Kasture with a memento. Thank you, madam. Thank you, sir. Yes, please. Because you can get the lunch on time, we had shuffled one of the session, and we are sorry for that. not to us, to the person who's going to present the next address. Please help me welcome Mr. Sunil Alvarez, MD and CEO of CDSL Ventures Limited. Welcome, sir.
Good afternoon. Good afternoon to the distinguished guests, ladies and gentlemen. It's a privilege to be here at the Global Securities Market Conclave. So basically, I'll try and deliver this address in two parts. One is about the KRA, what we've actually done in the Indian securities market, and secondly, what we propose to do in the IFSC. So for nearly 2 decades, CVL has played a very silent yet deeply foundational role in the securities market ecosystem. CVL was the first to, along with, in association with the mutual funds in India in 2007, to set up the first KRA in the country. And after the KYC regulations came into being in 2011, CVL was the first KRA to get registered with SEBI. And today, it is the largest KRA in the country. Just last month, we achieved the milestone of 100 million KYC records. So over the last 2 decades, CVL's mission has been to strengthen the trust in the financial ecosystem, enabling greater investor participation, and supporting the growth of the markets. By ensuring a robust and uniform KYC network, CVL has also helped intermediaries a lot. So earlier we were talking about a TAT of T+10. So recently the Indian capital market regulators, that is SEBI, has reduced the TAT to T+2. But we have gone much beyond that, and with all the fintechs coming in, we are actually validating the KYCs almost on a real-time basis. Of course, there are other validation sources available over there. We validated with the Aadhaar database of UIDI. We validated with the PAN database of CBDT. We validate the email, mobile numbers, etc. So, over a period of time, we have achieved this milestone of 100 million records. We have thousands of intermediaries which are registered with us. And we continue supporting this continuously expanding digital ecosystem, which again has been built on 3 pillars, that is of security, of integrity, and regulatory compliance. When we talk about security, we're talking about the best in class in terms of cyber security, the best in class by ensuring we have a primary site, a DR site, a business continuity site, and all of those things. If you see the KRA system, it's gone through a transformation over the last 2 decades. What was just earlier a repository for storing of KYC information, now it has become a digital-first, investor-centric infrastructure that enables seamless onboarding for opening of demat and broking accounts for investors wanting to invest in mutual funds, accessing capital markets, and participating through fintech platforms. I'm also delighted to announce that CVL will shortly be launching the CVL IFSC platform by the end of March. This will be specifically designed to the needs of the IFSC ecosystem. And this platform again will be built on 3 core principles. That is, it will be globally compatible so as to align with global regulatory requirements and expectations, digital efficiency for end-to-end digital onboarding using advanced verification tools wherever possible, enabling intermediaries to onboard international investors with ease, and regulatory integrity by being fully compliant with the IFSC's regulatory framework. The introduction of KRA would bring in many benefits to the IFSC ecosystem. So you would have faster onboarding of investors out here. basically, once the way the KRA system works is the investor needs to do his KYC only once. So once he approaches to an intermediary and submits his KYC documents out there, the intermediary then submits, if it is registered with CVL KRA, it uploads the documents into the KRA. The KRA does a verification of the documents, does a validation of those documents with the source database, and then registers that particular record with a reference number. In the Indian securities market, that reference number is the PAN number. So next time the investor wants to go to any other intermediary, he doesn't have to cart his KYC documents all along with him. He can just quote his PAN number out there, and the intermediary can download the KYC documents. It becomes that simple for him. Secondly, in case of you have any change in demographic details, you want to modify your address or any such thing, you can just fill in a normal modification form and go to any of those intermediaries where you have an account with him. You submit that modification document to him. Ultimately, that modification document will be uploaded to the KRA. Once the KRA registers that modification in its records, we will send a feed to all those intermediaries where that particular investor has an account. The intermediaries who receive that feed can take it into their back office and update those records. So that is one thing they can do. So that helps the investors again to a large extent. Recently, we have also started in the Indian market something called demise reporting. So if any of the intermediaries receive instruction from their clients, relatives or so that the investor is deceased, and once that instruction comes to us along with the death certificate, we inform all the other intermediaries as well, so that the intermediaries then can write to the investors so that the nominees can come along and claim the securities. All intermediaries which will be registered will have access again to a unified secured database for KYC verification. It will improve your risk management with a better validation framework and data integrity mechanism. Also, we have a lot of AML checks where we do FATCA validations, etc. And most importantly, it will actually help the ease of doing business, as intermediaries will be supported by a centralized repository where all the KYC information of the investors in the market will be available. Unlike the Indian securities market where the KRAs are restricted only to the securities market, in the IFSC, we will be linked to all the financial intermediaries, that is banking, insurance, the securities market. And finally, as we march again towards the 5 million US, to a US 5 trillion economy, the role of trust, compliance, and digital infrastructure is only likely to expand. And CVL aims to contribute to bringing the best practices to investor onboarding, strengthening cross-border compliance, enhancing interoperability. So in the Indian capital markets, there are 5 KRAs, and we are seamlessly linked to each other. The intermediary does not have to link to all the 5 KRAs. They can link with any one, and you can fetch a KYC from any of the KRAs where the record is lying. And supporting financial innovation in IFSC with global investors with confidence and credibility. Before I conclude, I'll be playing a 1-minute video which will give you a better perspective how the KRA system will work and what we plan to do in IFSC KRA. Can I have the video, please, for the audio visual?
CDSL Ventures Limited, CVL, India's largest and most trusted KYC registration agency, is proud to announce its expansion into Gift City, Gandhinagar. After decades of leadership in investor KYC and regulatory compliance, CVL KRA now brings its expertise to India's emerging global financial hub. A KYC registration agency, or KRA, forms the backbone of India's securities market compliance ecosystem. It ensures that every investor's identity is verified, validated, and securely stored. With a KRA, Investors are freed from repetitive KYC submissions each time they engage with a new intermediary. A single verified KYC is all it takes, making onboarding smooth, efficient, and future ready. In IFSC, the same principle applies. KYC registered with an IFSC KRA is recognized by all intermediaries operating within the financial system. One-time KYC means lifelong convenience across institutions. Whether you're opening a bank account, purchasing an insurance policy, or opening a broking account and a demat account. What makes CVL KRA unique? It is the largest KRA in India, trusted by 100 million investors and most intermediaries nationwide. It offers seamless integration. Your KYC is accepted across all SEBI registered intermediaries. It's secure and fully compliant with industry-leading data protection and regulatory standards. Its efficiency at a scale eliminates repetitive paperwork and speeds up investor onboarding. Now, it is expanding its global reach with GIFT City, connecting India to international markets. With CVL KRA, you don't just meet compliance requirements, you unlock convenience, security, and trust. Getting started is simple for any intermediary. Fill out the master creation form, provide the supporting documents and user details. Submit documents digitally. Once verified, enter into an agreement. Your access will be created and user credentials will be shared. For any assistance, please reach out to Mr. Sudeep Shukla on sudeep@cvlindia.com. As CVL KRA enters GIFT City, we invite institutions and intermediaries to join us in shaping the next chapter of India's financial evolution. CVL KRA, India's largest, now global.
So like I said earlier, we would be starting sometime by mid to end of March, and once we go live, I have my colleague here, Sudeep, who will be helping you out. That's all I have for today. Thank you so much, and I look forward to many of the intermediaries joining once we go live. Thank you so much.
Thank you very much, sir, for that presentation of yours, and we wish good luck to you. I now request Mr. Mihir Upadhyay, General Manager, IFSC, to present Sir a memento. Sure, sir. Thank you. So coming up this afternoon, we have a very exciting panel discussion on a thought-provoking topic of tokenization of real-world assets. The panel will explore how distributed ledger technology is revolutionizing ownership and trading by converting tangible and intangible assets into digital tokens. We have esteemed panelists who will discuss the transition from pilot projects to institutional adoption, potential benefits and challenges to scale, the regulatory frameworks shaping the future of global finance, and potential financialization of real-world assets through tokenization. And the panel is one more time going to be moderated by Shri Praveen Kamath, General Manager, IFSC. Welcome. Without wasting a moment, I would welcome our panelists on the stage. Foremost, Dr. Pramod Verma, co-founder and Chief Architect, Networks for Humanity, NFH, former Chief Architect, India Stack. Welcome, sir.
And also former committee member of SEBI's Committee on Financial and Regulatory Technologies.
Sorry, I don't have this much knowledge. I'm so sorry. Thanks, Praveen, for helping me. Mr. Ronit Ghosh, Head of Future of Finance, Citi. Welcome. Mr. Vincent Turcotte, Sales Director, Apex Digital EPEC. Welcome, sir. And Ms. Suzanne Zhang, Senior Product Manager, Global Payment Solution, HSB. Can we welcome all of them with a louder round of applause? Thank you. Over to you, Praveen.
Thank you so much, Dhwani. This panel was supposed to be for a duration of 60 minutes. Due to unforeseen circumstances, we have cut it down to 45 minutes. So I had originally planned to start with a 180-second odyssey. I wanted to take you on an odyssey of tokenization, but I'm cutting that short. So before I start, I just want to repeat what I said earlier in the morning. In the GSMC app for Android and iOS, we have a poll for this panel. Okay, audience opinion poll questions. So if you go to the app, the top leftmost corner of the app, 3 lines, you click on it, live session, and then poll. So there are certain audience poll questions that are there with respect to this panel. We have activated the questions. Request you to take 10 seconds off to just answer the questions. These are multiple choice questions. We will be displaying the results of this poll at the end, towards the end of the session. So without much further ado, I'd like to start. Now, tokenization, to summarize, asks a simple deceptive question. Okay, it just asks the question that what if the entire life cycle of an asset, right from issuance to trading to all other post-trading activities, what if the entire life cycle of the asset is on-chain, instantly settled, and always on, available on a 24/7 basis? What happens when you do that? So that's the inherent question which tokenization asks. Now, in my experience, if you meet 10 people at any event and you ask them what tokenization is, you'll get 12 different answers. One subset of people will say it's a revolution, it's a damn new thing. Another subset will say, no, it's just a database. Now, in between these two answers, the real truth lies. So, Dr. Verma, since you were part of SEBI's Committee on Financial and Regulatory Technologies back in 2018, I used to interact with you very extensively, and you were the first to broach the topic of tokenization in our committee back in 2018. So I'll start with you today. When we talk about tokenization of real-world assets, what are we actually solving for? Are we trying to create liquidity? Are we trying to bring in operational efficiency? Or are we trying to optimize the balance sheet or make asset easy for access? What are we trying to solve through tokenization?
First of all, I think that depends on who you're asking, what you're trying to solve, because different people want to solve different problems. That's nothing wrong with it. But very quickly, first part, what is tokenization? For me, tokenization as a broader construct. Just for example, when we carried our note, physical note, and handed over to you, it got instantly settled. And you could verify them, you could accept them, you could transact instantly. So in the physical world, I could transfer a token, but in the physical form, of course, the physical form, and instantly it was acceptable, verifiable, transactable, and it got settled. When we digitized, we actually brought the agency out of the user and back into the computer system with all the workflows. Now, if I want to send money, my bank, my app, my bank has to integrate with your bank, your app, before I can actually just pass on that 10 rupee note. Think about it. So we complicated quite a lot, actually, in digitization. Tokenization, actually, Nandan Nilekani, my sort of the de facto CTO of India, my co-founder at Networks for Humanity, he said, when we were in Basel, we were presenting to BIS, and he said, the title was Back to the Future. And this was very essential to think tokenization as a means to give back that agency to transfer a verifiable, transactable representation of an asset. Which asset? Any form of asset. Real world asset, physical assets, digital assets, currencies. Some of them are touchy topics, but nevertheless, they're all digital twins or digital representation of it. So that's first part. For me, tokenization is not at all related only to money. It is tokenization as a means to represent any form of economic asset in a verifiable and transactable fashion. And the second you asked is that I don't think it's a technology driven at all. If somebody says tokenization about DLT, it's one means to do it. We haven't even seen the tech that is yet to evolve. So I would actually make an argument as an old man, been in the computer science system for a long time. I can actually tell you that tokenization has nothing to do with tech. It's not at all tech driven. It's a means to actually represent and make it. Why do we do it? For me, it is democratization. When we built UPI, why do we build UPI? Why did we build Aadhaar? Why did we build DigiLocker? People haven't even asked those questions yet. It is a means to actually democratize technology as a means to allow a long tail of users and SMEs to participate in economic transactions at a low cost, high trust fashion. You can't reduce the trust. So low cost, high trust fashion. That's it. For me, that's only reason why I would do tokenization is to expand the pie.
I take the point that for tokenization, you don't need to necessarily use a distributed ledger, centralized ledger, like in the traditional system may also do. However, if you see, when Vitalik Buterin published that white paper on Ethereum, that is when the term tokenization went mainstream, if I'm not mistaken. So the underlying technology at the end of the day is a DLT, distributed ledger technology.
Not necessarily. I would argue no. You might think so. That might be today's argument. I actually think no. No, the reason why is that the DLT came with a philosophy of disintermediating intermediaries, saying that math will be the trust factor. I trust math and I don't trust institutions. But that's not reality. Institutions have to exist, legal systems have to exist, grievance handling systems have to exist. So when you actually, this is why we started confusing ourselves with permission change now. Or private, it means nothing. It's actually quite silly argument there. So I would think DLT plays a role, definitely plays an important role, but doesn't have to be the only tech.
So now that you have lit a fire, let me move to Mr. Ronit Ghosh. Do you see the DLT being the central technology around tokenization, given that it's mostly spoken about by proponents of DLT?
Absolutely, and thanks for inviting me and inviting Citi. I would echo some of the comments that Dr. Pramod meant, and your, or rather Nandan's Back to the Future framing is brilliant. Think about what money is. For most of the history of money, 5,000 years of recorded civilization, give or take, money used to be coins. What's the rupee? A rupiah? A silver coin. Most of the currencies in India, in China, in the historic economic centers of the world were silver coins. If I gave you the silver coin like you gave a banknote, we have instant settlement. It's a token. Computers arrived late 50s. So in America, where my bank is from, in the UK, in France, computerization happens in the late 50s. In many other parts of the world, computerization, I still remember walking into a bank in Europe, in Southern Europe, 2005, they were bringing computers into the banking system in that country. So between the late 50s and early 2000s, we had computerization. Without that, you don't have centralization. So what we're reinventing with decentralization is combining the benefits of scale computing and the benefits of the old silver coins. DLT is an important part of it, and this is a bit definitional. I know you had a little bit of a disagreement there, but it depends on how you define tokenization. Like, we talk about tokenization in credit cards. We talk about tokenization today, tokens were, but we talk about tokens in this panel and often in finance where we're talking about blockchain-based or DLT-based solutions. It doesn't have to be. It's just that that's the definition we have chosen today. But tokenization can be defined in many, many ways. DLT, whether obviously classically is permissionless, DLT is a very important part of tokenization. Now the challenge we have as regulated financial institutions is that money isn't the same as technology. Money inherently is permissioned in the modern world. It can be grades of permissioning, but there is a permissioning element because there's a state, there's a government, a central bank, in some societies a king or a sheikh or there's a central institution that permissions, and that's what gives the value to money. Now, blockchain is in a way taking us back to silver, because silver the minting, the putting the stamp on the coin gives the authority, but there's also an inherent intrinsic value to silver or gold. And blockchain has this intrinsic value of decentralization, software embodying decentralization. So it's like our generation, or actually probably my children's generation, version of silver or gold. So, sorry, a very long answer, but I think it all depends on how we define it. In the context of this panel, yes, DLT, I think, in blockchain is very important. And because we're coming from a regulated world, permissioned blockchains, while a little bit of an oxymoron, permissioned blockchains are where we start. But it's like a bit like, when you learn to ride a cycle, often you have stabilizers. Some people say you should just go straight without stabilizers. That's the current philosophy, just get on the bike and run. But we as parents often like our children to have stabilizers. Our regulators like us to have stabilizers. The governments like us to have stabilizers. So that's kind of what we're trying to do with permissioned blockchains.
Yep. Point taken. If you see in our consultation paper on tokenization that we issued last year, IFSC, we have said in a way that it need not necessarily be a DLT, it can be a centralized trading platform as well. But nevertheless, 2018 when everybody was talking about blockchain and tokenization, it was in its infancy. People were saying that technology is not commercially viable. So my next question is to Ms. Suzanne. What has changed in the last 24 to 36 months? And I'm asking this to you from a global bank perspective. What has changed in the last 24 to 36 months that makes tokenization viable now? Is it client demand, or is it inherently the asset, or any other factor that you feel?
Okay, thanks for the very, very tough and good question. And for everyone seated, if you are new to this space, let me also just add a little bit of history. Of course, again, Bitcoin paper came out, I think, 2008. Someone feel free to correct me here. So it's a long history when we're talking about blockchain and DLT here. And we went through waves, including all your blockchain consortium looking to crack trade finance. And then that wave ended. And then what happened was that you see a lot more momentum when it comes to stablecoin, but again, for the crypto ecosystem, right? So to answer the question here, I think it's actually multifaceted. Why do I say so? Because I think first off, as what Pravin has rightly mentioned, we do see clients who want to move their funds on a 24/7 basis for treasury management. We also see institutional clients saying, can I do tokenization of real world asset? And it can be a tokenization of bonds. We offer tokenized gold, for example. And again, we have customers then saying that, can you do custody for me? So that part is a growing part. But again, I don't want to mislead everyone going out of this room thinking that tokenization is the future, right? Because that is like, as with all technology curves, they are the frontiers. And then we still have the middle chunk of everyone, which is my wide corporate and institutional clients at large. They are trying to grapple and understand what is it about tokenization that is worthwhile for them to take a look, right? And I think maybe just to cap off the last point here is that I think from a bank perspective, we are then seeing, because I just want to touch on that whole conversation on blockchain or not. Again, for myself, coming to the banking world, I would say that, we will touch on this later on. I don't want to pre-jump it here, right? Each bank works on core banking system. And if you have ever seen one, you might think that you're looking at a game from when you were in childhood. And again, blockchain, we talk about permission and everything. What it does bring is that possibility for them to be bridged and interoperable. Yeah, maybe back to you.
Great. Mr. Turcott, one of the arguments given by the proponents of tokenization is that if you have a high value liquid asset, when you tokenize it and break it into smaller unit, you can bring in liquidity into that asset. However, if you see some of the pilots that are running worldwide, of course, in the unregulated space, that has not exactly been the case, right? There may be a genuine use case, I don't know. I'm asking you as a tokenization enthusiast and not as a regulator. So is the argument that tokenization will bring in liquidity into high value liquid assets, high value illiquid assets, is this a reality or is it a myth?
For some reason, God does not want you to speak at this. Thanks very much for the question. And before I dive into it, I wanted to just say thanks to GSMC and all the sponsors for having us here today. My firm, Apex Global, has 70 people here in Gift City. We have 5,000 people in India. And the reason I'm sitting here and not my boss is that the 75 top managers for Apex are all in Jaipur right now at an offsite. So they brought me in from Hong Kong rather than Amit Jain, who runs our Gift City office, or my boss, Angela Walker, who runs our commercialization for tokenization from London. But once again, thank you. And to your question, it's a more nuanced one. I think there are a couple different things to look at. On the surface of things, tokenization is not a magic bullet. For highly liquid assets, for instance, stocks, foreign exchange, government bonds, and so on, it's rarely going to add a lot of value. Now, under most circumstances. Each of these assets, however, is tokenized when there is a reason to do so. And that's mostly so it can interact with participants who are already within the Web3 environment. However, underneath that, a lot of the big banks, including our colleagues at HSBC, Bank of New York, Citi, some of the other big banks have begun to tokenize treasury bonds, for instance, for repo, so that they can do it internally. And that actually increases the velocity of that collateral availability. It increases the atomization between digital money or even fiat money and the asset, so you can lend it for 2 hours and bring it back. And that's a level of liquidity that was never available, even in these notably liquid assets. Repo is one of the most interesting applications for it. It's a little bit of a dull subject for people who are not really directly engaged in the business. But that velocity of collateral movement has actually increased a great deal, to the point where we're talking to central banks right now. We just had a meeting earlier this week with a central bank who's very excited about taking its primary issuance of its exchange fund bills, or they're not exchange fund bills, that's Hong Kong. This is another jurisdiction that uses a similar product to manage their primary liquidity for their banks. They want to put it on chain and have it interact with their CBDC, their central bank digital currency, so that their settlement can go from T+2 to T+0, and their ability to keep track of where all of the bonds are at any given time, who has them, and how they've transacted at what price, can all be monitored from a centralized platform in real time. Now that is delivering real value, where I would argue that tokenized stocks really don't deliver value. That's I think, a longer answer than you were looking for, but that's kind of where we're at with it.
That's very candid of you. To build up on that answer, Mr. Ghosh and Dr. Verma, a lot of financial institutions today are building their own tokenization platforms, and each one of them is having its own technology stack. So in essence, these are all siloed platforms, not exactly interoperable, or if I may be bold enough to say it, not exactly fully scalable, right? And the way things are being rolled out, you're going to see multiple silos that are operating in this space. Now, when you have multiple silos, it's a nightmare for a regulator to regulate and supervise, point one. But it's also a nightmare for the end investor who wants to move value between different systems. So do you see the future of tokenization between the siloed environments as a unified ledger? Do you see a unified ledger coming where every entity which wants to tokenize an asset will come on a unified ledger, one common ledger, and do the needful? Or do you see eternally a need for having bridges and bilateral agreements to move value between different systems? So I would first like to start with Mr. Ghosh.
I'll answer your question if I just have a 60-second segue to pick up on what Vincent was saying about tokenization and liquidity. I broadly agree with what you said, that if you're looking at the foreign exchange market, the world's most liquid market, say you're looking at dollar euro, dollar yen, dollar pound, do we need tokenization? Or you're looking at NASDAQ, NYSE, or here in India, the stock exchange, do you need? But then you think about it not from the perspective of our regular clients or HSBC's regular clients, big institutions, large family offices. You think about it from more the democratization point, which is, what if you could tokenize NVIDIA and put it through fintech apps around the world, fully regulated? You open up a whole new investor base for NVIDIA stock. Now, the biggest fund manager sitting in Hong Kong or Singapore doesn't need that. The biggest fund manager sitting in Hong Kong and Singapore can call the Citi trading desk or the HSBC trading desk and execute NVIDIA. Even on many retail apps, you can do that. But tokenization opens up a whole new demographic and geographic reach. Even in the US, many younger clients in their 20s or early 30s, a lot younger than Vincent and myself, might choose to take the token version. So broadly agreeing with what you're saying. Now, in terms of the unified ledger and again, sort of going with analogies, you said these banks, these silos. I think I'd go back to what I was saying before. Do we want to ride a bike with training wheels? No. But did our parents make us do that? Yes, because it was a start. So I think of these silos or these islands as a start. It's not the end point. But it's better to ride the bike with training wheels than not ride the bike at all. So I think eventually we're going to get to some level of interoperability. Because just having silos, I mean, we have a couple of very big banks on the stage. You're probably a client of ours in multiple jurisdictions, but the liquidity benefit, if it's interoperable between our two banks and then, you know, the Indian banks and then the other Southeast Asian banks or European banks, clearly is vastly better. But we can't jump straight to that endpoint because we're learning to ride the bike. Our regulators and stakeholders are watching us learn. So I think it is a stepping stone. Now, is the concept of a single ledger, whether it's, I'll let you talk about the Finternet, but is the concept of a single ledger somewhat utopian? I mean, conceptually, it makes a lot of sense to have one piece of, or one framework, whether it's a single software or a single set of rules where different types of assets can plug in. But I think of it a little bit as the kind of the search for a universal language as well. Now, even if you don't speak English as your first language, it's often our second or third language. It's like the interface layer. But language around the world, there's no one language. Hundreds of millions of people might speak Hindi or Bengali or Mandarin, and they'll carry on doing that. We'll just make the interfaces easier with technology. And I think money is the same. I think this kind of having a global single ledger, it's a utopian quest. Who's going to run it? It's like a global government. We don't have a global government for the same reason, but we're going to, I think, have a network of networks, and each network needs to be more multidimensional and then interoperable. So, like, take Swift. We're one of the biggest members, shareholders of Swift. Swift has a project, a sort of a unified ledger project, but it's going to be an orchestration layer rather than a single database, because it's too utopian to have a single government, a single network, but an interoperable one. Think of the telecoms network. Tomorrow, if you land in whatever European country, my phone from the UK works. If I land in Germany, if I land in India, if I land in Hong Kong, my phone, these are different networks, they're just interoperable. And so that's, for me, the kind of model. It'd be terrible. Can you imagine you land and I'm not plugged into the local network? That's how it used to be, right? Before mobile phones. But I can go pretty much anywhere in the known world, and my UK-based phone automatically connects. I'll pay some roaming charges, but I don't know. What do you think?
So your take on this?
No, I think it's perfect. It's very well said. First of all, I think there is so much affinity. I think tech guys sold you a bunch of stuff, and I'm the only tech guy, I think, in the thing, because we have a magic new tool called DLT. We are trying to solve everything with DLT.
And tech guys tend to benefit from the rollout of DLT because it's
just even more costly.
Right?
It's just ridiculous. Yeah. So, but there was a purpose, though. Vitalik, the people who built that, had a purpose of creating currency. The math can drive the currency. In that world, it's perfectly sense. Make validators, all the mining, everything makes sense there. It does not make sense when you have a trusted ecosystem Cryptography makes sense, but not necessarily a DLT. There's a very big difference between those two. Okay, so cryptography makes immutability, non-tamperability, they make sense, but doesn't mean DLT makes actually sense as a data structure. That's point number one. Point number two, the velocity. We have not even seen the velocity of what AI agents is going to do. AI agents are going to take this volume. We thought UPI is, 750 million transactions a day is high volume. We have not even seen what's coming. Our banking system will not be able to handle the kind of volumes that agents are going to do. Micropayments, billions and billions of them. Micropayments, it doesn't make sense. High value, low volume, it's okay. But extremely low value, high volume is just ridiculous computing, right? So you can't drive that thing into the old model. You're trying to take an old engine, DLT, I would actually say it's an old engine, and force into an AI world. Keep that in mind. And the last main point you're asking, I completely agree with him. He's precisely correct in saying UPI, we did not create a central system or central tech. And hence the U part of UPI, we keep forgetting. It's called unified because it's not uniform. Very subtle difference, not uniform, it's unified. That means they will exist many technologies, many variants and implementation. But for the user and for the businesses, it ought to be unified. And that's precisely the vision of the Finternet that we are driving. In fact, it was misconstrued and misunderstood as a single ledger. Absolutely wrong. It is about every individual, 8 billion of us, and 300 million businesses having our own ledger, which is unifying issuers' ledgers. And issuers can use any types of ledger to mint it. Banks might choose one, somebody else might choose one, my agri-produce guys might choose something to mint and agri-produce into a tokenized world. No big deal at all. Technology will create interoperability and bring unification, not uniformity. Okay, so if Internet is precisely the dream of accelerating a unified world, where the individuals continue to own all forms of economic assets in their ledger, and that is issued from a variety of different technologies, but unified for me as a user. And then the transactability becomes much easier. This is what smartphones did, right? You create a programmable world for the fintechs and technology guys to be able to now program on a common world, common protocol. Not common tech, common protocol. Okay, so very subtle differences, but important ones. Good question, by the way. Thank you.
Fantastic analogy, sir. So my next question is for Mr. Vincent. A lot of financial institutions today have pilots in the field of tokenization. Some have multiple pilots. And a lot of these pilots are flying around in circles, waiting for permission to land. Now, of course, there are multiple challenges in these pilots. There are technical issues, and then there are non-technical issues within these pilots. What, according to you, are the non-technical issues being faced by a lot of these pilots on asset tokenization?
Wow. Well, there's a lot there. I think maybe I can answer it by going back to some of the things that we've just been discussing a moment ago. It's our fundamental belief that the choice of a blockchain or a ledger is not really relevant. There's no need to have a single unified ledger. In fact, financial market participants, particularly banks, prefer to have digital islands, as you described them, with the idea that they will have their own walled garden in which they can manufacture tokens and manage internally, which is a big part of the advantage of tokenization, the ability to move money internally, whether it's across their legal entities or across their client base, they can do it 24/7. I mean, as everybody knows, that's the real plumbing of a bank. Let's face it, we were discussing this before the panel, Suzanne and I mean, most banks still have their transactions banking, their core banking processes on COBOL. And, my memory of COBOL is dropping some cards into a snowbank when I was on my way to to an exam in COBOL in 1979. Okay, so that's really where the banks are right now. I mean, Citi's still there, HSBC is still there, everybody's still there. COBOL is not what it was back in the 70s, but it's still okay, let's face it, if you're going to build it today, you wouldn't build it on COBOL. You would build it on blockchain. And one form of distributed ledger or other you would use to do it. Now, getting back to the regulatory side of that, where the regulators have an issue is, can they monitor all the activity on the blockchain? Can they see what's actually happening? The answer to that is yes. And it's not the blockchain itself that you have to worry about. It's the assets that are changing hands. Programmable assets are the future of tokenization, or the future of blockchain. Our team developed something called the ERC 3643 standard some years ago, and they spun it out into a foundation, realizing it's never going to be a proprietary thing. And it's now become the most popular standard for tokenizing real-world assets and funds and so on. I mean, BNP, for instance, just launched their money market fund on it last week. It's a standard of token, and for those of you who think it's a bit wonky, everybody thinks of ERC20 tokens as sort of the foundation of blockchain technology. This takes ERC20 and builds on top of it a compliance layer, so that you can know who's trading the asset. If they're not supposed to be trading the asset, the trade will not atomize. The next level is, are there rules that need to be followed in a particular jurisdiction? Can this asset trade in India? If an Indian-based client tries to trade it and it's not authorized, it will not atomize. The trade won't happen. So all of the technology for KYC AML, for protocols in domestic markets, with domestic regulation, can be programmed into the asset itself. That takes a lot of heat off of what ledger you're going to use, how you're actually going to trade it, and it performs all of the functions that you would need to know to feed third-party systems downstream that are still on COBOL or some other package of software. That information comes directly from the asset. So it's rapidly gathering steam, and that's really kind of the message that we carry, is that there's really 3 layers of compliance. One is at the asset level. The second is at the level of the blockchain itself. And the third is on the off-chain systems that need to constantly be informed of what is happening with that asset. All of this can happen in real time. It happens anonymously within the market, because those IDs that are trading are numbers. You can't see who's on the other side of your trade, but the regulator can, because they have an instant access to that ID off-chain. So it changes the paradigm completely from ex post compliance, from doing an examination of a trade after it happens, to ex ante. The trade doesn't happen unless it's supposed to and legally able to do so.
To build up on 2 keywords which have emerged till now, velocity and stability of the asset. So Suzanne, there are certain asset classes which are inherently stable because they are slow to trade. That's the nature of those assets. Now if you tokenize this type of assets and you make them very liquid, you increase the velocity of capital within this asset class, which may probably give rise to certain risks which we have not envisaged, right, by the regulator, or by the academic community, by the technology community, and so on. What is your take on this?
Honestly, I think on this question, there's actually a few things to unpack here, right? I think we talked about not all assets will see tokenization to have efficiency, that's one. And 2, as we talk about some of these assets, maybe they are already illiquid to start with, tokenization might open up that possibility for just more liquid trade, but sometimes there's also a reason why it was illiquid to start with. So there's a few things here to consider, right? And I think what we've also noticed is that even as clients, or what we've seen in the industry, as assets get tokenized, a lot of times it's then what is the underlying problem you're trying to solve here. Because for example, when we did tokenize gold, then it's about increasing accessibility, which again, fractionalization then comes into play here. Then what we're talking about is then, instead of 1 million per purchase, you are breaking down that 1 million. So coming back to your question, the velocity seems to have increased, but if the problem statement that you're trying to address is to make it to be smaller bite size, then again, sometimes looking at velocity becomes a bit misleading, right? So again, there's multiple things to consider, and then ultimately, when we look at, tokenization of asset, and let's take out tokenization as a word, right? Issuance of asset. At the end of the day, when anyone wants to do anything on this front, you will look at, the fundamentals, what is the risk behind it, the legality on it, and then in some instances, maybe accounting comes into play. So I would say that there is it's not a simple answer to your question. There are multiple things to consider, and I think on the asset level that you're looking at, then that's also the fundamental part that comes into play on whether are we then really increasing that risk with increasing velocity. And then maybe the last thing I'll cap off is then, who is your end investors? Because again, if we are talking about I would say the boring part of this panel, again, esteemed panelists, thank you for the invite. If you are looking at my corporate clients, the rate to which they trade for some of them is not that fast. But if you're talking about the unregulated space in the Web3 ecosystem, weekends, overnight, so again, so multiple parts, hopefully I answer your question.
Yeah. Can I give
Sure,
a quick
please,
one?
please, sir.
I think it's not, I think we should look at tokenization as simply the next version of digitization. Did we stop digitization because velocity question? It was inevitability playing out. What I'm saying is that it will get digitized and it will get tokenized. Tokenization simply brings cryptographic guarantees and programmability on top of digitization. Digitization, we put it in the database, but with APIs. But we really are bringing a lot more programmability and cryptographic guarantee. That's all. It is going to happen to every asset. But what do we do if we believe, as a regulator, if we believe there's consumer protection risk or consumers, social engineering risks or any other risk, you can actually program cool-off periods and other parameters and make a checker and extra, sort of steps there to ensure that it's not like a one-click property transfer to somebody. You'd never want to see that in India because somebody is going to be taken out properties in no time. But that is a programmability that is giving you to the regulator. Regulators gets those controls that allows you to calibrate slowing down, but not stopping tokenization. Bring tokenization and program slowness. That might be the right way to do it. Yeah.
Point taken. We have 8 minutes left, so I have to just skip certain questions. So the next question is for all the panelists. So I'll start with Susan. And in the interest, because we have an audience all full of financial institutions across different domains. You have fund managers, brokers, you have exchange people, you have bankers and so on. Which asset class will achieve, according to you, full-scale tokenization on a global scale? And what would be the medium of exchange, preferred medium of exchange for this asset class? First question to you, Susan.
Okay, thank you. I'll be the first to bite the bullet here. Honestly, when it comes to this space, again, this is more of observation, we do see a bit more activity when it comes to, say, fund space. I think we've really seen that with the big players. That's how they got into, I would say, the Web3 industry as well. That's something likely we will see growing. And I think we have touched on a little bit about that tokenization of real-world assets that are a bit illiquid. There's real estate that pop up. I think things like this will likely see more momentum as we go, subjected to regulatory and again, legal guidance, right? And ultimately, I think there's one important part. What is that medium of exchange? So worldwide, you kind of see different trends. Of course, there is the non-bank issuers that kind of look at private money. And then, of course, from the bank perspective, what you have noticed that, from Citi to HSBC, we have launched tokenized deposit. And again, we are kind of going with the momentum on what's the need out there in the world. But I think I'll also be quite frank here, right? When it comes to tokenized deposit, we have spoke about it today. A lot of times it's still within the bank's ecosystem. So I think eventually, as we scale the space, and again, everyone in this room, we are in that pivotal, and I would still say that we are scratching the surface when we're talking about tokenization. So as we start out, you might see medium of exchange serving immediate needs to be tokenized deposit. Over time, CBDC might also get more popular. And again, private money might also come into play. And then the key part is then what is the interoperability across these three. And I think one last point to note is that when we talk about tokenization, everyone's talk about on-chain activity. And for everyone in the room, on-chain means on the blockchain, right? But actually, when we step out of this room, when you are paying, you're using UPI to pay, I'm using cash or credit card. And again, then what about the interoperability back to your traditional payment rails? Yeah.
Noted. Mr. Vincent.
Yeah, I guess where we're seeing, I'm echoing a few things that Suzanne said, but where we're seeing the most traction for tokenization is across a spectrum of less liquid assets. So case studies that I'm working on right now are a fund manager in Australia who specializes in secondary assets, buys 4 different steel fabrication plants, wants to create financing for that in the form of a bond and wants to tokenize that bond because he has Web3 native investors that are ready to buy it. On the other end of the spectrum, we're seeing a lot of momentum in the digital money forms. My personal feeling, and this is not representing my company, but my personal feeling is that stablecoins will eventually be supplanted by a more active market in tokenized deposits. Some of the case studies that we see in live examples, these are not just POCs, they're production grade examples. At Ant Group, for instance, at Citi, Standard Chartered, and Bank of New York has accounts for all of its legal entities. They can make those payments 24/7, just like you could through any other app. But what they get over and above a stable coin is that they get paid interest, they get the bank guaranteeing the deposit, and on the bank side, they get a much lower level of friction than they would if they had to go through payment app, SWIFT, down through the correspondent banking network, and then down. The transaction happens like that, peer-to-peer, counterparty to counterparty, without ever leaving the bank's ranch. Yep. It's all internal. So those two are the two extremes. In the middle, we're seeing a lot of interest in tokenizing funds, and that's why Apex, as the world's largest independent fund administrator, bought Tokeny. Because the funds kept coming to them and saying, how can we tokenize? And we would refer the business to Tokeny. And we said, why don't you just buy Tokeny? So we did. We bought it and brought it in-house. And we see huge momentum in that. People are looking for new avenues to distribute funds, whether they're in less liquid product, like real estate or art or something like that, or highly liquid product, like government bonds, ETFs, and so on, all being tokenized and put on chain.
Your answer would be music for Susan, because she's leading the tokenized deposit project for HSBC. She's very happy right now.
And I just met Susan today, but a couple of people in her reporting line are very good friends of mine, so we work together with them as well.
Yeah. Mr. Ghosh.
I'd echo what some of the other panelists have said, but I'd just go up a level and say what's really potentially revolutionary about tokenization is how it collapses boundaries. So to answer your question, I think when you look at it in terms of dollars, the volumes that you could get, say in tokenized cash, either as stablecoins, CBDCs, or deposit tokens, tokenized deposits, could be huge. And the other huge area for TAM is tokenized funds, but not so much mutual funds or real estate funds, tokenized money market funds. Because the money market fund as an instrument's been around in the US and now the rest of the world since the 1970s. But what do you hold in the money market fund versus your transaction account, whether you're an individual or a corporate? Transaction account is cash, instant liquidity. Money market fund is return. So in the world of finance, whether it's banking, investing, we have this distinction between return and immediate access. Put mutual funds, yeah, interesting, but put money market funds on chain, I get T-bill-like returns, an investment return, 24/7 instant access. And that is revolutionary. That is way more revolutionary than stablecoins. For geopolitical reasons, I think the world outside the G10, or particularly outside the US, not even the G10, but outside the G1, outside the US, are all going to build some form of CBDC wholesale rail in the next 3, 5, 7 years. And CBDCs used to be a solution looking for a problem, and we've found the problem. It's geopolitics and sovereignty.
I just wanted to jump right in and say, absolutely right on the money market funds. Some of the best projects we have in our pipeline are money market funds. I wish I could tell you more, but in the next month or two, you'll be seeing several announcements from us that are focused exactly on that segment for exactly the reasons.
We didn't plan this, by the way.
No, we didn't.
Yeah, actually, I have a counter to that, but we are short on time, so maybe some other day. So
I think when you really look at what people
at really next generation, young, global people, you need to actually look at money needs to be high velocity. We humans should be able to exchange money at high velocity. So there is no way we can get out of that part, one way or other, whether it's in the form of CBDC, stable coins, or anything else, any other form of wrappers, any other topics, it doesn't matter. Or even UPI in a next generation way. In one sense, people should be able to move money. So that's clear. Second, information will get tokenized. Watch for a very high velocity of information tokenization that's going to happen. Third, there will be significant growth in the new age areas like creator economy, entertainment, sports. All those will get tokenized faster because we are moving towards an ownership economy and so much democratization going on the creator and ownership economy. You will have to be able to tokenize and allow fractional ownership, investability into those kind of section. Then comes real world assets. And in the real world assets, we are seeing 3 areas that are globally relevant: property, agriculture, and machinery and vehicles, that side.
Okay.
Pretty much.
Sure. One more rapid fire question for all the panelists. Before that, Abhinav, you may please display the results of the poll on the screen. In the interim, I'll ask the question. Let's say 2 more minutes and I'll ask the question. What is the one blind spot? This question is for all panelists, rapid fire. What is the one blind spot about tokenization that you feel regulators don't know about that keeps you awake at night?
Because they think tokenization is about technology.
That's a blind spot for a regulator.
Totally blind spot. Because we taught them the wrong thing.
I appreciate the honesty.
We have to really understand what is quite like digitization. Tokenization is a movement. It's a way of converting any form of assets into verifiability and transactability. It's nothing to do with tech underneath. Yeah.
Good. Mr. Ghosh.
Obviously, our regulators have no blind spots, right?
Mr. Vincent.
No, I'd say the one thing is we tend to think about tokenization, stablecoins, all of the above as very much as they are today, as dollar-based products. That's just the first generation. It's not a blind spot, but it's maybe we're just responding to what the world is as now. Cryptocurrencies and stablecoins were dollar-linked or dollar-based, even though they were supposed to overthrow the dollar. The next generation can be rupee-based, can be AED, dirham-based, and people, not so much regulators, but inside state apparatuses. I was listening to an American security specialist the other day from an embassy in Asia talking about digital assets, and he clearly hadn't spent enough time thinking about how much control he could have over money flows. Because we did a client event in a major financial center in Asia, and he got up and said, this is going to facilitate money laundering and terrorism flows. And I was thinking, actually, no, this is the opposite. It's programmability. There's an issuer, there's an entity issuing. You can actually increase your control much more than cash or gold. I think sometimes people in governments who don't have a very deep, like my colleagues on this panel, technology understanding, underestimate that.
Fair enough. Mr. Vincent.
Yeah, I'm going to go ahead and side with the 2 panelists previously and say I think that the blind spot that exists is maybe more on the education side for some of the regulators themselves. Every regulator I speak to, and that's part of my remit, I speak to all the Asian regulators, Japan, and South Asia as well. And most of them have a couple guys on their team that are really clued up, really understand it, but sometimes that doesn't always get to the policy level. And so I think what we have to do is make sure that we just continue that, educating guys, asking them questions, what do you want? And as my colleagues have said, increase the transparency. Make sure that they understand that gives them greater control than they have over a fiat system.
Fair enough. Susan.
So interestingly enough, my answer is on screen. It's actually the point on liquidity. So I think, quick one, everyone thinks that the regulators, they don't know tech. Coming from a central bank and regulator, you will start to realize even in India itself, the regulators knows how to implement it. the technical controls and the existing financial controls that should stay. But what we're talking about in the end state of this world, if asset and cash is moving 24/7, today when I'm a bank, I do end of day reporting. How is that going to look like, right? And who is going to finance it from a liquidity perspective? Because from an end consumer, it feels like I get liquidity a lot faster, but someone is actually paying for it. So something to look at.
Yeah, nice. For the benefit of the audience, Susan was working with the Monetary Authority of Singapore before joining as HSBC. So let's quickly, yeah, she was the regulator and the central banker, yeah. Let's just quickly go through the audience poll question. So first question, what according to you is the primary benefit of tokenizing real world assets? We have a majority of votes, 48% on programmability, automation, smart contract. Broader investor access comes second, 22%. Lower settlement and operational cost. Settlement, of course, I have certain reservations on this. We can discuss it maybe after the panel. Next question, please. Tokenization of real world assets will first scale meaningfully in 72%, overwhelming majority, private markets, private credit funds, real estate. 13.6% believe listed equities. 1 vote believes government bonds, and 2 votes believe commodities. Next. In the next 10 years, tokenized markets will be dominated by this. Question was actually for the panel, but we put it in the poll. Traditional financial institutions, good news for all of you, 52%. Crypto native platforms, 5 votes, 23%. Joint ventures, hybrid models, 19%. Hybrid models is also what IFSC is thinking about. New entrants displacing incumbents, 1 vote, 4.8%. Next. Biggest risk to large-scale RWA tokenization is 47.6% legal enforceability of tokenized claims. This is the problem every regulator in every jurisdiction is facing. Some may have solved it to some extent, but this is the major problem faced by regulators across jurisdictions. Custody and key management, 23.8%. Fragmented standards and platform, yes, that's what we spoke about, 23.8%. And lack of genuine liquidity, one vote. Next, regulation will ultimately, overwhelming majority of you are extremely optimistic. Accelerate RWA tokenization, 76%. Slow it significantly, one critic, 4.8%. Shape it into a niche product, again, 1 vote. Make it indistinguishable from traditional securities, 14.3%. Good. Next. You should give us credit, sir, for giving the choices in the first place. Yeah. As on date, most of the RWA tokenization is best described as 47% genuine market transformation, great. 26.3% a technology upgrade to existing plumbing. Yeah, if we go through the centralized ledger route, yeah. 21% say repackaging existing products, wow. And 1 vote says experimental and premature. Next question, please. In 10 years, tokenization of RWAs will be, 57% of you believe that it would be core financial market infrastructure. Interesting. 28.6% believe important but limited to specific asset classes. 14.3% say it's widely used but mostly invisible to end investors. And okay, the last option has not received any vote. Great. Next. Good news for all of us actually. Does tokenization create liquidity or just redistribute it? 42.9% of you say creates new liquidity. 14.3% say redistributes existing liquidity. 38% say does both. And 1 vote says does neither. Great. So that's the end of the poll. Thank you very much. I just want the audience to know that all 4 of the panelists have flown in specifically today for today's panel. They have taken time off from their hectic schedules. Big round of applause, please. Yeah. And thank you, Susan, Dr. Verma, Mr. Ghosh, and Mr. Vincent. The 3 of them have flown in from overseas. Mr. Ghosh is a very busy man, so is Mr. Vincent. They are both based in Dubai, and they took specifically time off. They flew in, and they'll be flying back tonight, I believe, right? Yeah. Yeah. But thank you so much. Susan, thanks for flying in from Singapore, and thanks to the HSBC team as well. So thank you so much. And your encouragement and support has always been there right from our SEBI days. So thank you so much. We appreciate it. So that ends our panel, and over to you, Dhwani.
Thank you, Praveen, and thank you all the panelists. And the moderator who would like to make a presentation of the memento. I request Mr. Ronit from View Trade to present the mementos to all the panelists. Foremost, Dr. Pramod Verma. Mr. Ronit Ghosh. Mr. Vincent, Ms. Suzanne, and to Mr. Praveen for keeping us awake through the quiz and through the moderation of the session as well. Thank you. You can pose for a group photograph, please. Sir, you also can join. Praveen. Thank you. So without your caffeine break, we are going straight away. It's a live counter, so you can take your sip whenever you wish to, but do not leave the room more than 5 minutes. Yes, I'm going straight to the next panel discussion for the day, which is on global market access, navigating the future of cross-border trading. Amid accelerating global capital flows and AI-driven market transformation, the panel will deliberate on emerging models for cross-border access, with special focus on IFSC's recently revamped framework for global access providers and its implications for positioning GIFT IFSCs on a trusted gateway to global markets. Let me allow them to set the stage. Once you're done, please let me know. Sure. Okay. So, in order to start the panel, foremost, I welcome on stage the moderator, Mr. Neil Borate, Editor-in-Chief, The Fine Print. Let's welcome him with a big round of applause, please. Thank you. And to join him, our panelists are Mr. Tony Petrilli, CEO and founder, View Trade Holding Corp. Welcome, sir. Mr. Ashish Kashyap, founder and CEO, Ind Money. We welcome you, sir. Mr. Yoshi Yokokawa, co-founder and CEO, Alpaca. Welcome, sir. Mr. Shubho Maulik, CEO and founder, Appreciate. Welcome. Mr. Bhairav Mehta, head of Client Solutions, Interactive Brokers. Welcome, sir. And Mr. Somnath Mukherjee, Vice President, Zerodha. Welcome, sir. It's indeed an exciting session, and if you want that the outsiders have that FOMO, we can cheer louder. Thank you. And I hand over my baton to the moderator, Mr. Neil.
Hello, everyone. So it's wonderful to be here. I was told that the tickets, the registrations for this event were sold out in 2 days. And the kind of uptake has been absolutely phenomenal. And also of this space that for so long in India was unregulated, but caters to a very, very real need of Indians to diversify for various reasons. The first time, because of IFSC, is coming into the regulated space. So my deep thanks to them for making all of this possible. This feels like a moment in history because there are times, there are inflection points when things take off. I was a journalist with Mint for 6.5 years, and I've seen some other industries have these moments, but I think this is it for this industry. And I think you can see that from the folks on the stage and the kind of efforts that they have put in and are putting in. And I count myself as part of them because the magazine that I moved to, which is The Fine Print, considers global investing as front and center of our coverage. So let me start with actually the oldest player in the room in this space, which is interactive brokers. Bhairav, if you can tell us a little bit about your presence in India for quite a long time and how that's going to change now with GIFT and global access.
Sure. Thanks, thanks Neil for having me. While the firm is probably the oldest here, but I feel I'm the youngest on this panel. So good afternoon to everyone. I've been in the space for over 7 years, and I'm seeing this global investing transform from good to have product to a must have from an Indian resident perspective. For the longest time there was no regulatory framework in place in India, but with GIFT and IFSC coming into picture and providing that regulatory cover to advisors, to brokers, and fund managers, it's just made things easier. And I think we all are working towards one objective, and that is to make global investing more accessible to the Indian population. That's where.
And I think they'd be glad to know that you guys are also moving to GIFT and being part of the global access.
Yes. So yeah, we obviously are wanting to set up our operations in GIFT, and we are working towards that, and we would like to be a part of this growth story. One thing I like to highlight in terms of IBKR and our solution specifically for advisors. As an Indian, we are well diversified. Most of us are well diversified in India, and but when it comes to global investing, most of us talk about the Magnificent Seven or the FANG stocks, but there's an entire universe of opportunities lying outside of India, and that's where advisors and fund managers can sort of bridge that gap and provide meaningful advisory to Indian clients to have a sort of a well-balanced global portfolio. And so I see a lot of scope and specifically for advisors, fund managers, and brokers for that matter. And one thing I'd like to highlight in terms of IBKR is that we provide access to 170 markets that we are a part of across 40 countries through a single account. And 2025 has been a great year for our clients. S&P gave a return of 17.9%, but advisors on IBKR generated 20.57%, and hedge funds were at 28.9%. So clearly, it was a very successful year for our clients, and I believe that will continue. I strongly believe that will continue in this year and in the coming years as we focus on building technology and providing access at very low costs.
Sure, thanks. Now let me move to some of the newer players on this panel, at least to the Indian scenario. So Yoshi, if I can go to you next. If you can elaborate on Advaka's plans for India in terms of investments you're making into this business, and how do you see this going forward?
Sure. Hi, I'm Yoshi. I'm co-founder, CEO of a company called Alpaca. We are United States headquartered clearing broker-dealer, offering our services to hundreds of retail brokers around the world in 45 different countries. Also in India, we work very closely with my dear friend Ashish, IND Money. We've been working together for almost 4.5 years, so we've been here for a while. And then we recently made a decision to acquire.
But indirectly, so now you're directly present.
Yes. We recently acquired Zinc Money in gifts, and then we now have 5 persons fully operating, functioning in the gift city. So last year's regulation clarity really made us to make a huge step forward.
So can you elaborate on why you're bullish on this space? What your plans are in India on growing the business?
Sure. I mean, while working with so many different countries, broker dealers, obviously India is the biggest market, as everyone agrees. And then I think the country is now really changing, moving forward, creating clarity, and clearly this energy in this gift city, as we see each other in this room, is extraordinary. And I'm super excited, all the people that I talk with, in this gift city, and then also, mainland India, they really changed their attitude. So we definitely see the huge changes coming in, next 12 to 18 months, and we want to be a center of that.
Okay. Now, if I may turn to you, Som, I think ever since Nitin announced that Zerodha has plans to get into this space, everyone's been watching very closely. So if you can start with telling us, to the extent that you're able to explain, your Zerodha's plans in this space. Sorry, is he audible?
Yeah, now, sorry, yeah. So, no, thanks so much for having me. So, we've been tracking this space for a long time, actually. We've spoken to most of the people here. So the thing is, I think till 2025, a lot of the things that we couldn't control were kind of not clear, like regulations being one which you pointed out. So I think IFSC came out with the gap license, which made it very clear that now we can partner with global brokers. Payments was a big pain point as well. A lot of banks now have made it kind of online to do the LRS remittance also. I think GIFT is now even PSPs are now kind of licensed here, so that's kind of clear as well. But so now,
do you already have these licenses or plan to? What's the?
So no, we haven't. I'm just saying IFSC has made it clear that they've given the licenses. Everything's clear now. So now I think it's up to us, people with distribution, on how we want to kind of. So again, I think wealthier people always had access through wealth arms, but it's just retail who haven't had access till now. So I think now it's up to us to kind of build on content around communication, around things like why diversification is necessary. With now the way the world is going, it's kind of going in a very de-globalized kind of manner. I think it's become more important to kind of not keep all your eggs in one basket, one country. So to communicate that well, also to give support around not just product support, but also compliance support. I think taxation is one aspect which people are generally scared of. Retail investors, again, don't have access to a CA who they can call right away, and if they're scared of something, so that's something which is a pain point as well. I think most retail investors don't even pay advance taxes. So yeah, now it's the last mile delivery, which probably players like us can solve. So yeah, around plans, now that it's clear from SEBI also, we can offer third-party products. That also kind of came out last year actually. So until last year, brokers like us couldn't offer any unregulated SEBI products. So things like whether it's US stocks, whether it's something like fixed deposits also from RBI, we weren't able to offer such products. So now it's kind of clear that you can have a separated out window with disclosure saying that, you're not allowed to go to say scores or the SEBI grievance redressal mechanism with all the risks in place. So yeah, that's how we plan to offer it with a US broker, through the exchanges as well. So yeah, hopefully April or May, something should come out.
All right, so that soon, April or May, you guys will launch.
Hopefully, yeah.
All right, and presumably you'll partner with one of the players on this panel.
Right.
And do you want to elaborate a bit on, would it be on the Zerodha app? Like how would the experience?
Yeah. So we'll follow the TPP regulations to the T. So the plan is on Kite. You see 8 market watches currently. We open up a 9th one which says US stocks. You can search for stocks. The order form looks slightly different. So again, you see it in dollars. So we separate it out everywhere on the reporting side, on console as well, on Kite as well. And yeah, so yeah.
So separate sections, but same app.
Correct. Same app. And hopefully we'll also have, so we use, if you're aware, we use the Jori Finance for fundamentals. So, hopefully have a screener as well where you can screen out stocks, do your research around US stocks. So that can also be a value add support. But yeah, on Kite, on console, you'll kind of see a separated zone for your US stocks.
Okay.
Yeah.
So Shubho, you guys have been making strides in this area over the past year and a half.
Yeah.
How has your experience been so far, and going ahead, how will things change?
So look, I think when we started focusing on international diversification, it was still a little ahead of the curve. I think, there's a sea change. You have players like Zerodha and Siddharth coming in, you have other players coming in. I think if you really want to get true retail adoption in India, you have to figure out how you get mass distribution. So for me, having Zerodha come in is great news. It's a great signal. But you also need to enable much smaller brokers, right? Because even the largest brokers today don't have a huge market share. So I think we're quite focused on what does it take to really provide a turnkey solution. That means that every broker can provide this, right? I mean, so that you guys have tech teams, you guys have compliance. A smaller broker doesn't have the bandwidth to do that. So how do we provide, or an advisor, for example, how do we provide a turnkey solution so that everything from KYC, compliance, tax, the tech, so you reduce time to market, even marketing and engagement support, because the reality is that when a new retail investor comes in, I agree with that, there's education, there's engagement. So we're really focusing on providing that entire turnkey solution out of the box, and actually a bunch of people here will be partners. So, it's not all competition, it's also developing the ecosystem. And so we're quite positive that it's going to be a pretty good set of 2 to 3 years.
And you would include India's very large number of mutual fund distributors, insurance agents also into...
Absolutely. And I think just to talk about pain points, right? So if you look at, I'd say 3 really key pain points. One is remittance. So we've actually spent over 4 years solving remittance, having completely digital one-click remittance journeys that are compliant. There's education. So we've worked significantly on figuring out how to use technology to give recommendations and really educate folks. And finally, there's the whole piece about compliance, right? And we have to thank IFSC for making compliance clear, and then we enable compliance. So we think that the real wave is going to happen like it has with every financial product with distribution access. And that's now going to happen any day pretty soon.
Okay, so 2 very interesting points, remittances and compliance. I want to quickly go around the panel. How low do you guys think remittances can go as a percentage charge on, let's say, a $1,000 remittance? So right now I would put it at 1.5%, right? Roughly thereabouts, or even 2% in some cases. How low do you think it can go? Just very quickly down the panel. Bhairav, starting with.
I think that's more on the banks than on us, but...
Just make a guess.
I think it can go down to 0.2%, clearly, because, especially here, because now the money is getting aggregated here, and hence it becomes really efficient. And if you start a world where SWIFT is out and gets disrupted, it can actually go down just like an Indian PG, right? But with some risk on the Forex volatility. So it can really, really go down.
Yeah, I mean, I think if you can get tokenization going, I think you can really bring costs down. But I also think it's not the right question, Neil. I think the right question is total cost of transacting. Because there's no point saying, oh, I got remittances down, but my brokerage charges or advisory fees are up. I think the whole point is how do you get total cost of transacting down?
Sure, brokerage charges are already quite competitive. 0.2% is sort of the going rate.
Yeah, but if you bring remittance down, do you take brokerage up? So there's always that pull and push. So I think we can get to a pretty low cost transacting environment.
So what would you put the number at, total cost of transaction?
0.2 to 0.3 or even lower, right? Because I think what you can make money on is actually advisory. I would personally say make transactions close to 0, make money on advisory.
Yeah, and probably with Zerodha coming in, it will probably go to 0. So
if they take it to 0, then I mean, by the way, for example, today on the B2C offering, we have 1 rupee, right?
Fair. Tony, if I could turn to you now. So you guys have been very early to gift and to this process before, I think, most others. And you have an interesting, different route that you've taken. So you've adopted something called the omnibus structure. I think very few understand it. So if you can elaborate on your journey and the route that you've taken.
Yeah, we take a different approach. India deserves its own way of doing things. And a lot of firms will come to, we do business in 32 countries. I've been doing this since 1982. And we've opened up markets all around the world for millions and millions of people. Every country is unique and should be respected that way, as a unique country with its own unique aspects of how they want to conduct global business. one of the things that I always found perhaps offensive is when a foreign firm comes in and tells you how to do something. Right? Do it my way or don't do it or you can't do it. No, that's not the answer. So the approach we take is a solutioning approach. We came here very early and we began working with the IFSC and the team and understanding how we can in fact construct a process of doing business in India that worked for India and met the requirements of India and quite frankly the objectives of the IFSCA, the whole purpose of Gift City. The idea of Gift City is, I don't have to tell you, you know better than I, is to be a global financial center. Well, that's what we're going to help you do. That's how we're focused on it. It's a two-way flow. It's where capital meets. It's where investors meet, right? So how do you do that? Well, we took the position day one to say, we're not going to open, so let's back up a little bit. Up until this point in time, if you wanted as an Indian resident to get access to a global market, you had to open your account with a foreign broker. Wrong. I strongly discourage that with every one of the clients I talk to in all the countries we work with. The customer, the end customer, in this case the Indian resident, should keep their account in India. And not only keep the account in India, but operate it under the same rules that they trade India. Same regulations. In this case, we have the fortune of having a great unified regulator, which makes it a lot easier. And I'll be frank, without IFSCA being formed, Gift City, we may not be here either, right? Because it was not going to work under the old regulation, but under the new Gift City regulation, unified regulator, open-minded to global market flows. So we're going to offer now, we're offering now, in fact, we work with many of the financial service firms in India, as well as with the exchanges, to offer for the very first time in the history of India, a global access account based in India, which is where it belongs, right? And that makes us now focus on our clients. We are B2B2C. We don't go directly to the C. I know there's questions in terms of where fees are. We don't set the fees. The fees is a function of the business model of the business that's servicing the client. And there's many different business models and many different needs that need to be serviced. You have advisors. You have people who just want to day trade very quickly. You have people who want to invest over the long term. You have all different types of constituents, what I call constituents in the market at any time, representing their own business interests, their own investment objectives. We want to cater to them all. And that means we work with financial service firms who are focusing on those, and they set the price based on the value that the customer perceives. It's not about zero. It's not about trading for nothing. It's about what are you getting for the services that someone's providing to you. We're an enabler of that objective of that financial service firm, and at the same time, therefore, enabling the person who's that entity's customers to achieve their objectives. That's the approach we take. So today we have about 60 people here in Gift City. We're licensed here. We were the first to get the global access provider license. We continue, and we very, very, very much want to be part of the financial service industry in India. Not a global broker, not an American firm, not a UK firm. We want to be part of the financial service industry here, and we're going to continue to work towards that, to those objectives with the financial service industry and the regulators in India. That's where we're different.
Sure. And you guys are also powering the two exchanges, National Stock Exchange and Bombay Stock Exchange, right?
Yes, we are. Again, we don't talk about our clients too much because it's their business. Our job is to enable their business and their brand. But yes, we're working with the exchanges. We do business in 22 countries in terms of markets and asset classes. We have clients, as I said, in 35 different countries, all big institutions. We believe in the incumbents. We love the incumbents. They created the industries. We want to service them. We want them to be able to have the modern technology, the modern approach to capture the transition of wealth that's about to happen from the parents and grandparents to the next generation, that they think differently, they want to approach. We help them with that through technology, operations, business process outsourcing, and of course, at the end of the day, a license to do the brokerage in the offshore markets where they're not present.
Right. So Tony, if you could break this down in as simple terms as possible, what is the omnibus structure, and what is it?
Okay, so omnibus structure is, as an individual, you open your account with us, and you don't have to worry about where you want to trade ever again, right? In other words, you open your account with our client, I should say, our B2B firm, who you're working with. That account is open with VTI FSC here in India. And you don't have to worry about where you want to trade. You want to trade or what asset you want to buy or what currency you need to settle in. You have a single account and you trade. That's it. We, as a corporation, open up omnibus or corporate accounts around the world so that we can access those markets for you. Now, there's huge advantages to that, okay? A lot of people don't know, and I don't want to dominate, I don't want to take the whole panel thing, but I could speak forever here.
No, it's a new concept, and I think it's important that you explain this so people understand.
So when you open your account in a foreign market, you're subject to laws and regulations of that country, right? You're subject to, if it's in the US, you're subject to the estate laws of the United States, you're subject to the courts of the United States, on and on and on. That's what happens when you open up an individual account. As a corporation, I'll take on that burden. As a corporation, not as an individual. I'm in a much better position as a corporation to represent the interests in those particular countries, to work in the legal systems of those countries, to protect the assets that you have, to hire the lawyers if I need to get your assets back if there's going to be a problem. As an individual, you're not going to have any real ability to do that. So what an omnibus simply is you open your account here locally, it's your account here in India, and we take care of all of the legal, technical, regulatory, and all the other complexities that exist all around the world for you. It's completely transparent to you. I mean, you don't even see it. You just know that you're trading here as an Indian resident under the laws of IFSC, the regulations of IFSC, and that's it. I guess that's the best way to frame it.
Sure. And in terms of concrete benefits of this structure, one, if you can explain how US tax does or does not apply, estate tax.
Well, again, if you open your account today and you have your account in the United States and you unfortunately pass away, good luck getting your assets back to your beneficiaries, right? Because if you have assets greater than 60,000, you're going to be first, before you can even get that asset, first you have to say, did you find a beneficiary that someone can rely on? If not, you got to go to a probate court, which means you got to hire a probate lawyer. Then if your assets are greater than 60,000 or not, forget probate. Before those assets can leave the U.S. broker and come back to a beneficiary here, it's got to get a tax certificate from the IRS, meaning you got to go in front of a judge, and the judge says, do you owe any taxes? If you don't owe the taxes, no problem. We'll give you the certificate. Now you have a certificate in hand, assets greater than 60,000, subject to estate tax, starting at whatever, 28% up to 30, 40% of your assets goes paid to you didn't know you were married to the U.S. government, but you were, because they're going to take 30% of your assets before they even leave the United States. If you open that account here, you're subject to the laws of India, the inheritance process in India, and you don't worry about the U.S. because as an omnibus, as a corporations don't die, corporations don't have estates. Your accounts, as far as the world knows, you have your account here, and I'm a corporation there, so you can get your assets much more quickly. You don't have to go through all this legal morale, which none of you know. I mean, you trade in the UK, you trade in Singapore, you trade in the US, you're subject to the rules and regulations of every one of those countries. Omnibus, you're not. You're subject to the rules and laws and regulation of the country you live in. That's the subject.
Yeah, I think omnibus is really like, because it's really concludes inside of India, so the end customers really don't have to worry about or less worries about what the US requirements are. I mean, US, if you are US exposed, same thing as IRS, but there's a FINRA specific requirements that comes through here. But in the omnibus, you may not have to worry about it. And that's a big benefit. And the second benefit is obviously because it just simplifies a lot of things. So, which means it could be less cost for this whole ecosystem, which of course trickle down to the end customers and individual customers. So, which is, I think, could be a good thing for the retail customers.
So, are you also adopting this model?
Yeah, we can do both. We can do multiple layers of the models, including omnibus, yes.
Yeah, but just touching on what Yoshi said, yes, I was talking about the back end, but from a trading perspective, if you have a U.S. account, you're subject to the U.S. rules. Do you guys know what good faith violations are, day trading regulations are, liquidity Reg T? No, these aren't rules you're ever going to know, but those are the rules you're subject to when you open up a U.S. account. You open your account here, you're subject to the IFSC rules and regulation. You don't have to worry about any of those things as it relates to the United States. I guess so.
Okay, Shubhu?
Yeah, I think just to echo the advantages of actually being able to net settle in India on an ongoing basis and therefore simplify the intraday trading experience for some people. I think that's actually a pretty useful feature. We think that that'll see some interesting demand. So, time will tell, but as we can innovate and offer more features, the better it is.
Yeah.
So of course, I'm given to understand that this is still a matter of perspective, right? There is legal arguments for and against this particular structure. If anyone wants to come in on that, happy to get
to put it simplistically, because we work with my friend here on both the models because of transition. At a simple level, think of it that a consumer earlier would conduct a KYC with us and a KYC with Alpaca, which means his account sits individually with Alpaca. In this new structure now, the consumer conducts a KYC only with us and with a IFSC regulated entity per the laws of the land. And in this structure, the consumer's money comes and sits here, in a IND money wallet, for example, and not with an Alpaca wallet. And that is actually disproportionately different, because which means that the whole money movement rails completely change.
But Ashish, if I may, the custody of the money and the stocks remains in the United States with an escrow, right?
Custody of the money for an investor remains here, but then
there's no escrow bank in the US?
Because at the end of the day, there's a settlement, right, which happens. It's like the way, to put it simply, as I was telling you, it's like if I'm buying today's date an Apple device, I'm actually buying goods as a distributor from somewhere, right? So it's in a similar way, right? Then the other concept is custody and clearing. Yes, that is in US. And I also actually want to just tell you that there was a very innovative thing which the IFSC regulator and NSE had done here in India, which I was personally very keen about, which was a UDR product. We talk about something called tokenization, but actually, Arjun sir, you had done tokenization way back, right? And it didn't kind of take off, because I think, if for everything there's timing, right? Because it was a little early in the game, and also there was limited number of securities. It required a lot of tech to be built, which we couldn't, because of course there were multiple players. But long story short, that's what the whole custody argument is, which also I think we players here will, now that Alpaca is here, etc., we will find solves for that also as we go along. I mean, will there be a parallel of an Indian DMAT? 100% possible out here.
But does the US permit custody of stocks and money to be held outside the United States?
No, so it doesn't. So it had to sit at the DTCC, which is the Central Clearing Corporation in the United States. But what can be done in different countries? What happened is, for example, depository receipts type of the thing, or like in Indonesia, there's a thing called PALN structure, which are kind of non-leveraged CFD product that's backed by one-to-one to the actual US security. Tokenization very similar, but that can be done in a way, but it becomes a little bit of another layer. So as long as Ashish and the IND money is doing the correct treatment of the cash and securities domestically, even for the foreign securities, it's been working correctly, and I think it's pretty smooth too right now.
Yeah. So Neil, I'll just like to add to what Tony just mentioned. At least at Interactive, what we've done is that we only offer products that are permitted by the local regulations. We, in terms of Reg D, like you mentioned, in terms of those rules, I think that wouldn't be applicable to Indian residents, because we anyways offer them like a cash account, which works like a prepaid account. So yeah, that's something which is taken care of, at least at IB. And in terms of estate taxes, what other option also is the non-US products, right? So at least, we offer UCITS, EDFs, etc., which are those non-US products which are available. And I think this omnibus model, I think, Tony, I think that's pretty interesting, because once we have a gap license, probably, we'll also explore that as well.
Yeah, but rightly said, there are other solves to it, like UCITS, right, ETFs and funds and so on. Right. Now, I want to turn towards the other segment of Indians, which is NRIs, and how you guys can solve for them as well. Shubho, can I start with you?
Yeah, so we're quite excited on the potential for GIFT to be a two-way access gateway. We think that there'll be pretty significant NRI demand, and I think IFSCA has plans to simplify NRI onboarding further, as well as allow foreign citizen onboarding. And so we are actually on track to launch sort of an inward rail and product, leveraging sort of our payment service provider product, as well as partnerships with some folks here, to really say that, look, this can actually become, especially for the diaspora, a pretty interesting proposition. I think that you'll see far more two-way flows than you have in the past, especially as the India story starts getting more traction, and it becomes much easier to do this versus the alternate path, which is a regulator account on the mainland. So quite bullish about it. You should see some announcements from us in the new financial year.
So if I could dig a little deeper into this, actually, because I have spoken to a lot of NRIs in the past several months and years, and even for their global investing, they trust Indian institutions. So even if somebody sitting in Dubai wants to invest in the US or Europe, they would much rather go through an Indian broker because they are familiar with the Indian system and they trust the Indian system. So that's where I want you guys to come in on. Are you building anything for Indians outside India but who want to access the world, not necessarily only India? Anyone?
Yeah, I mean, I think so. We are just working towards it. There has been regulatory clarity on the KYC, which actually has been going in circles, even in the Indian jurisdiction. But there is now some clarity. So we've started obviously onboarding for our India-facing side of it, but we are going to replicate that for the global investing. We are also right now working on building those complicated rails, because see, this whole investing business is not just about the trading engine or the investment engine or the OMS or the RMS. It's also the banking rails, which which I think a lot of people didn't understand when we were launching. We said we want to solve that and leave the rest to an Alpaca or someone to kind of solve, right? And we're doing the same thing right now for NRI, right? We got to solve those rails, so that how can the money, a person sitting in Middle East, how can he populate his wallet in a compliant manner, in a fast manner, and how can we do the settlement, etc., right here in GIFT City? So there is work happening. For us, I think the value proposition is, because we are an investing first and not a trading first platform. Value proposition is investing diversification for NRIs in a single place, tax management for them, and so on and so forth. So that's what we're right now building.
So you will enable global investing for NRIs?
Yes. I'm very excited, right? We're going to celebrate here the day the first dollars or dirhams hit here.
All right, fantastic. Tony?
I mean, we're enabling dozens of firms here in India to tackle the NRA, to bring them back home, so to speak, right? And to provide the technology, the compliance, all the things that are needed and able to facilitate that. So always think of, our job is to enable. Okay, our job is not to take someone's client. Okay, it's not to say this is our client, we're going to do something for it. We're here to enable the financial service firms around the world. NRIs are already with many firms that are clients of ours already in other countries. They would be interested in coming back home, and now that they have the option of doing it, I think we're going to see some good uptake.
Right, but what I understand is there are, of course, potential regulatory challenges with that. You might need to have registration with the regulators of those jurisdictions. So is there a solve? How do you guys?
Yeah, so I think specifically in the broker dealer sector, what we have to really think about is very big two things, right? One is investor protection, and two is the maintaining the health of the capital markets. And I think what you're talking about is more of the investor protection. So if the NRI person is, for example, in the UAE, who cares about investor protection would be the government of the UAE. So it really depends on how the UAE government thinks about the investor protection, and which is not black and white. It's some country cares about it, some countries may not care about it. So that's the whole thing about investor protection, where it goes to. And I think usually, as Tony was saying, and then Ashish is doing, companies who deal with the NRIs in different countries kind of know about which countries are doing what kind of investor protection requirement. And that's usually something that we've witnessing as an infrastructure company.
So are there particular countries that you guys think will give the most flows of NRIs? Som, do you want to attempt that?
No,
You're building a separate solution as well for NRIs. I think Nitin announced. So
So no, we're super excited about the NRI space in general, whether it's in the domestic India space or through GIFT. So we also, firstly in GIFT also there's I think the GIFT Nifty future contract is getting quite a lot of liquidity since NRIs come in with dollar denominated, taxes are lower, so that can be a popular product as well. So that's something in our roadmap. And apart from that also, the KYC rules was just relaxed. I think the Aadhaar requirement is still there. From what we see, I think only 10-20% of our NRI clients have their Aadhaars linked. So I think if that goes away, that'll be super helpful. Apart from that also, we have a few startups that through our Rain Matter initiative, through whom we've partnered with. There's one called Rupee Flow, who are working on the FDs for, the NRE, the Forex denominated one. They also do a digital notary, so to onboard them easily to get their KYC docs notarized.
So if you could elaborate on that a little bit.
Yeah.
Because what I understand is...
Oh yeah, we had spoken about that.
Yes, yes. So an NRI who does KYC from abroad has to have notarized copies of his or her original documents, which have to be certified by either an Indian embassy or a local notary. And that's something that your
so it can be a foreign embassy as well, so an Indian embassy abroad. So so they've done that through a webcam kind of video who you can set up with a licensed notary, show them the documents and get that doc notarized and then submit it.
But is it correct to say that if they come through GIFT, then it's only video KYC that's required?
Correct, but unless the Aadhaar is linked. So
I think the passport substitution for Aadhaar is potentially a request that's been made, which the regulator is considering. And I think the notary requirement, whether it's video or physical, goes away completely. Also, I think, just to respond to Yoshi's point, I think it's a good point, but because if you target diaspora, right, they actually have a legal basis in the relationship, and therefore the regulator, you can say naturally, is GIFT, right, because there is reverse solicitation. So I actually think all the barriers, and we've had this conversation with multiple folks at IFSC, are systematically being taken away, right? I'm equally excited. We think that this could be, and whether it's into India, whether it's into another market, whether it's into the US, there is some comfort you can give folks, and if you can basically fix the rails, I think this is a pretty great opportunity to drive a segment that hasn't really been driven before.
Okay, so let me dig into this concept a little bit more, which is reverse solicitation. So from what I understand, if I am sitting in the UAE, or if I am sitting in Mexico, taking a random country, and if I myself approach your platform, then you don't need to be registered with the local regulator. Is that broadly correct?
So Neil, so the expectation is that you should be sort of regulated in the country where your clients are coming from. You can't have unlimited clients from region where you're not licensed. Let's say it can't be a situation where the advisor is licensed in India, but he's getting all their clients from Dubai. Obviously, reverse solicitation comes with certain limitations. So at least for advisors and fund managers, I think for them, a fund structure works really well, where they can just set up a fund in GIFT, and that fund can sort of bring in all those global investors, and then that fund trades global markets or whichever markets that they want to trade in. But I mean, if you want to do those managed accounts, I think that will always be restricted, or you'll need to get yourself licensed in countries that you potentially want clients.
Tony, you have,
and I would,
I think that's.
You're right. I mean, look, reverse solicitation. You have to again respect the regulators in every country, and many of them do have prohibitions in terms of soliciting. Again, we solve that by giving and helping our clients have the technology they need to carry those accounts for global access themselves. So the client never leaves, the customer never leaves that country. There is no reverse solicitation because they're working with their local broker, who's our client. We give them the technology stack to carry those accounts, and now you eliminate the need. In other words, we're not...
No, Tony, but I'm saying if I'm sitting in UAE, right, but I am picking a broker that you work with, in India? Because I'm familiar with the Indian context.
Yeah.
Can I do that?
Yeah, you go to your UAE broker and you open an account for access to whatever market you want.
If I may come in, so I think there's a slight difference. If you have an Indian passport and if you have an OCI card, you actually have locus standi from a regulatory perspective, you're multi-jurisdictional. If there's a US citizen in the US, right? There's obviously, I agree, there's a limit to how many US customers you can reverse solicit because the SEC is going to say, hey, like, this is not okay. But given that there's a locus standi, and this is the importance of marketing to diaspora, there is an actual jurisdiction overlap, right? So that's, I think it's two answers. If you're a foreign citizen, there are limits to reverse solicitation. If not, there's actually a link back to India.
Yeah, I would, again, maybe it's a fine point, but solicitation has nothing to do with citizenship. It has to do with residency. Where you're resident at the time you're looking to open the account to transact. I can be a U.S. person sitting in India, right? Well, U.S. citizens are a little different. But the point is, it's a residency test. It's not a citizenship test. So if I'm in the UAE, I'm not being reverse solicited because I'm an Indian citizen living in the UAE working with a UAE broker. That's not a solicitation.
I think investor protection, easy way to think about it is that you are, Indian citizen or NRI sitting in UAE. When something bad happens, where are you going to make a claim? Right? And then that's okay, people, if you're living UAE, you feel like, okay, it should be UAE. Let's go to the UAE regulator. And they find out, whoa, I don't know this app, right? Then UAE government gets in trouble. Okay, what is this? What's happening? It's someone's messing around our residents. So that becomes an issue about investor protection. So that's how you can kind of think about it to simplify.
Sure, but to answer the question about if I'm living in the UAE and I myself come to you guys to open an account, would you say yes or no?
I think that depends on the platforms and companies. It's really coming to the internal probably risk procedure. Some companies may say yes, some companies may say no. Again, it really depends on, is it UAE or Mexico? Maybe you are in Japan.
So I'm taking UAE because that's a very large section of the Indian diaspora. So it's country to country is what you're saying. Is that right?
Country by country, company by company. That's at least my experience in this. Yeah.
Sure. Ashish?
Yeah, look, I think very clear, if you come to us, then we'll open the account, much like what happens for the Indian leg also. We don't do any solicitation there either. But our view is that finally the right way to do it is that we need to have some kind of a pooling or a vehicle in each jurisdiction at scale. Otherwise you can't. And for that you need to get licensed in those jurisdictions. And let's say if that happens and if it plays out, then all of those international jurisdictions for a company like us will be subsidiaries of the gift entity. And in a way, it kind of also comes under the purview of the regulator here. So that's how we look at it. So long story short, get started, much like any internet company, and don't do aggressive solicitation till the time you have some standi there in those countries and you have your local accounts there. And then once there's traction, then you got to build it formally.
Yeah, I'm going to give you the consumer perspective here because until now, thousands, maybe lakhs of Indians have opened accounts with international brokers. And it's not like I would go to SEBI if there's an issue. I would presumably go to the SEC if there's an issue. So in a sense, they've solicited our people. But Som, let me come to you as a lawyer and as a last word on this. Would you say yes or no? I'm sitting in the UAE, I go to Zerodha and I open a global access account.
Yeah, I think they should be able to complain to the gift, wherever Zerodha is located. So I think, it should be fine.
Should be fine.
Yeah.
Fantastic.
If you do your AML checks and all that, PMLA, where the funds are coming from, if you do all those checks, I think it should be fine.
Awesome.
So when I have similar views.
Fantastic. Okay, now in 5 minutes, I'm going to open up the panel to the audience. I always do this with all of my panels because I don't like it to be a monopoly. So if you guys have questions, please think of them now and raise your hands. We will come to you one by one. Now for the final part of my part of the panel, we're going to talk about regulations and where they need to go. In my view, probably the biggest problem today in the regulations is the ambiguity around purpose code. So essentially, if I am an Indian and I want to build a dollar corpus for my kid, and I would be happy to use a gift fund, or I'd be happy to use a US ETF or a European UCITS ETF, and I build it up over 5, 10, 15 years, at the end of it, can I use that money for the education of my kid? And the answer, as per some interpretations, is no. The other answer is it's gray and it's ambiguous and there needs to be clarity. But I hope that as an ecosystem, at least we push for some.
Yeah. So I think the people, okay, my opinion, right? So I think the folks who say that this is a gray area, the answer is no. I don't think that's accurate. The purpose code is applicable when you send money out, and there are conditions on investing it within certain time periods. Of course, and this is a completely allowable use case, right? The RBI allows that. Once the money is out and it's invested, what you do with proceeds, again, as long as it's not going into an unallowed use case, right? You can't, liquidate that and put it into crypto, for example, right? But it's going to education, which is also allowed. I don't think there's any gray area. I'm happy to be contradicted by the panel on that, because, that's the simple reading of FEMA as it exists today.
Do we have better?
Yeah, Neil. So I agree to that. And in fact, now with GIFT, now that you can open dollar bank accounts, it's become easier for an Indian. So let's say if I am investing in global markets for, my children's future studies, I can actually withdraw it. I can open a GIFT bank account, withdraw it back in dollars, and then make those payments that I intend to make, which was not the option that we had for earlier before GIFT came into picture. One thing that I'll also, you're talking about regulations, and yesterday,
No, sorry, Bhairav, just to get your interpretation on this. So let's say I've built this bank balance by investing in a US ETF. I've redeemed the ETF now.
Correct.
Can I use it for education?
Yeah, but you're redeeming it, you're getting it back, and then you're making those payments, right?
Getting it to a gift bank account.
Gift bank account,
in
and
dollars.
then making those payments, right? So I don't see that as
No
an
problem.
issue. But,
Okay, go ahead.
I mean, but yeah. So one thing that probably IFSC or things could be simplified from an Indian resident that's investing in global markets is the Schedule FA. There is so much. It's a nightmare to fill that Schedule FA. So if that's just a feedback and something. If a Indian is investing through, let's say, a GIFT gap licensed entity or any licensed entity in GIFT, I think if IFSC can propose something which can make the Schedule FA a little more streamlined and simplified, I think that would be a very good. Initiative, and it could.
Yeah. I quite agree with you. In fact, the direction of travel on this has been quite good. Some of you who've tracked the space would know that now up to 20 lakhs, there is no penalty if there is a undisclosed foreign account or balance. And this budget itself, they introduced a special window for disclosure where if it's just a technical mistake, then it's a 1 lakh fine rather than earlier it was 10 lakhs. So the direction of travel is good, but you're quite right. It needs to be a lot easier because this is completely tracked money from the point of remittance to the point of return.
In Schedule FA, I mean, there's some field called as peak value. I sort of don't understand why we, having that. I mean, you literally have to go down, you got to see the stock that you invested, you have to see what it's called, what's the 52-week high, and
Your pains apparent.
No, and not just that, as per the SBI TT rate, which is not on the SBI site.
Exactly.
So you have to...
It's, that's a nightmare for an Indian resident who's investing globally. So I think that's something which can be simplified and made life easier for all of us.
Yeah, we had to build those automations on our app because at some point of time at scale it became messy. I want to answer your question, controversial. I believe that if you're investing under S0007, which is for equity investment, and especially if we are doing it through this regulated rails of IFSC GIFT, I believe that it should be a closed loop system. And the appreciated dollars need to come back and should come back into appreciated rupees, and then only the real value of this ecosystem, gets demonstrated. Because The other use cases, whether it's travel or education or just saving, are just different use cases.
But Ashish, if I may, in this whole process of back and forth, only the banks are making money. But we as consumers are losing out, no?
See, that is a problem which banks and all of us need to solve. That's because of the, there is a messaging rail, which I'm sure everybody knows, SWIFT, right? It's very, very old world, okay? There are, of course, there's tokenization, that's one way to do it. You know, there are interbank hard pipelines that one could build. So that's an issue of inefficiency, which will get efficient.
But Ashish, aren't you inventing a new requirement under FEMA? There's no repatriation requirement unless it's actually not invested.
See, I'll tell you the danger, right? And I'm going to just spell it. Now imagine our friends at Zerodha are going to walk into the game, and so would other people. This will just create a larger market, because till now it was very few of us going and creating and knocking on doors of consumers and telling them that diversify, and that too as a startup, right?
Mm-hmm.
And as you know, any fintech, any consumer tech needs distribution. Of course, we built it over time. A lot of hard work we had to do. By the way, to the Zerodha team, 3x more difficult to build this than the India stack.
Yeah.
I'm sure you know, right? So what I'm trying to basically say is this, that this value of money going out of India, where even if it's coming to gift, the minute it breaches that $2-3 billion, right? We saw when we participated in that scale, right? We saw what was happening. There were banks being asked to stop doing LRS, right? I remember getting on a call with Yoshi ke kal se dhanda band ho gaya. Some of you guys won't understand, okay? And when this becomes $3 billion, there will be repercussions. So I think in general, for the sustainability and for actual value creation, at the end of the day, the country needs to have the right balance of payment, right?
If I may, Ashish, it's for you guys to make the argument to IFSC and RBI that, look, it's our money, it's Indian-owned assets sitting outside, it's helping our country.
See, at the end of the day, at the end of the day, let's understand that what the country wants also, right? We have to have a kind of a balanced thing. I think what makes any nation uncomfortable is when there's too much of funds going out, right?
But Ashish, shouldn't we approach it the other way? So I get the balance of...
Let me tell you, when you're building, have you played Snakes and Ladder, right? So you're like climbing up and suddenly a snake bites you and goes down. We've seen that happening already.
I get
so
it,
you want to build a sustained and sustainable
I'm talking about
business.
a sustainable ecosystem, but I think you're approaching the wrong problem. The problem is, what's the balance of payments between inflows and outflows? The solution shouldn't be, hey, I want to control outflows more. Let's bring in inflows. The government doesn't care if there's 6 billion coming in and 7 billion going out. It's 1 billion net. Gift is a two-way gateway. I don't think the answer is more regulation on an already overly regulated FEMA space. So I'm definitely on the other side of this one.
Yeah, that's fine. Like I'm just telling you that as an industry, all of us, right? Obviously, this is going to scale, right? Why is it going to scale? Because at the end of the day, where is AI happening? All of us are using AI. These companies are going to become more powerful. Money chases wherever value and wealth is to be created. We are giving an opportunity for people to create wealth. So this is going to scale. But you don't want that suddenly a rule comes here, 20% TCS on 1 lakh, another rule comes. And then another rule comes from tomorrow, a person can send only $100. Right? You don't want that stuff happening, right?
All right. On that note, we only have 5 minutes and I promised I would come to the audience. So folks, please raise your hand. Don't disappoint me. I carved out time for you. So please raise your hands and we'll get the mic to you. Yes, sir.
So my question to Tony, like the corporations in which the assets has been placed, what is the security for the real owner who have invested? At any given point of time, if something goes wrong with the corporation, then how he would be secured?
You're referring to cross-border transaction.
Yeah.
I think he means in the context of omnibus and the pooling that... He means it in the context of omnibus and the pooling that happens there.
Yeah, I mean, your account would be here, the custody would be here in IFSC. You're saying if something goes wrong where? In the sub-custodian and DTC, something like that? Okay,
yeah.
So every country has rules and regulation related to customer protection, and Yoshi was touching on some of that. But so I won't go into all the detail. But if it was in the U.S. market, depending on how far, let's just say if the U.S. broker, who's the sub-custodian, something happened there, went through some sort of administration. Is that what you're referring to, like a Madoff situation where you don't have, the assets aren't there or something's missing?
No, Tony, so if you guys go under, if you guys go bankrupt, does SIPC kick in, is the question.
Well, look, I mean, the key is not to be in a position where you can go under, right? So if you have no debt, you have no risk, it's very difficult to go under. But if we went under, your assets would still be with us here. The administrator, I would imagine, IFSC would come in, take over the broker-dealer and transfer the assets to another Indian broker, another IFSC broker. I mean, that's the way it would work. The sub-custody assets remain, right? They would just be then subject to administrative proceeding that IFSC probably would enact. I think I'm answering your question, but the assets don't disappear, is the point, and the record is still there.
The question was like short, but I think Neil, I think you got what I wanted to understand.
So, Tony, if you can just, does SIPC kick in? Does insurance kick in?
Yeah, if you're asking specifically about SIPC, is that what you're referring to, SIPC insurance? Yeah, SIPC insurance can apply. There is a look-through provision, but you have to be on, you can only be one omnibus account away. So if you're 2 omnibus accounts away, you don't get the protection from the U.S. broker, that's subject to this SIPC proceeding, right? So the way we've set up our structure is the accounts are fully disclosed on our books, we have the omnibus, you have the SIPC look-through protection should the custodian, or if it was us, because if we were using DTC, it would be on my subsidiary in the United States. If that would go under, you'd be protected under the SIPC provision. That exists not just here. It's not unique to India. This is how SIPC operates globally through omnibus structures. We, in fact, back a decade or so ago, had this discussion with SIPC and put this in place because this is what we do. We do a lot of this type of...
Yeah, so, and then Indian stocks is very much fully disclosed into the exchange, right? This is actually pretty unique if you look at the 195 nations on the earth. So, we do omnibus structure to broker-dealers in different countries. In the United States, omnibus is a very typical structure that a lot of countries do, actually. So, there's a certain protocol, as Tony was saying, there's SIPC kicks in, just like FDIC and the banking, and then there's a 50C33 protection rule, which is like, the SEC. It requires us to segregate a bunch of the funds so that, like, even if we go under, there's a cash that's sitting even without, like, SIPC comes in. So there's a multi-layers of protection in the even like US law, and this structure has been running for tens of years with the different countries to the United States.
Okay, thanks. One last question over there.
Hey, hi everyone. So I just want to ask, like if a broker or a customer want to move their account from one broker to another, so why this process is cumbersome and expensive, and can we come to a cheaper and a uniform solution in that case, and the end client is not affected?
In fact, just to answer that question, if it's a US broker to broker transfer, it's completely online. I mean, it's called the ACATS transfer, which you can just, let's say for example, you want to transfer from some other broker to Interactive for that matter.
No, but Bhairav, I think he means the fee. There's a fee.
Why the cost is included in that?
There is no cost, at least Interactive does not charge anything.
So I think the sending broker charges a fixed cost, $100. So
if you're sending out of IB also, for that, we don't charge.
Yeah, but let me just say, that cost is a decision by the broker you're with, okay? So check those, when you read the broker agreement, if you have an account with the US broker, not everyone charges.
So do you guys charge?
Do we?
If you're the sending broker?
No, absolutely not.
No.
Neither, I don't think Interactive does either. But there's other firms, that's how they trap you, okay? And I don't even get me going on how foreign firms trap you, but that's one way you get trapped, is through that ACAT fee.
All right, I think we are out of time, but thank you guys so much. Some of you have come from a long, long way, so really appreciate it. Start of something big, I'm sure, so look forward to all that will come.
Thank you, gentlemen, for that wonderful session. And in order to present the mementos, I call upon stage Mr. Saroj Nanda from NSE ICC to present the mementos to the panelists and the moderator. Foremost to Mr. Tony. Mr. Ashish Kashyap. Mr. Yoshi. Mr. Shubho Maulik. Mr. Bhairav Mehta. Mr. Somnath Mukherjee. Yeah. Also to Mr. Neil Borate, the moderator of the session. He's coming? Okay. Can we have a group photograph, all of you, please? Can you step forward a little bit? Thank you very much. Thank you, gentlemen. Ladies and gentlemen, we're now moving to the final session of the day, which delves into navigating the landscape of equity and debt listings, opportunities and challenges. The panel will discuss trends in international debt issuances and cross-border equity listing by issuers. It will also talk upon the role of GIFT IFSC in attracting global capital to fuel the India growth story, as well as reinforce India's ambition to become a global financial hub and a gateway for cross-border investments. In order to moderate this session, we would like to invite on stage Mr. Pramod Rao, I've written here, Executive Director, SEBI. Welcome, sir. Mr. Neeraj Kulshrestha, MD and CEO, NSE International Clearing Corporation. Welcome, sir. Mr. Nagesh Srivastav, MD and CEO, India International Clearing Corporation. Welcome, sir. Ms. Hetal Kotak, Head Listings, NSE International Exchange. Welcome, madam. Ms. Gesu Kaushal, President, Kotak Capital. Welcome, ma'am. Mr. Samarth Jagnani, Head Global Capital Markets for India and Southeast Asia. Morgan Stanley is on his way. Oh, he's here. That was the timing, perfect. Mr. Vineet Gupta, Head of Relationship Manager, South Asia, Commercial Group, Moody's Investors Service. Thank you. And I now pass on my baton to our moderator, Mr. Pramod Rao, sir. Over to you.
Good evening. It's very, very heartwarming that we have so many in the audience, even though this is the final session, as you said. So thank you very much. I'm delighted. We have an excellent panel, and including a panelist who just made it in time. His flight landed just about half hour ago. So thank you for making it, Samar. Very quickly, we will be delving on talking about both equity and debt listing here at IFSC. And, I couldn't have asked for a better panel. We have both Neeraj, Nagesh from the clearing system. We have Hetal, who's at International Exchange heading listing. Gesu and Samarth, who are investment bankers. And we have from Moody's, Vineet as well. So we have a rating agency perspective. So let me begin first with you, Neeraj. You've seen both the domestic market and now you are here at GIFT. What do you see both as the evolution and what's in the future ahead for all of us?
So, good afternoon, everyone. And I think it's a pleasure to see such a decent crowd even in this session. I mean, I echo Sir's view. So I have been part of this system now for the past 3 years. And prior to that, I was on the domestic side. So again, on the exchange space. So understanding the ecosystem here, I think the future speakers will, of course, certainly talk more about specifics, but it's been a fantastic journey. So, and it's all credit to the regulator, which is IFSCA, which has been very progressive with the support of the government. Largely, so if we see, this was to start with a banking ecosystem with some bit of capital markets, and then other various segments were brought in. And similarly, within capital markets then, from futures, then we have migrated to, and bonds were there, but equity ecosystem has certainly been created from scratch. And if you understand the equity system, it's been done in such a manner which can facilitate trading by most foreign investors, listing as well as trading. And we hope to see the first listing on the 6th of March, as was being talked about earlier today. And it's a very progressive regulation. So I'll not go into the specifics because I mean this is probably not the overall theme. Prior to that, there were a few DRs listed here. 2 DRs have been listed. One was, of course, Dr. Reddy's, and then after that UPL very recently, as recent as last week. On the bond side, of course, there has been a tremendous development. Bond side, there have been 192 issuances for a value of around $70 billion. And it's, and the heartening thing there was that out of that 192 issuances, there are 70 issuers which have done multiple issuances, and of which one of them has done 14 issuances. So you can see that, there is a lot of people are taking advantage of this ecosystem, particularly on the bond side. And we hope to see the same replicated. But more heartening is that on the bond side, it also covers a vast ecosystem, right from NBFCs to banking to infrastructure, energy, etc. And also different types of bonds, which is, for example, I was just seeing the data yesterday, 21 green bonds, 9 social bonds, 9 masala bonds, 6 sustainable bonds. So effectively the ecosystem, if you really see, and this is not the India kind of mindset which is AAA. This is BB minus, BBB, those are the kind of issuances, ratings which are going from here. Largely, of course, fixed rate bonds, but this does show the maturity. And coming to some of the other aspects, from, when I look at it, we have been created as an ecosystem to solve the issues of foreign investors, which they may be facing largely on the domestic side, because domestic they have their own priorities. So which has to be also factored in, because as a nation we want a stability on the domestic side. But GIFT City was, when it was created, it was largely to solve those aspects and to ensure a vibrant ecosystem here, which from a regulatory perspective has been achieved. Now it's up to the market ecosystem to adopt. I'll stop here because if there are other points.
No, I'll come back to you, Neeraj. I'll move over to Nagesh and maybe, more on the lines of what else would you like to see? And of course, Nagesh before the panel told me he's exactly joined a week ago. So maybe the freshest mind on this panel in GIFT. But yet, to my mind, who can probably show us what future gazing might look like.
Thank you, Prabodh, and all delegates who are sitting here. So this session very well discussed about that, how to grow that. So since I am from clearing corporation side, so as a clearing corporation, the role is quite important considering we have to give a comfort to the investors. So as a clearing corporation, I have to ensure that our systems are robust. The investors have that confidence that whatever they are investing, the money is safe, the securities are safe. So that way, the regulator, IFSC, has done a tremendous job. So the regulations have been built properly. It has been brought to it has been brought to certain level that we are having robust systems, transparency is the place. And since, as Pramod has already mentioned, that I have recently joined and I have been working with banks also earlier. So I have seen other sides also. So I am looking from investor perspective also, that what investors are looking at. They are looking at whenever they are investing, how fast turnaround can be done, how fast settlements are happening. At that, the systems are robust. Whenever settlements are happening, they are getting the paying the payouts on time. So that kind of infrastructure has already been developed here. And there are new products which are going to be launched that is already being worked upon. So currently the derivatives tradings are happening. So that way the products are there, the discussions are going on, lot of traction is happening, lot of developments are happening. And besides that, from clearing corporation perspective, that kind of infrastructure which is supposed to be there, it has already been there. Only thing is that we have to bring the investor confidence that yes, if you are investing, if you are listing here, insurers are listing here, like it has already mentioned, and first issue is being listed in equity. So once the issue is there, the people will get a confidence. So it is something which is going to start. Once it starts, it will give a greater confidence to everyone. And from clearing corporation perspective or clearing house perspective, the confidence we have that the investors would be delighted, the kind of services which we are going to provide to them.
Thank you, Nagesh. I'll move to Vineet, and more because I think debt listing, as you heard already, is really taken off well in IFSC. $70 billion is really remarkable for a jurisdiction which is 5 years old. So to me, the question to you really is, what's next? What do international rating agencies look out for, your perch at Moody's, but also what should be next for IFSC to consider really from debt side?
Sure, thank you, sir. Now, I just want to give you one piece of view, which is typically if you look at any financial center, you will actually see equity being listed first and debt coming in second. This is one place where debt has come in first and equity is coming second, which means in terms of acceptability of the Gift City operations and Gift City location as a listing place, that is very well established. And with that coming into mind, for the future, what is required is that you should have a playbook that if something goes wrong at any point of time, at that time, what can investors expect that this is how the problem will be solved. That is something which is extremely important, because all said and done, this is a listing which is typically outside the comfort zone of many investors. And hence, if you have a playbook that yes, this is how the solution will be provided, will actually give much more comfort to the investors to keep coming here.
I think it's an important point, and I'm hoping my colleagues from IFSC are sort of taking note that indeed it is planning for what can go wrong around debt and therefore having something to deal with it, especially when you have issuers from different jurisdictions, including India, which are listed.
And one more thing, I mean, not many people know, the listing is not just of Indian issuers. You have one issuer out of Sri Lanka also which has come forward and listed its bond, a social bond that too, and come forward and listed it here. So therefore, there is an international issuer who has come forward and used the services in its entirety for getting its debt listed within IFSC. So that is a great achievement.
So I think, the message at least I'm taking away is that cross-border insolvency regimes need to be studied by the IFSC team, by the market intermediaries to figure what's next. And I think that's a very important point you've made, Vinny. Thank you. Hetal, I'm again changing gears and more looking to you because you've been drumming up interest around listings. You've got MOU which we saw with the Colombo Stock Exchange and so on. But what else do you see which is going to drive listings in IFSCA jurisdiction? We are having the first equity happen, but what's next, or what more?
Thank you, sir. So at the outset, I would like to actually thank all of you, because the most rarest commodity, which is attention, you guys are giving us in the last session of the day. So thank you so much. And to answer what Pramod sir asked, as to what next, I'd just like to, highlight quickly upon what we have achieved till now. The question that we get asked along with what next is, what next after the fiscal advantages or the fiscal benefit goes away? So to that, we strongly feel that since last 5-6 years that we've been pitching and we've been speaking of debt, the entire debt ecosystem in GIFT City, it's not just the fiscal advantage. How we have 4 pillars to every strong foundation. We have really strong 4 pillars here also. Fiscal advantage, obviously, the lower withholding tax being one of them. The other one, the excellent regulations of the unified regulator that we have. What we have experienced is that people are actually coming and telling us that this is not, this is just not being humble, but it's not the best policy, but it is the best of all the policies. So it is so seamless and so easy for them to adapt. The legal counsel have given us the same response. So in terms of ways forward also, I believe that the progressive thinking that we have in terms of adapting the regulations to every new thing, be it blended finance, be it transition finance, given the fact that we aspire to be a hub for sustainable finance, all this is going to matter a lot. So fiscal advantages, regulations. The other one, we have instruments from 1 billion to 3 million listed, and each one of them seamlessly follow the same process, the same commercials, the same guidelines, and the investors are equally comfortable. Speaking of investor comfort, again, as we all know, these instruments are mainly placed with professional and sophisticated investors, mostly privately placed, again, all flowing in seamlessly. The confidence in GIFT City jurisdiction, what we have seen, which was 5 years back when we used to go and pitch for these listings, or we used to pitch for issuances out of GIFT City. It used to be like, oh God, again, you guys are back. What is, just for the sake of being on GIFT City, they were there. But we are proud to share that over the last 2 years, if we analyze the ECB data, there are barely 2 issuances which have gone to global stock exchanges, and all of them are listed here in GIFT IFSC. So that is one of the biggest achievements that we have. And last, and very cost sensitive, all Indians are extremely cost sensitive. So commercially listing in GIFT IFSC, I would say, as per our analysis, I'm not giving numbers, but just a ballpark, is 1/10 the cost of listing in any global jurisdiction. So these are the 4 strong pillars that I feel even the tomorrow will be much better than what we are seeing in the present situation.
Thank you. Both valuable points, and of course you already heard the audience, applaud you for what you've achieved. Gesu, turning to you, we are going to see the first issue, but really the success of debt and UDRs, which was mentioned. To me, what are your takeaways, both as a banker and when you are advising potential clients, when they are going to be looking at GIFT City? What is it that plays in your mind and your advice to them?
Hi, everyone. I think, one, I must say that as a part of the Standing Committee of IFSCA on policy framework, great progress. I think the proof of the pudding is in the eating, and with this offering that's coming up, I think it is very encouraging. I think what IFSCA has done is absolutely wonderful. We made a very progressive, lightweight, but a sensible regulation, I would say. I think the challenges that we face or we get asked are really, where are the investors? And when issuers want to come to a market to list, they not just want investors in the IPO, but they also want a vibrant secondary market where there is continuous trading possible, supported with institutional research, broking, etc. I think as far as the regulator is concerned, the decks of making execution easy, putting the policy framework in place is absolutely great and wonderful, and the first important step. I think the next step would be to create that environment for investing, which will comprise of institutional, retail, AIFs, private investors, a whole bunch of differing view investors, so that trading is possible. And I would hope the next 2 years we should kind of get there. Small steps taken. Debt, of course, has led the way, but I think we'll get there soon.
Thank you, Gesu. Samarth, I'll turn to you. And IFSCA, I always think of it as a gateway both to Indian capital going out, Indian investors sort of participating in international markets, but as much obviously a gateway for international investors investing into India. How do you, as both an international merchant bank, but also who's seen the Indian markets evolve, been part of IFSCA's advisory committee as well, what do you see here?
So the success of a global financing center is, and this financing center has been created for driving India's growth forward. So the objective is to channelize foreign capital better, to direct it for areas which are priority, and same ways to provide a responsible way for Indian capital to go abroad, because here they can put the right guardrails of allowing Indians to invest abroad in the right framework. I think what we have seen IFSCA and GIFT do over the last 5 years, and this will continue, I'm sure, over the next 2 decades, is areas of priority. Aircraft financing, absolutely a priority. India is the largest market for new planes being ordered. Creating a framework. Both the airlines have their financing entities here, they actually use this. This financing structures and the framework has been created in consultation with the industry. It is best in class. People are moving from Ireland into GIFT City for doing that financing. And as that market deepens, we'll definitely see more products in that being brought in. Similarly, the government is focused on data centers, AI, semiconductors, all of these. A 2 gigawatt data center, the kind Meta is building in the US, which we just did financing for, needed $30 billion of capital. To channelize that kind of capital, GIFT and IFSCA will play a very important role. We understand several investors are looking at this route to channelize that capital to bring that into India. The government's recent tax incentives with respect to data centers that the government has given till 2047 means, and those are large sums of capital. So that is a way of getting capital in. We know of many participants who are using that. Just to the point that ma'am said, acquisition financing related loans, pretty much every participant in that market is providing that capital from their GIFT City branches, which demonstrates the fact that the objective of the financing center of providing capital for productive uses of our economy is actually, we are seeing that on the ground, and that is what is part of the role. I think what we would like to do more as participants and colleagues and focused on growth of the economy is how do we improve the mechanisms of the outward investments. Right now, I think we have not leveraged, so we have UPI in India, but UPI with GIFT is not necessarily integrated, right? It's a simple thing. Even if you create a 2-5 lakh kind of a framework, can you provide a mechanism for people to participate? And the best point is, we are in same country, we can regulate it. Yes, it's offshore, onshore, but the flow, if we increase the velocity of the flow, that is what this market will drive, and we will be leaps and bounds ahead of all other markets because we are directly correlated to India's economy and we are the fastest growing economy. So that is definitely what I would like to say on that.
Again, I'm sure takeaways for the banking colleagues on IFSCA side, both in terms of UPI and NPCI is indeed partnering with as many as 20 different nations that I understand, and IFSCA is indeed a foreign jurisdiction worthy of exploring. Thank you, Samarth. Gesu, I'll build on the question really from Samarth's, where he articulated about aircraft finance, shipping, I'm sure must be on the agenda and so on. So beyond IPOs, what else do you see which IFSCA can really contribute to help in and so on?
No, I think there is serious work that is happening on the policy side on both follow-on offerings, of course, and other products which are relevant for capital markets, similar to the Indian market. So we do see that kind of enabling, not just, Samar talked about specific financial products, but that should open up acquisitions, that should open up buybacks, that should open up a lot of these other relevant products that, corporates can look at. And of course, I think on the debt side, there is a lot of structured products that are being talked about. What I understand also is, and I'm not on the debt side, of course, but every need of the industry is looked at seriously by IFSCA to create or enable a framework that allows that product to go forward. So I think we do have a very open-minded regulator, and I think no efforts are being spared to enable as much as the industry wants to allow money to
I describe IFSCA usually to people who are unfamiliar, saying it's the sandbox for Indian regulators. Because several of the things they can experiment here because of the unified, all 4 pillars, as we heard in the morning half, now being operational here. So indeed, that's true. Hetal, you touched upon, and maybe I'll come back to you on the Sustainable Finance Hub ambition for Gift City. And I think, again, there have been a lot of fostering of different things which have been done. But if you could just elaborate what else, what have you seen as what has been done and what more can happen?
So I'll borrow some words from Pradeep sir's statements, which he usually uses, that SEBI also has guidelines for green bonds. But if we analyze and see the numbers, the same Indian issuers who have managed to raise large quantums of capital from IFSC versus the domestic is a testimony itself as to what the IFSCA guidelines permit. So sustainable, us aspiring to be a sustainable finance hub is actually a long story. It started with a committee that was set up. There were so many thoughts and ideas that came up at that time, and every single one was touched upon. What we are trying to do now, along with the regulators, is trying to work and, again, as I said, take the best policies from everywhere, and flavors of every single type of instrument is being encouraged. In fact, we are, along with the regulators, encouraging each small issuer who is into funding, whether it is MFI funding or NBFC's funding, they are doing the funding for a certain social cause or for a sustainable cause, but they are not labeled instruments. So under the guidelines, we are trying to make it so comprehensive that they can also start getting issuer ready to become issuers who can raise these labeled bonds. We may ask, what is the advantage? The advantage is, coming back to ma'am's point, that we are opening doors to them, to investors who otherwise would not look at them if they were not labeled issuers. Like somebody who is lending towards a social cause or lending towards education suddenly gets a social bond flavor. He's going to get 5 more investors from the global market, from the Nordics, from we know where all. So from the sustainability hub point of view, we are working on several areas, from getting issuers ready to making different policies, to promoting these policies, and to, when it actually comes to implementing those policies and monitoring those policies compliance-wise, to doing that. We are working very strongly on foreign collaborations, like, the Sri Lankan issuer was mentioned. Our colleagues from Colombo Stock Exchange are here. I would say they also have excellent policies on green, renewable, sustainable, coastal. I mean, there's so much to learn from. So we are learning, we're adapting, we're trying to pass it on to issuers and trying to see as much more capital that can come into India via GIFT and our exchange being the conduit for this.
I would echo what you said, and indeed it's something I have expressed to Pradeep and the IFSCA colleagues, that indeed the kind of volumes, especially debt has seen, but particularly green debt, I think, and we took, at least in the domestic market, a leaf out of IFSCA playbook of saying that we will use the same definition for introducing ESG debt securities. And again, it comes home to my mind of saying it's a sandbox. So if you have experimented, something is successful, can be imported into domestic side. Vineet, I'll turn to you, and again, I come back to the international perch you occupy. This is a very young regulator. It's the youngest in our financial system, 5 years old as a statutory body. And if you had to guide them about what else should they do, you said, and I think you mentioned about the playbook, and I'm hoping they have noted that. But I wanted to draw out if there are anything more and what they have done right and what else they can be, sort of guided by as they evolve.
Sure. Everyone sitting here knows that IFSC is an integrated regulator. Okay? It's the one-stop shop and can do things what others like 2 or 3 entities would do. So now I would like to just change that phrase and not call it integrated regulator. I'll call it integrated enabler. It enables many things which have never ever been thought of or even done in the domestic tariff area, if I can again use the term. So therefore, the difference is big and hence the opportunity is big. So if let's say going forward, today if you talk of, let's say tokenization in the domestic market, right? Moment you say the word, possibly it may be thrown out of the window, okay? Whereas, again, this is a sandbox. You can actually try out, perfect it, and deliver and show results. And being the integrated enabler as a tokenized entity that I want to list, I only have to speak to one entity. And the opinion and views and thoughts and processes of one entity will derive and determine how I act. Hence, interpretation, getting the job done, getting everything done becomes that much easier. Hence, the integrated enabler, I'll again use the phrase, can actually help you there, and that's what is the next. And I can assure you that domestic tariff area cannot handle this at all. Sorry to say that, but that's what it is.
No, I think, again, I end up looking at it with the lens that you have, and maybe I'll borrow from the panel which was on tokenization. That, what we have an opportunity is not a uniformity, but a unified, and maybe not integrated alone as a word, but interoperable. And because you have that opportunity, because all 4 pillars are sitting inside one regulator, I think that's indeed something to build on. Thank you for making that point. And Nagesh, let me come to you. And one of the interesting points I heard on the previous panel was again discussion around omnibus versus segregated. Indeed, I would say India's success over the last 25 plus years from the time depositories was thought of, I think has built on that we have segregated account structure, we know, and we can pinpoint the individual investor. The global markets have evolved differently. The UK, the US are, I think, prime examples of omnibus or nominee-based structures. And if we had to experiment, like I said, it comes back to IFSC being that sandbox. How would you sort of share your thoughts around what could be the points of consideration? I know we heard the previous panel, but I thought it's interesting to have your perspective.
That is a good point, what you have mentioned. In earlier discussion also it came out that that omnibus structure with broker-dealer structure, that's what we were discussing about. So that is something globally what is already happening. So if we are if we are considering GIFT City or this area as a foreign jurisdiction, and we are enabling all those whatever is available overseas, those facilities, if we can enable, then that is a very important aspect. Because if we are able to equate, if we are able to, you can say, provide facility to invest in those securities which is there at the investors who are actually coming through such broker-dealer structure or through omnibus, where the regulated entities kind of very robust entities having good, you can say, credentials, where we can trust about that SNAP, which is anyway you have mentioned that segregate nominee account, you can say provider. So that has already been discussed upon. So that is something I would like to say that IFSC is already in discussion with that. So only thing is that how fast it can be done, we have to certainly deliberate. It is not that simple because the way you mentioned that segregated to a omnibus structure is certainly there are a lot of you can say roadblocks or maybe many considerations have to be you get deliberated upon. But certainly, if we have to look at a global structure, then this is an area which certainly is required to be looked at. And certainly, that is already been worked on. I'm sure that regulator has already been working on it. And that is there. One suggestion, one idea could be that even for Indian investors, if they are trying to invest, a smaller amount without PAN should be allowed to invest. Something that is only an idea. That is something which normally people talk about. Since I mentioned that I was on the other side, working with banks, custody and all. So that is something which always come upon. That how to invest, that what is the benefit I am getting for investing in IFSC. So, or you can say gift. In stock exchange, the point comes that I am considered as a overseas entity, overseas stock exchange. So I should be getting all the benefits which I am getting in overseas stock exchanges. So that is something if we can work upon. And certainly it is already being done. A lot of things have been done. I think a few steps more have to be taken.
Right. I don't know how much role a clearing corporation can play, but one of the thoughts which comes to my mind is just as mutual funds in India are invested in without a demat account. You know, it's a statement of account, there's a registrar. Whether that role, if somebody can perform in the IFSC jurisdiction, maybe that's a way of dispensing with the requirement of demat itself, demat account itself.
Certainly can be done, like folio structure is there, then RTAs are doing lot of deliberations on that. So only thing is that what concern is always KYC and AML and the source of funds. If the entity is able to have establish the genuineness of funds, then that certainly can be worked upon. And that is something would be required in this area as such. And yes, stock exchanges can be enabler for that. Clearing corporation will have robust mechanism that way. So if we have certain kind of that, we can certainly develop those processes in place that we are able to ensure that required regulations are being followed, and the genuine investor, I'm not saying investors, genuine investors are getting benefited out of it.
Let me come to you, Neeraj, and I could already see you wanting to reach for the mic. So please, both on the omnibus, and I think again, it's your vast experience which speaks to both seeing the debt and equity side evolve in Indian markets, but really, yeah.
So one of the important things about this jurisdiction is, which we have probably not talked about, is the dollar clearing, which is happening here. So understand that this is equivalent to a Singapore or a Hong Kong or any of the other international jurisdictions where dollar settlement takes place effectively on a real-time basis. I mean, we have achieved that, and it's happened, and this is, and it's a use case waiting to be utilized by the infrastructure. So from a clearing and settlement perspective, that's certainly one of the important aspects which we have to also understand. Along with that, I'll just say, IFSC in its wisdom, when bonds were permitted here, they had also permitted global depositories. So the insistence was not that you need to have an account with a local depository, but they permitted global depository. Now that was foresight is what I will say, and effectively now that, and because of that, the bond ecosystem actually developed. Okay, so because there was no insistence that there should be an account here. So that means we were trusting a foreign depository to hold the securities on behalf of the investors who are investing in these bonds. Now that, once there is a reality there, it's an evolutionary stage, so I do understand that. So it's basically how do we build on that? So there is a need for depositories here to connect to global depositories. It's something which should have happened yesterday. And so that is one very important enabler which will certainly help us. On the aspect of omnibus, as you rightly mentioned, it's finally KYC has to be done by someone. Can we trust an FATF jurisdiction entity which has certain recognition, certain license? Whether we can trust that is a thought, which we should all consider, because it's not that it's anything new, it's like trusting another IOSCO entity. So it's conceptually, we have the ability to think through such matters, unlike on the domestic side where there are other realities to bother about. So therefore, and we do not really have the friction of forex and all these kind of things. And on the aspect of trading, there is just one particular point, from a bonds perspective, which is, since we are a sandbox, we should also look at a progressive CDS framework. A credit default swap. So see, from a perspective of what happens is, from a bonds perspective, while we may say that there should be trading, this, that, etc. But there should be an ability for people to hedge. Now, so CDS is very widely used across, and on the domestic side, there are certain regulatory aspects associated with that, where somehow the product has not really taken off. But there is an opportunity here where we do understand that there are participants who would be interested in that. So that's one area to possibly consider. I'll just stop this.
Thank you. Again, I'll move to Hetal. One of those things, especially which Neeraj touched upon, is this connectivity with overseas depositories, overseas, Clearstream or Euroclear and so on. Again, to my mind, one of those things which have driven that is probably the liberal way that IFSC allowed that to happen. And again, maybe correct in its own position when it did. But I think it contributes at some level to lack of trading that we see here, right? If you can elaborate, what can we both think about it? What can be both friendly to those overseas investors and yet compel, and that was the point Gesu was making.
Absolutely,
we need
sir.
Trading here.
Absolutely. So Neeraj sir has touched upon a very important topic, which we feel is like one of the small missing links, which tantamounts to being a big missing link, because the question again boils down to once it's listed, then what? What happens? So at least in other global jurisdictions, what happens is that even though the instrument is not getting traded on the stock exchange, but the facility is there, the possibility is there because of the connectivity between the global, the clearing ICDS, which is something which is missing here. Now, the large issuers which are there, such as the RECs, IRFCs and Adanis of the world, they still have the global ISINs, they still have the global depositories, global custodians. The trades are still happening OTC, they are being reported on other platforms. That is continuing seamlessly. What we are trying to encourage here in GIFT City is an end-to-end issuance from GIFT IFSC. The central depository of GIFT City itself creating an ISIN, which we are very proud to share that they are a global registered depository and they can issue an international ISIN. But then what? It stops there. We cannot clear and settle that instrument from outside of IFSC. Now, we know that most of these instruments are held to maturity, as we've already discussed that. But this just puts a full stop, that there is no possibility of even trading it. So, again, small ticket size issuances are happening end-to-end from GIFT City right now, so this question hasn't come up. But when we are encouraging large issuers to completely adapt to GIFT City rather than doing it from global jurisdictions, it will be definitely one of the biggest pain points, I would say.
Gesu, again, one of the things which one notices is that we keep talking about individuals using LRS and so on, maybe corporates as well. But somehow we don't focus on that all our, I should call it retirement savings, which is in the NPS, CPFO, or long-term investors like insurance companies. Somehow they are not in their investment patterns investing in international securities, right? I feel it is one of those blind spots in our regulatory system that we don't have geographic diversification at all. So is there a story beyond India? Is there a thing which we should sort of encourage both IFSC to think about, but also other financial regulators, the policymakers around that?
So I think traditionally we've been very cautious as a country, both in terms of enabling our issuers to go overseas, as well as investors to invest overseas. I think there's a lot of effort being made to both with SEBI, IRDA, etc., to permit certain amount of their investment corpus to be invested overseas. The challenge, I think, remains around how does one diligence these assets and how does one access them. Mutual funds, for example, do have a small portfolio now that they can invest in the US markets, etc. So this would somehow be like a competing product for what they're already doing in India. I think a little bit of, it's a little bit of a cautious approach that we've had. Maybe over time I see some of that changing, but it is a mindset issue that we'll have to overcome. Also, getting the LRS investments per se may also not be as easy, right? Because one is information to retail investors. You don't also want only a retail market. So we are hoping that the first step that this IPO should do well is the first litmus test, and then we get more and more issuers. We've also been very cautious, like I said, about issuers going overseas, and Samarth and I have been on committees for direct listing of Indian companies overseas and vice versa, and we've had, as a mindset, we've been very close to it. So I'm hoping that along with SEBI and other regulators, we need to break the concerns around it or find checks and balances that make it possible.
Certainly, I think
time.
direct listing has got at least enabled in the statute, if not the rules. So the question is who's first, and maybe what we see in March might be a signal towards that. Samarth, the same question to you, and again, from an international merchant banking perspective, at least the way I've ended up seeing is in domestic territory, domestic India, we end up seeing overseas pension funds. We see sovereign wealth funds and so on, all of them coming into our markets. And obviously, they're doing it for geographic diversification. They are seeing a high growth area. But is that part of, or should be part of, any institutional investors' mindset in India too?
Absolutely, it should be. So if you call it a sandbox, that sandbox right now is functioning only to get foreign capital in different forms, shapes, products, structures to come. But it should function in the same fashion to get capital out of India into the areas where we want it to go. And the fact that we are kind of effectively the funnel means we can have the right framework and regulations and limits which allows certain classes of investors locally to do this here. I think the biggest advantage we have is the first thing as members of the industry when we discuss at SEBI is how are we protecting the retail investor, mis-selling, because our market is free. If you discuss with RBI, FX or any other free market, everyone locally can invest in products, there can be mis-selling, insurance. It's a consistent thought process, right? There's no retail here, right? And whatever you want to permit, i.e. IFSC wants to permit, they can specify the norms for permitting. If you ask the top mutual fund CIOs in India, they will say they need a route to invest outside India because effectively we are driving valuations in India up because it's trapped capital. If you spoke to insurance companies and asked them, are you willing to hire an asset manager where 3% of your assets can be invested abroad? And maybe you will hire the mutual funds as asset managers because they have $7-8 billion deployed. They will say yes, because the other countries are delivering returns and some of these countries are strategic partners. If we are in a multipolar world, we have the Prime Minister of Canada in Mumbai today. We had various other dignitaries on the AI summit. We are doing bilateral partnerships with them. One of the things we can do as bilateral partnership is our investors can invest in areas which are priority for them. Nuclear is priority. France is signing stuff with us. An Indian group of pension funds can take maybe 1% stake or provide some funding there to provide support there. We have capital. We have created a domestic capital market which can channelize capital, and IFSC can actually drive that initiative very, very well because we will frame the regulations which suit for the economic purpose, not just for the purpose of creating regulation. That's way how over the last 5 years we have all the regulatory action has been to either boost liquidity onshore through this funnel, right? So most of the stuff on the equity side increasing. I think there is a lot to be done. We talked about risk management. CDS from a debt perspective, equity risk management, all the equity risk hedging products, nothing exists in India. We think of F&O as a mechanism in India where retail is trading, but there is so much more to equity derivatives hedging beyond, and this can be the market where we can create those products and use the way that we have this funnel and the connectivity between India and GIFT to channel that in an organized fashion. Liquidity, cash trading liquidity in India has doubled from 7 to 14 billion on a daily basis. No reason it should be 30, 40 billion or lower, because it's all about what risk management products we can create, because the biggest thing, a local investor and a foreign investor takes risk while investing in equity and debt is liquidity. So the more risk management products that exist, the better is the liquidity discovery and the deeper is the market. So,
thank you. Thank you. Again, I think that makes a lot of sense. Vineet, over to you in terms of both, what should issuers be looking for when they are tapping the debt markets, when you as a rating agency are looking at them? We've had a successful run of Indian corporates which have come in here, but we will start to see hopefully other countries, companies from other countries also coming here. But when you put on that rating hat, what else are you looking for from them? I think again, IFSC has been quite regulatory friendly in that sense in creating a framework. But for issuers, what would be your, and for intermediaries who assist them?
See, typically the starting point for getting a bond listed is getting a rating done. So I'm trying to market myself here. So get yourself rated. That's point number one. Second, don't get bogged down by the fact that you may get a rating which is lower than the domestic ratings. So if you are a single A rated domestically, it doesn't mean you'll get a single A rated internationally. You could be somewhere deep down in the high yield category. And again, high yield does not mean that you will default or you have defaulted in the past. High yield still means that you will pay all your dues on date, on time, in full. It's not that you're going to default even 1 rupee at that point of time. So if you're a single B rated entity internationally, you will still pay all your debts on date, on time, in full. Hence, don't get, let's say, don't consider that rating to be a setback to your own operations or even a comment on the way that you are being run as a company or as a corporate. This is how internationally ratings work, and this is how it will continue to work. So be open. And one more thing which has recently happened is the ECB guidelines. Significant is actually a very small word. It's actually a turntable. So everything has been turned upside down. Whatever was the past thought of domestic tariff area, I'll use the term, it is completely an overall complete shift. You earlier had so many restrictions that you couldn't do this, that and this. Today you are like, it's practically open. So get the mindset that yes, I will try and get international capital. And by the way, international capital is waiting for you to tap it. They are not like, okay, I'm not going to invest in India. No, they are just waiting for you to come forward with a bankable proposal, and they're very happy to provide capital. So that's the biggest thing, that please get away from that mindset that no, I'll just stick to India. No. Capital is available globally. Go ahead and tap it, and get yourself rated. Thank you.
Vineetji, just if I may for 1 second, you marketed yourself, but for an issuance out of GIFT City, you have to be a CRA in GIFT City. When is that happening?
Very soon. Very soon.
Thank you. Thank you. Both for somebody who marketed, but also setting up shop here. So I'm sure we welcome that. It's probably going to be the last 10 minutes, but I want to use the opportunity of going one by one, more in terms of a wish list, if you will. And some of you have been here from yesterday, so if there are things which you picked up, heard, which you want to amplify again, because this is also the final session, I would request Neeraj, you to begin, and then we'll go down the panel.
See, finally, speed of execution is what will differentiate us in everything. So, I was just reading something very interesting, so I thought I'll just narrate it. So, from 2020 to 2024, Singapore experienced a significant decline in both listing volume size, particularly in 2024, with 4 listings to the whatever. The Equities Market Review Board was set up in August 2024, and in Budget 2025, this is in early 2025, host of announcements were made which incentivized listing on exchanges there. So, I mean, all that I'm saying is, IFSCA already has done a fantastic job, but it's just that we cannot even wait. I mean, we just don't have breathing space. And I mean, I know that we are just working with too many policies, too many aspects, but this is the reality of the world, and this is what people would expect from us at least on the IFSC side. So, I mean, we have to continue to be active or whatever and ensure that things are done. Thank you.
Yeah, don't stand still. And indeed, I can only share that IFSCA benchmarks itself with all the global financial sector regulators and offshore financial centers. So I'm sure they are up to mark on that. Nagesh.
So I'll take you from address from Mr. Njeti Srinivas, former chairman IFSCA. We are acting as a Setu. So I am becoming greedy now. So what we are looking at, we should be able to offer all the products which are available in the capital market through stock exchanges, and it should be available to not only to overseas investors but to Indian investors also. Yes, we have to build ecosystem, we have to build regulations, but systems, process, systems, everything has to be built. That certainly will be able to do. As a clearing corporation, as well as for exchange, we would like to ensure that the robustness, systems, clarity, everything is in place. So we are with the regulator, with the investors also, that we will be able to service them the way they want, and we would be able to handle the volumes also if it is required.
Thank you.
So I think a lot has been said over the last 2 days, and this being the last session, no real gyan, but I would like to say the passion that our MD shares for the exchange and GIFT City, taking cues from that, the last final thoughts are that from 2018 till today, it was just a trailer, picture abhi baki hai.
Well said, well said.
Yeah, in fact, I was going to go contrary to both of you and say, we need some patience here. We are a young, platform, so to say, and I think we've done very well for the 3-4 years of active life.
I'll just say, as one of the first foreign investment banks who is present in GIFT, we truly believe that this is the place where the two-way liquidity and fungibility and the capital market growth, both equity and debt, will get created for India to drive growth. So we'll be fully contributing to all products and trying to bring that to fore.
Definitely, I would echo that, and I would use another term, which is adjacencies. So today, there are certain products which are available in the domestic market. There are today products available in the IFSCA market. So whatever adjacencies which you can derive from international product suite, but is not available in the domestic market, that can be tried and tested in the IFSCA market and be offered to both institutional and HNI investors domestically and to international investors for the GIFT City. That will help the GIFT City economy, GIFT City location, etc. in a much better way and be actually be differentiator to the domestic market.
Thank you. Again, the few thoughts that I'll just emphasize, at least which I picked up and which I also felt. Like I said, I think we see IFSCA as really the sandbox of a unified, interoperable regulator. It should really continue building on that. That it's a gateway to capital coming into the country, but as much as a capital, a gateway for, and that's the Setu really. So I'm very glad I'm using phrases which former chair of IFSC has said. And I think to me that it's a sandbox that we can experiment with newer architectures, with newer products, testing them until we draw comfort. You referred to tokenization. I think amongst Indian regulators, IFSC was the first to put out a paper on real-world asset tokenization. So I'm hoping they take it to the next level in terms of what can be done. There are several who are in the sandbox, specific sandbox, who are already in that. But creating a regulatory framework will be really interesting. I think it's time for me to thank those of you who are both in the audience and here. I see a hand being raised. Yes, please, if somebody can get a mic.
Sir, I'm Pradeep Kumar. We are the investment banker to the first issue which is going to be listed on the 6th of August. Our name is Global Horizon Capital Advisors. And first of all, let me thank IFSCA and the NSCIX and INX, all the three participants and other supporting these things, which we have been working for almost last 1 year very relentlessly with all of them, and they've been very positive and very progressive mindset. So let me put that in place first. But now, since you've been taking the wish list from this, we have a one wish list. Our interaction with investors overseas and with especially with the anchor investors as well as the retail NRI investors, they have one question to ask. They're saying that, okay, you're showcasing us the best place and best market and all those things, but tell us one question: why the Indian residents are not allowed to invest? Number one. Number two, they say that why the best of the companies which exist in India, why they are not allowed to be being listed there? So these two questions, of course, government there's none from the government, but through all of you we can. So these are the two things. Then there's one specific suggestion which we made already in writing, which for all of us to consider. There is a definition of beneficial owner and permissible holder in FEMA. That must be looked at very seriously because it's the biggest hindrance for a lot of investments which may flow in from outside, where the people are holding beneficial owner of 10% in those entities. But none of the money, I mean, if you presume that money is gone from there and round tripping, that's a different ballgame. Otherwise, a lot of people have raised money abroad. They are the only beneficial owner of those entities. So these are the wish list we want to place it, because unless we put in the best foot forward, we expecting all over the world best people come and invest here, and we neither are allowing our residents to invest, nor we are allowing our best companies to list here by way of dual listing, etc. So these things may be addressed.
So I can at least try to answer the dual listing point. I think it's work in progress and substantial work I think has happened. Will we see that happen? I'm sure we will. Sooner than later is what I would like to think. But on the Indian investors not being able to invest, I think again we should recognize that there should be, and there probably is, creative tension amongst the domestic territory and the IFSC jurisdiction, right? So probably if I had to argue the case for Indian side, I would end up saying that they will be saying we have a perfectly good 2 exchanges, 3 exchanges, in fact 7 exchanges in the market, where you can come, do a public issue and raise capital. Do you really need to go outside to do it? And Indian investors know our systems well, so why shouldn't they participate here? But having said that, I think I mentioned, I see this as a gateway for Indian investors to invest abroad too. So should it happen and how should it happen? I'm sure regulators and policymakers will get around to it. On the technical point you mentioned about permissible versus beneficial owners, again, I'm glad IFSC team is here. They do have RBI on their board as well. You can certainly take it up and see what comes of it. But if any other reaction, Neeraj ji, or yeah, thank you. Anybody else? Any other question? Yes, please.
Thank you.
Myself, Deepak Gulania. I am the compliance officer coming from the fund management entity. Sir, we have talked a lot more on the access to the global market. Like we directly purchase the Apple stock from the gift city. But I think we need to do more work on the access to the India. Let's suppose if I am the US persons have the account in the USA, and if I need to do the trading in the NSE, let's suppose we are the fund management entity and we will register and list our retail fund in the stock exchange, then I can easily trade or purchase the units from the USA. I do not require to do again KYC in the gift city, because the biggest challenge is KYC issue and opening of the account, because many of the investors says that I already have an account in the USA broker, so why again and again I need to do the KYC. So if any authority like IFSC give the relaxation, then it will give an open doors to the FME industry for the retail fund. Like we talk more on a global access, but I think we need to think to access to the Indian market for the foreigners.
If anybody has a viewpoint. I think, again, some of it will be within IFSCA powers and some may not be. For instance, KYC, I know for a fact, is governed by the PML Act. And the KYC stems from that as a source, so as to speak. So how much of flexibility they do have, don't have, gets determined with that. So sometimes the regulator may be sympathetic, but please understand that sympathy may not translate into actual action. I'll leave it at that unless there are any other questions. I was reminded here that there may be some of us who are catching a flight out this evening. So I'll bring this to a close with that. I have one last wish. I think I continuously saw the books being given as a present for those who have been participants in the panel. I think I saw the book's title is 1929. I think I'd love to see a book called 2020, which is about the founding of IFSCA. So some of you should put together that as a history, and maybe at ensuing, GSMCs, we can probably see that as a text. Thank you very much.
Thank you very much. And one more round of applause, because they ended right on time. Thank you to the moderator, sir, and all the panelists. And I now welcome on stage Mr. Shubho Maulik from Appreciate Broking to present the mementos. Foremost to our panelists, Mr. Neeraj Kulshrestha. Yeah, please. Mr. Nagesh Srivastav. Ms. Hetal Kotak. Ms. Gesu Kaushal. Mr. Samarth Jagnani. Mr. Vineet Gupta. And to Mr. Pramod Rao, sir. I request you to kindly pose for a group photograph, everyone. And any event cannot end without an official vote of thanks. For that, I would like to call upon stage Mr. Saurabh Kumar, Manager, IFSCA. Welcome.
Esteemed dignitaries, distinguished speakers, dear participants, ladies and gentlemen, Good evening to all of you. As we draw the curtains of this memorable Global Securities Markets Conclave 2.0, it's my privilege and honor to deliver the vote of thanks. First and foremost, I convey my heartfelt gratitude to the luminaries who graced this occasion and set the tone of the global conclave. Mr. Giles Roth, Minister of Finance, Luxembourg; Dr. V. Anant Nageshwaran, Chief Economic Advisor to the Government of India; Shri Injeti Srinivas, Chairperson NSE and former Chairperson IFSCA; and Mr. Jean-Paul Serves, Chairman ISCO Board. Thank you all for the intellectually stimulating dialogues that gave us all sufficient food for thought and instilled confidence and clarity about GIFT City amongst various stakeholders in the bold vision of GIFT IFSC. I would also like to express my sincere gratitude to the distinguished speakers, panelists, and moderators for sharing their knowledge and expertise with us. The insightful perspectives revolving around digitization of gold, commodity trading, fundraising, trading on stock exchange, tokenization, climate finance, and global access have enriched our understanding of the same. I'm sure that the idea of GIFT IFSC emerging as a setu or a bridge between India and the rest of the world in the financial sphere will resonate and spur action in all of us for a long time to come. I'm sure that the networking that we have outside, it will translate into more and more entities coming in GIFT IFSC. That would be the real success of this particular event. A heartfelt thank you to everyone involved and who have worked tirelessly behind the scenes. The leadership and the organizing teams at IFSCA, led by Chairperson IFSCA, and all the 6 market infrastructure institutions, that is the NSE IX, India INX, IIBX, NSE ICC, India ICC, and IIDI. I would also like to sincerely acknowledge and appreciate the efforts of the entire staff of the event management team, the various sponsors, the staff of GIFT City Club, and the MC of the event, Ms. Dhwani Dalal, for the meticulous planning, arrangements, and execution of the event. I'm sure that the multiple MOUs that we signed with the international exchanges, the various launches, and the very exciting quiz that we all had added a lot of value to this conclave. Special thank you to all those who have traveled far from GIFT City and especially abroad, especially for this event. Last but not the least, to all of you, a heartfelt appreciation for being a wonderful and a vibrant audience who kept the energy and the spirit high during the entire 2 days of the conclave. The active and enthusiastic participation of all the stakeholders has made the GSMC more than just an annual meeting. It has evolved into a tradition of sorts. We look forward to meeting all of you again in the future as well, hopefully next year, and let's carry this momentum forward. Thank you and Jai Hind. Before we all leave, I request the organizers involved, the officials from IFSCA, from MIS, the event management team, and all the people who are there in the Aratai group, please stay back before we leave for high tea. Please. Thank you.
Thank you very much for that warm thank you note. And I must say that I'm also feeling a sense of gratitude for GSMC and the entire staff at IFSCA, because they've been taking care not only for the delegates or the speakers, from the smallest person ever in the room, including me, and asking around, you had your lunch? Did you have your breakfast? Thank you, Pradeep sir. Thank you, Hemant. Thank you, Saurabh. Thank you, Gunjan madam, always for the faith. 2 days before, yesterday morning, this was a gathering. Then, today, we feel it's something called a shared vision. We have long-term goals, but I'm sure you also have the short-term goals. Instead of the ESG goals, we have the goals to reach home early, take the flights, have a happy weekend, home back. And I'm sure the colorful Holi, may your portfolios be always green, may your hearts be always painted with pink and yellow and colorful. And yes, I'm not going to announce next the panel discussion because even I have to breathe in for another 365 days for one more panel discussion. But indeed, I love being over here, as always, one more time and look forward for the next event. Till then, when we meet next, you should be smiling, happy, healthy always. So this is Dwani Dalal officially signing off. Love you all. Stay happy, stay healthy. Bye-bye. Sorry, they don't want me to sign off. We have the arrangement of the high tea, so do join us. And I request the team to kindly come on the stage, the organizing team as well. We'll have a group photograph. The memories have to be captured. Bulletin mein chhapna hai, boss. Gigi, yes.